FTSE MIB over in Italy trading higher. The CAC 40 was trading above the flat line. Now it's sort of hovering around the zero level. Xetra DAX, though, under some selling pressure, down about 0.4%, and the FTSE 100 down by about 0.3%. In terms of the sector trade, you're seeing outperformance in travel and leisure. That's one of the notable outperformers this morning. On the downside, though, you're seeing a sell-off in technology stocks, so some sympathetic trade to what you've seen in the U.S. and in Asia overnight, as well as defense stocks. Let me take you to the European defense sector. You're seeing a sizable sell-off in some of the German names, Leonardo, Rheinmetall, Hensoldt, these stocks that have done incredibly well year-to-date. Huge momentum plays on the basis that European governments are going to be spending more on defense in the years to come. But this morning, sentiment hit by the encouraging headlines around a possible peace deal on the horizon between Ukraine and Russia. These stocks seem to be very sensitive from a sentiment perspective to any suggestion that we may see a resolution on the conflict there and the potential implications that can have for European defense spend. Frank?
Juliana, thank you very much. Juliana Teitelbaum, live in London. All right, time now for your big money movers. We're going to start with shares of Korea Zinc pulling back in Asia overnight after surging more than 20% yesterday as it strikes a more than $7 billion deal with the U.S. government to build a new smelting plant in Tennessee. The company's largest shareholder group is reportedly pushing back on the plans to create a joint venture that will see the Pentagon get a 40% stake. LG Energy Solutions falling more than 5% in Korea today, the move coming as the battery maker's customer, Ford, announced it's cutting back its EV plans, shifting to more gas-powered, hybrid, and extended-range EVs that have onboard gas engines. And the NASDAQ is seeking approval to extend trading into 23 hours during the work week. Reuters reports the second-largest U.S. exchange is asking the SEC for permission to add an additional trading session from 9 p.m. to 4 a.m., looking to capitalize on demand for U.S. equities. The New York Stock Exchange and the CBOE also recently announcing plans for around-the-clock trading. All right, turning back to the broader markets, taking a cautious approach ahead of a lot of key economic data this week, starting with the combined October-November jobs report today that could help dictate the path for Fed policy next year. Joining me now is Alan McKnight, Chief Investment Officer at Regions Wealth Management. Alan, good morning. It's always good to see you. Alan, not hearing you. We're going to give a second for our tech team to get on top of this one. Alan, can you hear me, though? Alan, if you can hear me, can you say something? I think Alan's trying to work it out. All right, we're going to come back to Alan in just a second, hopefully get these tech problems worked out. A lot more to come here at Worldwide Exchange, including a look at merger mania. Is it just ramping up, or is the Warner Brothers bidding war? Does that mean we've reached the peak in this particular deal cycle? And then later, a sticking point that could block a critical data center boosting bill from actually making its way to the president's desk. We've got a very busy hour still ahead. The Worldwide Exchange returns. Stay with us.
So
to Worldwide Exchange. The ongoing takeover saga around Warner Brothers Discovery could potentially take a brand new turn. The company's board is expected to respond to Paramount Skydance's hostile takeover offer by the end of this week, with Paramount indicating it may not actually be its best and its final bid. The back and forth with Warner Brothers captain what's been a solid year for M&A activity, with over $4 trillion in deals being struck globally this year, and PwC just releasing a new report looking at what 2026, what that could hold for deal making. Paul Griggs is the U.S. senior partner at PwC and joins us with much more on that report. Paul, thanks for being here.
Frank, thanks for having me.
All right, really fascinating report. So why don't we start off where we kind of had you right there with Warner Brothers Discovery, Paramount. What does that signal? The fact that we're seeing bidding wars, and I also want to kind of throw in the idea we're seeing more debt financing used for deals. Does that signal that we might be at some type of peak? Is that generally what you see at the peak of a cycle?
Well, first, we'll see. But if you step back and think of these deals, companies are looking to scale platforms. They're looking to build and develop and take advantage of strategic positioning. And to me, these deals are all representative of that. You referenced in your opening, 2025 was a huge deal for mega deals. Take the U.S. alone, we had nearly 75 deals, mega deals done in the U.S. Think of that as a 2x multiple of what we saw in 23 to 24 and 24 to 25.
All right, so you're talking about these mega deals, and that's really one of the keys to your report. So you're looking at the M&A market. If you're looking at the volume, like the number of deals, it's up 2%. It's kind of muted, especially where we're in a situation we have what a lot of people think is a deal-friendly president. But the dollar value of those deals, that's up about 45%. So that signifies bigger deals. What are these bigger deals? Where do they take us in 2026? Is it kind of like a inertia type of thing? The bigger the deals get, the bigger they get? I'm kind of going back to my first question. Or is this a sign that we might be kind of hitting the limit? Because again, we're using debt financing, we're doing bidding wars. It's a lot of things that we haven't seen in recent years.
Think about the drivers of the large deals in 25 for just a minute. If you step back, more than 20%, about a quarter of the big, large M&A mega deals were AI oriented. And if we stare into the opportunity that 26 begins to show, mega deals again will be driven by AI technology. We'll see what happens in healthcare and industrial policy. To me, the real question becomes, what happens in the middle market? You referenced the volume differential between mega deals and deals in aggregate. The middle market will be driven by, do we have a degree of consistency in trade policy? Do rates continue to stay low? And then what do we see with the labor market? Those things, the fuel for the middle market, the fuel for the deal market is what happens to GDP, what happens to corporate profits. It's shaping up, so we'll see what 26 holds.
In your report, you say it's about 20% of those mega deals driven by AI. That seems low. I mean, why? It seems like it would be more. So where are we trending when it comes to that? I mean, you have obviously a window into some data that maybe a lot of our audience doesn't have and we don't have. And also, just I'm sure you're talking to a lot of people. As we look ahead, are we going to see more AI deals? And if so, what does that say about, we're going to talk about the private markets later in the show. What does that say about the private markets? Does that mean they're cooling off, that people actually want to make deals and either cash out of shares of private companies or take them public?
Well, think about a couple of things. First, AI is on the balance sheet at this point in time, and I expect that to continue in 2026, meaning that deals surrounding technology, deals surrounding healthcare, specifically medtech, deals surrounding industrial, which picks up the energy demand that is fueling AI, that will need to be there to fuel AI. I expect all three of those sectors to see a reasonable deal cycle in 26. AI is on the balance sheet, and as a result, returns are otherwise expected. So think we see in healthcare, we see greater point of care delivery as a result of AI. We see drugs coming through the process in a more expeditious way. Take aviation, we see the friction in transport managed, both keeping planes in flight, but also keeping crews in airplanes ready to go. So the fuel that is AI, I expect will still be there in 26. We'll see if it's a mega deal continuance or a small deal recovery.
All right, we'll have to wait and see on that one. I also want to talk to you about private equity firms and their place in the kind of deal cycle, often called sponsor-backed. You say they have a lot of dry powder.
Yeah.
So is that going to drive deals, the fact that they have the money to deploy, or are they going to still be kind of picking and choosing? We had Robert Smith here on the show before, and he just talked about he's not seeing a lot of great deals. I talked to a lot of other private companies, they're just not seeing a lot of great deals. Does the dry powder, is that the catalyst to make the deal, or does the deal have to be more attractive?
Yeah, first, if you think about what we've seen in 2025, think 1,500 of the circa 10,000 deals in the U.S. done with private equity money. Think 8,800 done with corporate buyers. Private equity sets up, you're right, loads of dry powder. We'll see what the market shapes up to be. Again, if we have strong corporate earnings, if we have good labor, if we have reasonable rates, if we have stable trade policy, you're going to see private equity active in 26.
All right. Active active in what areas, though? You mentioned healthcare, some other things. Does private equity want to be in AI, or do they want to broaden out their bets like we're seeing in the public markets? We're seeing the public markets say, AI is great, but we're not really sure who's going to be the winner. We want to broaden out some of their areas that might actually benefit from AI instead of trying to pick the winners.
Yeah, technology, which to me is AI and AI related. Healthcare, medtech, etc. Industrial policies and industrials, broadly speaking. Think electrification, think energy demand, think automation. All three of those sectors I expect we'll see as growing and hot markets in 26.
Big deal year this year. You're seeing another one potentially shaping up next year. Paul Griggs, great to have you. Great report.
Thank you so much, Frank.
Thank you. All right, turning from the mega deals back to the broader markets. We've got Alan McKnight, Chief Investment Officer at Regions Wealth. He is back with me now. Alan, I hope you can hear me now.
I can indeed, Frank. Thanks for your patience.
Technical difficulties resolved. All right, Alan, before we were bringing you on, we were talking to you about some of that delayed data that's coming up later today, the October-November jobs report. The combination of that, we're looking at potentially, the estimate at least, 50,000 jobs added, unemployment ticking up to 4.5%, highest level since October of 2021. I want to ask you, does that matter to the markets? Does it matter to the Fed when we know there's going to be a lot of twists and turns before that next Fed meeting?
Well, there'll definitely be some twists and turns before January, but we think it does matter to investors right now, and more than anything else, if it's above and beyond what is anticipated. So if we come in at a 4.5% unemployment rate, if we add the jobs that are roughly expected, I think it's a non-issue. Now, if it does for some reason, and we have this gap because of what happened in October with the shutdown, if it were to spike more, or we weren't able to add as many jobs, I think that's where the market gets a little spooked.
All right. So you're saying it's a non-issue. Is it a non-issue for the Fed, for the market, for both? Because I would think a relatively strong jobs report with an elevated unemployment picture, when we're talking about the unemployment rate, that's a little bit tough for the Fed. I mean, the Fed is, we heard Jay Powell say that they are looking at the labor market, even though they kind of think things are steady right now. That unemployment ticks up to 4.5. Isn't that starting to become concerning?
You're spot on. And if you look at the futures market right now, it's saying that it doesn't anticipate another cut in January. I think it's only about a 25% chance of a cut. If we were to see that unemployment rate be higher than anticipated, if the Fed is getting a little bit scared, I think that changes some minds. And then we get backed up with some of the inflation data later this week. So you really do have this push and pull going on right now for the Fed around what do we do? And I think it was great to hear from Chairman Powell last week about they don't argue about the current status on either inflation or unemployment, really. It's really more about the weightings between those two.
Okay. Obviously, we're seeing some weakness in the market, specifically when it comes to the AI trade. I'm looking right now. Wells Fargo out with a report today. They say dips become opportunities. They actually say the weak data, at least in the near term, is better for stocks, and they're looking ahead to next year. So are you a person that believes in buying the dip right now and that this weak data just creates an opportunity because there's going to be potentially more income for consumers coming up next year with tax breaks and also tax returns, and the report cites a number of other things. But is right now the time to buy this dip or to be worried about the volatility?
We think you should be a little bit worried about the volatility. We don't want to go running into it. And I think more than anything else, as you talk about this AI trade and the tech sector, the reality is we've had such an incredible tailwind. And yes, we've seen a little bit of pullback of late, but the reality is that people have gotten so excited about what's going to happen. We think they may want to give a little bit of pause here as we go into the beginning of the year. We do think there'll be some tailwinds as we get into Q1 and into Q2. But over the next month or two, we think it's going to be a little bit more volatile.
All right, you also came out with your 2026 outlook. I want to talk to you about our bonds. You're saying fixed income is looking less attractive going into the year. Is that simply because you're seeing a dovish Fed, or is there some other factor?
More than anything else is the starting point matters. And we think about where bonds are, it's hard for us to envision a scenario where, one, rates go dramatically lower without there being some type of recession, which is not our base case. And so we think it's going to be more of a coupon clipping type of environment. You can still pick up a little bit more yield on the corporate side or with high yield, but we just don't think you're going to get the nice tailwind with rates coming down through the beginning of next year and into the end of the back end of next year.
Alan McKnight, great to see you. Thank you very much.
Thanks so much, Frank.
All right, still on deck here at Worldwide Exchange, the higher reward and even higher risk for institutional investors pouring cash into a possible SpaceX IPO. We're back right after this. All right, welcome back to Worldwide Exchange. There could be some good news coming for beating down CoreWeave and other data center-centric companies, courtesy of Washington, D.C. Emily Wilkins joins us now with much more on this story. Emily, good morning.
Good morning, Frank. Well, yeah, building and powering data centers, it could become much faster under a measure that the House was seeking to advance today. Now, this bill would do a number of things, but overall it shortens timelines to get permits by limiting environmental reviews, and that includes legal challenges to projects, and that could allow data centers to get online much faster. The Data Center Coalition says that while building a data center can take roughly 2 years, building power can take up to 5 years, and transmission can take up to 10. I spoke with Congressman Bruce Westerman, he's the sponsor of the bill, and he said that it will also help increase energy production, which could lower electricity costs in areas with those data centers.
These data centers use huge amounts of energy. What we want to do is be able to protect residential and commercial and industrial consumers and not have a spike in energy costs because the demand gets so high and we can't supply enough.
While there is a widespread support for the bill from OpenAI and Micron to the Chamber of Commerce, the bill does face a major hurdle today because a group of Republicans from coastal states say they will oppose advancing the measure because it has a provision that would limit the Trump administration's ability to block offshore wind projects. Now, if Republican leaders in the House can find a way to sway their members before the procedural vote, the permitting reform bill is likely to get bipartisan support when it does get a final vote later this week. Frank?
So, I mean, Emily, I think the question is, why is offshore wind such a sticking point in this whole situation that could be very beneficial for AI, something that seems to be a key policy not only for the Trump administration, I think just for the whole U.S., us maintaining leadership?
You know, Frank, I think it's been very interesting to watch this particular Congress. You hear a lot of talk about the need for increased energy, and there generally seems to be an agreement on that. But of course, as we saw with the fight over that Trump mega bill, when it comes to things like wind and solar, there's a little more of a hesitation when it comes to backing that. And also just making sure that the president, I think for a lot of Republicans, they want to see their president maintain the power to be able to cancel projects if he wants to. So I think that's playing into it here. Obviously, it's interesting with these big bills, even if you have one small provision and everyone's in agreement on 99% of it, but that 1% could be a sticking point when you have a majority as narrow as what you're seeing in the House right now.
I think all you can say is Washington, D.C. Emily Wilkins, live this morning. Thank you, Emily. Great to see you as always. All right, as we hit the break, we're watching a rare bright spot in the markets. That's healthcare. Up more than 1% yesterday and now less than 2% away for its November 25th high. The sector is the top performing S&P sector over the last 3 months, up just about 14%. Top performers include Eli Lilly, Cardinal Health, and Regeneron. We're back right after this.
market's moving up despite no labor supply. And that's a pretty precarious position to be in. Thus, I think we should be on high alert. It just feels like this economy. I know everyone says resilience. I just don't. When the job market's losing jobs, that's not resilient. That's fragile in my mind.
That was Moody's chief economist Mark Zandi laying out his concerns around the labor market and also talking about those with an upbeat view on it. We get a fresh look at where jobs stand in this country with a double dose of employment data coming up later today. Welcome back to Worldwide Exchange. I'm Frank Holland. We're going to have much more what to expect out of today's jobs reports and what that data could signal about the year ahead for the labor market as well as the Fed. So a lot to get to coming up later today. But first, we're going to get you ready for the trade day ahead. We begin with U.S. stock futures taking a look in the red across the board this morning. Off of its lows, though, the S&P and the NASDAQ both firmly in the red. The Dow looks like it would open up about 60 points lower. So this action after major indexes, they closed lower yesterday as we saw a continued rotation into cyclical sectors with financials hitting a record high and defensive sectors also getting a benefit of that rotation. Healthcare, the best performer yesterday. And as we said, today we get that data that was delayed because of the government shutdown. The key one, the combined October-November jobs report. Take a look at the numbers. It's expected to show 50,000 jobs added and the employment rate ticking up to 4.5%, highest rate since October of 2021. All right, right now we're going to take a look at the leaders and the laggers in the pre-market on the NASDAQ 100. We're going to start with the gainers this time around. Intel up just about 0.5%. On semiconductor, strategy, Workday, and Fastenal, rounding out your gainers. Then you have your laggers in the pre-market as well. Atlassian pulling back about 2%. Marvell Technology, ADP, SML, and Palo Alto, rounding out your laggards in the pre-market. All right, tech under pressure is part of that rotation yesterday. Take a look at these names. They were all lower yesterday. This morning, you can see all are lower with the exception of ServiceNow, up just about 0.5%. Microsoft pulling back about 1/3%. Oracle more than 0.5%. CoreWeave down just about 1.5% right now. This morning, we're also watching Tesla and Ford, the EV maker. Of course, we're talking about Tesla, hitting its 2025 high as it announces driverless robotaxi testing's in full swing in Austin. This morning, though, you see Tesla pulling back a bit, pulling back about 0.75%. However, Ford is higher. However, it was lower yesterday after announcing a nearly $20 billion charge as it restructures its EV business and its overall strategy. I want to move on to bonds this morning. As we mentioned, the jobs report coming up later today. That could be a mover for the bond market. Right now, the benchmark at 4.17, the 2-year at 3.5, down here the long bond at 4.85. All right, time to go global. Asia closing lower. Taking a look, you're seeing red across the board here. The Shanghai Composite, technically your leader, still pulling back more than 1%. The South Korean Kospi, the laggard, pulling back about 2.25%. And checking the early trade over in Europe this morning. Looking at that action, we always start with the stock 600, just fractionally lower right now. The Italian MIB is the leader, up about 1/4%. The FTSE 100 is the laggard, pulling back about 1/3%. All right, that is your setup. Now, we're going to turn back to what could dominate the discussion today. That's the jobs report, which is expected to show the labor market, it continues to slow down. We get both the November and October data, which were both delayed because of the U.S. government shutdown. However, the October numbers, they will not include the unemployment rate because the shutdown prevented the collection of data from households. Non-farm payrolls, they likely increased by 50,000, and the unemployment rate, that likely ticked up to 4.5%. While there's no consensus estimate for October, economists are expecting a drop in payrolls, largely because of the departure of federal workers who took deferred buyouts. Joining me now is Veronica Clark, economist at Citi. Veronica, good morning. Thank you for being here.
Good morning. Thanks for having me.
All right, let's start off. How much weight is actually on this jobs report when we know there's going to be other key inflation reports coming up later this week, another jobs report before the Fed meets again and makes this decision? How much weight are you putting on this?
Yeah, I think it is an important one, but there is going to be some weird dynamics in the data that we're getting this week. We know that maybe errors around this data are a bit bigger than usual just because of delayed collections, lack of collections. So that December employment report that we're going to get in a couple weeks before the January FOMC meeting, I do think that one's maybe a bit more important. It's a cleaner read on where we ended the year in terms of the labor market. But this number this morning is certainly important. So
when we're looking at the U.S. economy, if we're seeing unemployment tick up to just about 4.5%, really kind of going back to Moody's points, we had Zandi kind of talking about this. Shouldn't we stop thinking that the economy is so strong if we're continuing to see unemployment at a level we haven't really seen since the pandemic? I think we forget October 2021 was in the middle of the pandemic. And also, it seems, and maybe it's just me, it seems like there's potential for inflation to reaccelerate. So a lot of notes are coming out in recent days kind of pointing out that possibility.
Yeah, no, I do think this is a really fragile, precarious position, especially for the labor market, because, yeah, 4.5% unemployment, it's still a relatively low level, although interestingly, the Fed doesn't necessarily describe it that way anymore. But it's really that consistent increase and the very low hiring that we've seen for about 2.5 years now. I would want to see that dynamic changing to feel better about, and maybe the next step in this labor market is layoffs. We don't see that yet, but I would want to see labor demand start to improve to not think that's a risk.
All right. Let's get to your report and your data. You see 50 basis points of cuts coming up next year, and you say the market's underpricing the risk there. What's the risk? Are you saying the economy is so weak that it mandates 50 basis points of cuts?
Yeah, the risk would really be that we see more weakening in the labor market. So we do think that by that December employment report, which we'll get before the January meeting, we could see the unemployment rate at something like 4.7%, even a bit higher than 4.5%. I think that's enough reason for the Fed to be cutting again in January. I am a bit, by extension of seeing that labor market weakness, I am a bit less concerned on the inflationary pressures also. And I would worry that if we start to see any signs of layoffs picking up, this could be a much worse situation for the labor market that the Fed is cutting more in.
All right, we had Stephen Myron on our show, our air yesterday, I should say, not the show, but on air. And something he pointed to is that he's not that worried about inflation reaccelerating because he feels like shelter to the downside. He's looking at market rent data. Are you seeing the same picture that shelter is going to ease and that's going to just kind of stabilize inflation?
Yeah, I actually think he's incredibly right on this point. All the leading indicators that we look at to determine where we think shelter inflation is going, which is a really large share of CPI and PCE inflation, they've all been softer for about a year now. That's home prices, market rent data. So we would expect that this is a very delayed calculation to catch up to market trends, but we would expect that shelter inflation could be softer than usual for all of next year.
Okay, but even he pointed out to the potential, at least, for goods inflation. So how do we balance that out? The fact that, yes, housing is obviously a huge cost for just about everybody, because I think all of us spend a large portion of our income on our housing, but if goods are going up across the board and people are being laid off, doesn't that set us up for a pretty significant, or at least the potential of a significant slowdown?
Yeah. So we could see that stronger goods inflation. I do think that can be offset with softer shelter inflation. But the third important component of inflation is all the other services. And those do tend to be very dependent on wage trends, which of course would be dependent on, is the labor market weakening more, is labor demand loosening? And we did have the employment cost index data out last week for Q3. We did see the softest increase in employment costs in a while, so it does seem like wage growth is slowing, and yeah, you're less concerned about that other component of inflation then. All of that does kind of point to inflation is slowing in a softer demand environment.
All right. We're going to talk a lot about the AI trade here on CNBC and the build out and some questions about it. Some of the investor questions about the viability of all this, how do you see that playing out when it comes to GDP? Do you see the continued build out of AI? This seems to be a driving force for GDP going into next year. Of course, there's a lot of commitments out there, but it can't just be the big companies doing it. We have to see other companies doing it that can maintain the kind of growth that we've seen.
Right. As macroeconomists, it's very hard to take these announced investment plans and put that into a forecast because, what we want to know is what happens to aggregate growth. And certainly that could be a strong story. I imagine we'll still see that investment in, computer equipment, things like that in GDP. But you do have to weigh that, maybe some of this investment is just diverted from other sectors, would have happened anyway somewhere else, and the aggregate impact is not so clear. And I would, caution also that, some of the strength we had in that equipment investment earlier this year, it did seem to correspond with maybe some front loading of computer imports and things like that. So I would worry that on aggregate, it's not so clear that this is a new strength for a business investment.
All right. A lot to figure out here. We're going to get that jobs report later today. That'll give us some clarity, at least for now. Veronica Clark, great to see you. Thank you very much.
Thank you.
All right, coming up here on Worldwide Exchange. Tesla, Okta, and Roku shares on the move on the back of new analyst calls this morning. We got all the details when Worldwide Exchange returns. Stay with us. Worldwide Exchange. Time now for your morning call sheet. We got Jefferies upgrading his rating on Okta, moving it to a buy. It says the company has a significant opportunity as it attempts to build out a complete identity platform and capture growing agentic demand. Morgan Stanley upgrading its rating on Roku, moving it to overweight, also hiking its price target from 85 up to 135. The bank says its expectations for a strong year ahead for ad spending in the U.S. for the moves. And Mizuho raising its price target on Tesla, going from 475 up to 530. Mizuho citing improving investor sentiment around robo-taxis and increased adoption of Tesla's full self-driving feature. All right, coming up here on Worldwide Exchange, with the sky-high evaluation around a likely SpaceX IPO, what that could signal about investor appetite for that company and those in the private market pipeline. We're going to be right back. Stay with us. All right, welcome back to Worldwide Exchange. Elon Musk's personal fortune in focus once again, becoming the first person ever, according to Forbes, to be worth $600 billion after hitting the $500 billion mark back in October. The latest move higher coming on the heels of reports that SpaceX is preparing an IPO for next year and lining up bankers with an $800 billion valuation. Elon Musk personally owns an estimated 42% stake in the company. For more on SpaceX's atmospheric valuation and the rest of the action in the private markets, let's bring in Kelly Rodriguez, CEO at secondary market platform Forge Global. Kelly, good morning. Thanks for being on the show.
Good morning, Frank. Great to be here.
Let's talk about this action in the private markets. Let's start off with SpaceX. The fact that it's getting up to an $800 billion valuation, clearly there's a lot of demand for those shares. Part of the company's plan, just to be fair, is to build data centers up in space. Here on land, here on Earth, we're seeing a lot of questions about the data center build out. What's going on with that divergence?
It's just one of the hottest private companies in the world. You're seeing SpaceX and a couple of big AI names exploding this year. The numbers year to date are pretty staggering. SpaceX raised at $250 billion last December. So if this rumored $800 billion round is right, the company's tripled in the last 12 months.
But why aren't we seeing the same doubts in the private markets that we're seeing in the public markets? We're just looking at CoreWeave, Oracle, Broadcom, all of them lower yesterday, all of them lower this morning. In all fairness, as risky as the data center build-out may be, I don't think anything's riskier than trying to get into space. Let's just be fair. Flying a rocket's one of the riskiest things humanly possible. And then also trying to build data centers in space is going to be expensive, it's going to be difficult. And is it even clear if all the technology is available right now? Why do investors have so much confidence in the SpaceX and so many other private market companies that do the same thing as public market companies when we're seeing some wobbling in the public markets?
Well, let me first start off by saying SpaceX in the last 10 years has executed. They've delivered on big promises. They're rumored to be highly profitable right now, and just the growth rate of SpaceX and a couple of the big AI names is staggering. The AI sector is up this year 196 or 169%, and SpaceX has continued to execute. So I think what you're seeing is people are playing the long game in the private market. They're saying if companies are growing at this rate over the course of a decade, then I want to get in when they're hitting their billion-dollar valuations, not when they're hitting their $800 billion valuations.
All right. SpaceX looking at an IPO. When we look at some of the other private market companies, you actually came out with your private Mag 7. Are we expecting to see more IPOs out of this name, or is there enough money in the private market to keep them private?
Well, so it's kind of a tale of two worlds. I think there's plenty of money out there. The money capital that was raised this year alone is staggering, particularly in the AI space. But you're also seeing companies that were going to go public in 2025 had delays. So right now, I think there's something like 16 IPOs already considered for 2026, and some of them were going to come out in 2025. And I think it slowed down here towards the end of the year.
You and I were talking actually on the phone yesterday, and you talked about just there's a small number of names really dominating kind of the value in the private markets, kind of similar to the public markets when we're looking at the Mag 7. As we look at the private markets, investors continue to invest there. Do you see them broadening out their bets like we're seeing in the public markets, or are they going to stick to those AI-focused names, which you call the private Mag 7?
I think it's an interesting question. I think it's both. Both OpenAI and Anthropic are on this race to get public. I think both of those companies have sort of led the AI pack. But one of the interesting stats, if you look in the last 6 years and you track every company, private company that got to be worth $1 billion in the last 6 years, the average return of that company during its private existence is about 65% per year. That's what I'm talking about. That's the long game. People are getting in and saying, you know what, I'm just going to ride the whole private sector. But at the very top, as in the public markets, you've got some massive players with Anthropic, SpaceX, and OpenAI.
Why aren't we seeing bubble concerns there? I know you're saying they're executing, specifically when it comes to SpaceX and when it comes to Anthropic and some of these other names. People see them or at least feel like they're executing. But why aren't we seeing the same bubble concerns?
You are. I think what you're seeing, though, is these numbers continue to put up growth rates that are astonishing for the size that they are. SpaceX's revenue was rumored to be somewhere around 22 to 24 billion next year and around 15 billion this year. To have that kind of growth rate on that base number, that hasn't been seen before. So I think people are trying to find their footing on what the multiple should be. At the same time, these are hard to get names, and so there's a lot of demand in the market for them. But we'll see what happens in 2026.
All right. We're going to be looking at some economic data later today when it comes to employment, also jobs added. Does economic strength impact the private markets? So these investors, obviously, many of them are accredited or institutions. Do they look at the strength of the broader economy, and does that play a part in the valuation of these private companies?
I think it does. I think sentiment broadly does have an impact in the private market, although one of the things that we're watching is when there's dislocation or at least some concern around macroeconomics that affect the public market, you'll see some investors move more aggressively to the private market.
All right. Is there any chance we've seen peak private markets? We're just showing some charts, some incredible growth based on your platform and names like SpaceX, XAI, huge growth rates. I know you say they're also reporting huge growth rates when it comes to revenue and also users and things like that. But at some point, things just don't go up and to the right. Are you concerned? Do you think investors should be concerned that we might have reached the peak in the private markets? I mean, look at these astronomical valuations. SpaceX at $800 billion as we hit on, OpenAI at $500 billion, Anthropic at $350 billion. These are huge valuations.
We are in uncharted territories, and so we're watching it. But some of the broader index data that we show, it's not just in these names. You're seeing the entire private market index, I think, up around 65% this year. So this is not just AI. I think what you're seeing is a very significant group of investors are moving into the private markets. And as everyone knows that's watching, Forge announced an acquisition by Charles Schwab Corporation. A couple of other big companies are getting into this space in terms of investor access themes. So you're going to see a lot more participation in the U.S. private markets in 2026.
All right, we're going to leave it there. Kelly Rodriguez, always good to see you. Thank you very much.
Thank you, Frank.
And for much more on the coming SpaceX IPO and how investors like you can play it, head over to CNBC.com. A lot there. All right, coming up here at Worldwide Exchange, tapping into healthcare's growing popularity with investors. The stock up about 10% this year. Our next guest says is in the sweet spot of that sector. And if you haven't already, you should follow our podcast. If you miss Worldwide Exchange, check us out on Apple, Spotify, or other apps. We'll be right back. Stay with us. All right, welcome back to Worldwide Exchange. As we close on the 6 a.m. hour, a check of a few big stories that we're following this morning. The U.S. says it collected more than $200 billion in tariffs this year, according to new data from Customs and Border Protection. The figure comes as the Supreme Court weighs the legality of those duties. President Trump's filing a $10 billion defamation lawsuit against the BBC. The president is accusing the British broadcaster of producing a false and deceptive depiction of him in a documentary to influence the outcome of last year's presidential election. We're also watching shares of Canada stocks this morning, this after President Trump confirmed he's considering an executive order to loosen regulations on marijuana. Shares of Korea Zinc pulling back in Asia after surging more than 20% yesterday on that $7 billion deal with the U.S. government to build a new smelting plant in Tennessee. The company's largest shareholder group is reportedly pushing back on the plans to create the joint venture. LG Energy Solutions falling more than 5% in Korea after one of its key customers, Ford, announced it's scaling back its EV plans. PayPal says it's applied to become a bank here in the U.S. If approved, the fintech giant will be able to offer savings accounts as well as small business loans. And the NASDAQ is seeking approval to extend trading to 23 hours during the work week. Reuters reports the second largest U.S. exchange is asking the SEC for permission to add an additional trading session to capitalize on demand for U.S. equities. The New York Stock Exchange and the CBOE also recently announcing plans for around-the-clock trading. All right, turning back to the broader markets, investors are waiting to release their fresh jobs data before the open today. Checking futures right now, you can see we're in the red across the board. The Dow looks like it would open just about 50 points lower. For more, let's bring in Carrie Firestone, co-founder of Arias Asset Management, also a CNBC contributor. Carrie, good morning. Good to see you.
Nice to see you, Frank.
All right, Carrie, I actually want to hit on one of those stories we just talked about, the idea of 23-hour-a-day trading during the work week. You're somebody who's traded equities. What do you think about that proposal? What do you think it could mean for the market?
I call it a little exhausting. I think, in fact, people do a lot of trading after hours. I think it would be more, I would say, structured, because there perhaps would not be the type of drops that we see after hours. When there's not much trading, there's a few shares traded and you'll suddenly see big drops, big increases. We might smooth that out if there was sort of more controlled and more organized trading. But, I just don't think it's going to make a big difference at the end of the next day.
All right, well, we're certainly going to talk about it a lot while the SEC considers that. I want to get your word of the day. It's measure. What do you think is going to be measured? Obviously, we have a key economic report coming out before the bell today.
The market feels as if it's accepting that the jobs environment is not very strong, but it's not horribly weak. Inflation has gone up somewhat, but it's not escalating at a rate above 4%. We're seeing that tariffs have had an impact, but not as much as expected in terms of affecting inflation. So the market is having a measured response to what has been going on economically, and it would be great if there would continue through the rest of the year be a measured response in terms of excess. I'd say treatment of any announcement about AI spending, data spending, capital expenditures. Let's just see what happens as we go into 2026 in terms of the type of excesses that we have had around AI this year.
All right, speaking of AI, we were looking at this earlier today. We're looking at CoreWeave down, Oracle down, Broadcom down. Also this morning, Wells Fargo out with a note saying that dips become opportunities right now, saying this is a great time to buy the dip, and that week date is actually the best thing for the markets right now, especially with the Fed's path forward not being that clear. Do you agree with that idea that these are buyable dips, and also this jobs report that you're saying that the markets accept it's going to be a bit weak is actually good because it might help us get some clarity on the Fed?
I don't think there's any chance that we're going to see moves to the extreme on the Fed. If the Fed has lowered rates, maybe they'll lower once again. We know that sometime in 2026 there'll be a new Fed chair who will not raise rates, or that's what our expectation would be. I'm not sure that buying a dip is ever a bad idea. It's just whether the dip is going to continue. These stocks have had such big moves to the upside. If you look at the chip stocks, they're coming back into reality. There is an appropriate, I think, and healthy sense that, up doesn't go on forever. We have to see if they grow into earnings, whether companies can show restraint about their spending. So the dip is fine. Could it continue somewhat further? Yes, it could. Is it a bad idea to start buying stocks if you haven't owned any of these chips, whether it's Broadcom, NVIDIA? I think add a little bit, but just don't put everything into the basket right away.
All right, I want to get to your pick. It's in the healthcare sector. You're definitely not buying the dip. You're buying a stock that has surged big time over the last 6 months. Why is Thermo Fisher a good stock to buy right now?
This is a stock we have owned, we bought more of. It has continued recently to do very well. This was one of the darlings of COVID because of vaccines. Their instruments were used in the development of vaccines and in the processing and manufacture of vaccines. So they had an enormous spike, huge drop, and finally Thermo Fisher is getting its act back together. They had to restructure, refocus, and they're one of the companies that potentially is using AI to identify molecules, to create the types of instruments that use the intelligence and information that we've gathered over decades to design drugs and bring them to market sooner. So it's across the board the type of firm that we use for research, development, clinical impact everywhere. And finally, they're going to see year-over-year gains. So there's more to go for Thermo Fisher. It's been a good stock, but we see healthcare continuing its ascent. Best 3-month record for the group, and this is a name that's one of the best positioned of them all.
Carrie Firestone, your pick for us today, Thermo Fisher. Great to see you. Thank you very much.
Nice to see you, Frank. Thank you.
All right, before we let you go, one more quick look at the futures in the red across the board. That does it for us. Squawk Box starts right now.
Good morning. It is Jobs Tuesday, not Jobs Friday. The government set to release employment data delayed because of the government shutdown. And Ford pulling back on EV investments and taking a multi-billion-dollar charge. And we're getting set for what could be the biggest IPO of the year. It's Tuesday, December 16th, 2025. And Squawk Box begins right now. Good morning and welcome to Squawk Box right here on CNBC. We're live at the NASDAQ market site in Times Square. I'm Andrew Sorkin along with Melissa Lee. Joe and Becky are off today. It's nice to see you again.
Good morning to you.
2 days in a row. U.S. equity futures at this hour, a little bit of red on the screen. Dow off about 56 points. The NASDAQ looking to open down about 80 points. The S&P 500 off about 11.5 points. Treasury yields right now, if you look at the 10-year note, they're at 4.178. The 2 years now at 3.5. We'll talk about the Kevin Warsh situation in just a little bit. Crypto, take a look at where we stand with Bitcoin sitting now just about $87,000. When I think we saw each other yesterday, it was $89,000.
We cracked 86
right.
To the downside overnight in Asia. So interesting levels here for Bitcoin.
I don't know if it's a risk. I don't even know what this is a barometer of us of anymore.
Yeah.
We will discuss.
On today's Squawk Planner, key economic data, most importantly, the latest jobs numbers from the Labor Department. This is a combined report with information on October as well as November, rescheduled because the 6-week government shutdown prevented data from being collected. The report will help economists make sense of the employment picture and help Fed members as they weigh further interest rate moves. We'll get an unemployment reading for November, but not one for October because government workers couldn't survey households during the shutdown. It is the first time the government will not be able to release a monthly unemployment number. The October jobs picture will also face distortion because of government workers who took deferred buyouts as part of White House efforts to shrink the federal workforce.
So what are we supposed to make of it?
Well, I think that it's interesting. You know, we had the Fed meeting last week, and there was some debate as to whether or not they should have postponed the meeting in order to see this piece of data.
But is it so backward looking that it's maybe just...
Well, then you can say they don't need any of this data if it's all backward looking.
Yeah, but this one in particular.
This one in particular is backward looking, and there are a lot of things to look through. There are a lot of exceptions, or it's not clean.
It's not clean data.
Data, but still.
Okay. We got some corporate news for you this morning. Ford saying it's going to take roughly $20 billion in charges related to a pullback on investments in all-electric vehicles and a restructuring of its business priorities. EV sales slumping domestically after the Trump administration put an early end, I should say, to the federal tax credit for car buyers. Ford's plan includes refocusing investments on hybrid cars and canceling a new generation of large all-electric trucks in exchange for smaller, more affordable EVs. One highlight, Ford's all-electric F-150 Lightning pickup truck will transition to an extended range EV that includes an electric powertrain as well as a gas-powered generator. Take a look at what Ford CEO Jim Farley had to say on CNBC about all of this yesterday.
The very high-end EVs, the 50, 70, $80,000 vehicles, they just weren't selling. And we had planned a full EV lineup, but we also have hybrids, and we learned a lot about the market. And we think it was the right time to listen to the customers. We evaluated the market, and we made the call.
Ford also announcing plans to use battery plants in Kentucky and Michigan for a new energy storage business, and we'll get more on that story and so much more from Phil LeBeau a little bit later this hour. But at some point, you know, I interviewed Mary Barr just a couple weeks ago at Tailbook, and here we have Jim Farley saying a very similar thing. I mean, they'd already talked about charges and things. So when something like this happens, do you say to yourself, what was the mistake? Was Well, was the mistake in misjudging the consumer demand? Was the mistake in misjudging the politics of and policy that was going to go into the subsidies for these cars? Was the mistake in misjudging the investment in infrastructure that never happened? And if a board and a management team is responsible for these kind of losses and these kind of big long-term investments, how do you judge it or misjudge it?
I mean, I think it was a combination of all these things. I think when you take a free market and you distort it in some way with policy changes that help create a new market, you run that risk. Either the market grows to meet that or it doesn't. And maybe in this case, it didn't. And there was too much investment being put in. There's too much assumption that the investment would be put in terms of the infrastructure, the charging side of things.
Right.
And that didn't come.
Well, the flip side of this, by the way, is putting aside any of the climate issues. There's an argument to be made that without the subsidy investment that we are no longer making in our automobile industry and the tariff program that we are now implementing, that from a competitive set, you're going to go to Asia, you're going to go to Europe, you're going to go to other parts of the world, and the kind of cars that you're going to be able to get there are going to be materially better for materially less, and we could ultimately just be completely and utterly left behind.
Except for Tesla. Although, I mean, I think that the question here is, are we effectively ceding the EV industry to other players around the world?
Well, I think but then the question is, are we ceding the entire automobile industry? If you ultimately believe the automobile industry is going to be EVs, have you just decided that we are just not in that business anymore?
Except that we have Tesla still. We being the United States of America.
Sure.
So, which is a viable, profitable player, and the players in Asia are not profitable and do still survive on subsidies within those markets.
Right.
So, I mean, it's no, BYD for all the cars it sells, it's not making money on these cars.
Right, but ultimately, if they can get to a point of escape velocity,
sure,
which by the way Tesla did get to escape velocity,
right. That's true.
Then you actually run yourself into a real problem.
Right. But we can't forget Tesla being a major player, a dominant player in the EV market, period, and being a profitable player.
Yeah, but it's still just I'm not saying it's a small player, but it's a small, in the United States, it's on a relative basis to what the rest of the industry looks like. And then the question is, what happens to the rest of the industry? If there is no competition, then what? That's the other piece. The only competition is going to come from combustion engine companies.
Well, it's not that they're not going to make any EVs. They're just going to make different EVs, smaller EVs, more affordable EVs. Same thing with GM. GM, as you know, took $1.6 billion charge on its EV business, but they still make EVs. So it's just they're just sort of right-sizing the EV business to what the market actually is without the subsidies.
Without the subsidies. And I think maybe there's a question about whether we should have done that or not. That's
right.
What I'm asking.
Are you changing the marketplace by with these policies?
Well, look, we changed the marketplace the first time with these policies, but the rest of the world was also changing the policies. And right, I mean, so life is relative.
Yeah, absolutely. Yeah. Now let's get to the latest on the race to be the next Fed chair. This morning, prediction market Kalshi puts former Fed Governor Kevin Warsh in the lead, with bettors seeing a 48% chance he'll be nominated by President Trump. Previous frontrunner Kevin Hassett, who leads the National Economic Council, is now in second place. Sources tell CNBC Hassett's candidacy has seen pushback by high-level people close to President Trump. Some are worried the bond market could see upheaval for a time if investors see Hassett as too close to the president. Hassett will appear on CNBC at 9 a.m. Eastern Time on Squawk on the Street. You will not want to miss that interview.
You will not. You will not want to miss that interview. I will not want to miss that interview.
I'm going to watch it.
Meantime, the NASDAQ looking to expand trading hours. According to an SEC filing, the exchange wants investors to be able to trade 23 hours a day, 5 days a week. That will include a new night session from 9 p.m. to 4 a.m. Eastern Time. In addition, the exchange's current pre-market, regular, and post-market hours. The New York Stock Exchange and CBOE Global Markets also recently announced plans to move to round-the-clock stock trading. I don't know where you land on that as an idea.
You don't have to cover those sessions. I'm okay with it. But I mean, in theory, it could in fact increase the volatility because there will be more swings at other times of day.
So is that a feature or a bug to be able to trade 24 hours a day?
And I mean, Robinhood offers trading. You know, you can sell U.S. stocks around
at all times.
So on some level, it exists, but this is mainly for overseas players.
Right.
President Trump signed an executive order classifying fentanyl as a weapon of mass destruction that gives the government legal justification in its efforts to combat illegal trafficking of the synthetic drug. The order cites the lethality of the drug and notes criminal groups use the sale of fentanyl to fund activities that undermine U.S. national security.
And prosecutors in California are set to decide whether and how to charge the son of filmmaker Rob Reiner. After he was arrested and booked on suspicion of murder, Reiner and his wife, Michelle Singer Reiner, were found dead in their Los Angeles home over the weekend. Nick Reiner is being held in jail without bail. Sources telling NBC News the 32-year-old had been disruptive at a holiday party on Saturday with his parents hours before they were found dead. President Trump drawing criticism after he posted on social media about the deaths of Rob and Michelle Reiner, making claims that their deaths were related to Reiner's political activism. Police have not provided information about a motive. It's a terrible, I can't even fathom what happened.
If this in fact happened, because we don't know yet, imagine the last images in your head, your child doing that to you, and you're thinking, what is happening?
It's just, it's heartbreaking. And separately, though it's just a pile-on at this point because everybody's already said it, it's disgraceful what the president said yesterday.
It doesn't matter what your politics are.
It's one of those moments that's beyond the pale. No matter what side of it you're on. I hope that people recognize that and people who are around him recognize that.
Coming up, a deeper look at the U.S. jobs picture ahead of today's employment report. But first, as we head to break, take a look at shares of Tesla pulling back a bit this morning after hitting a record high in yesterday's session. It comes after Elon Musk said the company is testing a limited robo-taxi service in Austin, Texas. Without humans on board, the company had already been testing the service in Austin with safety drivers in the car. Squawk Box will be right back.
Welcome back to Squawk Box. Coinbase officially moving its legal incorporation from Delaware to Texas. That's according to an SEC filing published just literally moments ago. The company had announced plans to make that move last month, citing recent unpredictable outcomes in the Delaware Chancery Court. Now, shareholders approved the move. The filing says that reincorporation does not change the business or management, but a trend that we are seeing in light of ultimately where Elon Musk went, and he did this first.
Let's take a look at futures and how we are setting up ahead of a very big Jobs Tuesday. Yes, they said Jobs Tuesday. We're getting November as well as October reports delayed because of the government shutdown. We're looking at some losses across the board, at least for now. The S&P looking to be lower by 12.5. NASDAQ to be down by about 80. Dow to be down by about 51 points. Joining us now, Jordan Jackson, JP Morgan Asset Management Global Market Strategist. Jordan, great to have you with us. How important, if at all, is this jobs report, given we've already had a Fed meeting and we're already looking ahead to 2026?
I think it matters, but it doesn't move the needle all that much. I think the reality is the markets expect these numbers to be a little bit hazy, cloudy, right? Not clear data. But I think it's going to continue to confirm the story that we already sort of know, right? This is a labor market that is cooling, that's slowing, but one that's not breaking and collapsing to the point where the Fed perhaps needs to overreact here. And I think the Fed feels like they're in a comfortable position for the foreseeable future.
Let's talk about what's been going on in the past few weeks in terms of one of the biggest trades in the market, and that is AI. And it does seem like there's some skepticism creeping into this trade. We saw it in the Broadcom report, which is largely, in line. The backlogs were up, but still there was some questions about it. There are questions certainly about Oracle when you take a look at how the CDS has traded. How do you view the skepticism entering this trade and marry that to your outlook for markets in 2026?
Yeah, I think it's one of the risks to markets for next year. I think the AI theme has gone from, it will shift from being just this indiscriminate rally where everyone benefits to this period of deciphering the winners and the losers. And I think you will start to see more differentiation. But again, given the size of these names of the index, depending on the moves that some of these companies make, that could challenge the index more broadly to move higher over the course of next year. But I don't think it changed the broader narrative that we're still generally bullish, optimistic on the markets for next year after 3 consecutive years of double-digit returns. Does next year look like another 20% return on the market? Maybe not, but perhaps somewhere in the high single, low double-digit.
Do you feel like something changed though? Because when Meta increased its CapEx forecast and said we're going to increase it significantly, the stock didn't react well. Whereas in the past, whenever these guys would say we're going to spend more, it was a positive thing. It seems like people are really questioning the spend, what we get for the spend, and whether that growth is going to continue at the same rate. I'm not saying that it's a growth rate that's going to collapse or anything to that degree, but even a slowing of an exponential growth rate is a disappointment for the markets.
No, I agree. I think there is always, it's appropriate to have some degree of skepticism, but I think if we're looking at this from a 3, 4, 5 year window, I think the bigger risk is to underinvest, not necessarily overinvest. So I think some of these numbers, it's being funded by cash flow. Obviously, we're seeing a little bit of debt, which is a bit of concern.
How about Meta with
from a company-specific issuer perspective, these are pennies on the dollar, right? So companies still flush with cash. Now, my bigger concern is the impact that this could have on credit markets, right? Because you're seeing a lot of supply coming to the market, and that could cause some indigestion for spreads on a go-forward basis.
But when you look at this sort of prediction for next year, how concentrated is the success of the index going to be? Meaning, is it going to broaden out in a material way?
We think so. Look, the reality is it's hard to go from a $5 trillion company to a $10 trillion company. Maybe a little bit easier if you're a $1 billion company going a little bit multiples. But what I would say is we expect to see some sort of cyclical value areas of the market potentially providing some durability for a market rally over the course of next year. So we like financials, we like industrials, we like materials. I would say energy is a little bit of a wild card, particularly with our outlook for oil prices.
You're stating the sort of scorecard that stands right now, though. Financials, industrials, materials, they've all been doing well this year so far. Close to records, basically. Energy, sort of wobbly, just the way they are right now. So is it just the same playbook as this year for next year?
I think it's a similar one because it's a backdrop where the yield curve continues to steepen out. You know, we've gone from a deeply negatively sloped curve to a positively sloped one, and I think we're going to see the curve continue to steepen out over the course of next year. And that's generally been an environment that's been pretty supportive for cyclical, value-oriented sectors. I also think the implications of the big, beautiful bill, being able to expense domestic R&D, I think we're going to get a little bit more of a more traditional CapEx spending on equipment and structures, alongside, obviously, continued very strong numbers on the AI spending side.
We're going to leave it there. Jordan, great to see you. Thank you so much for coming in. Jordan Jackson.
Coming up, investors getting set for what could be the biggest IPO of the year. We'll bring you details about that when we come back right here on Spotlights. Welcome back to Squawk. We are getting ready for a big public market debut, the IPO of medical supply company Medline, expected to price tonight. It shares expected to price at the high end of the market range. It would range close to $6 billion and become the year's biggest IPO if it happens. The company backed by private equity managers including Blackstone, Carlyle, and Hellman & Friedman. So another thing to watch and another perhaps bullish sign for the markets if it gets done this way.
Coming up, Ford hitting the brakes on its current EV strategy. It is taking a massive write-down, $19.5 billion. Bill will break down the company's latest moves. And as we head to break, take a look at yesterday's S&P 500 winners and losers. Good morning, welcome back to Squawk Box Live from the Nasdaq Market Site in Times Square. Let's take a check on the futures ahead of today's jobs numbers. We got the Dow up poised to open higher by 84 points. S&P looking at 13. As for the Treasury market, we're holding pretty steady on the yields front. The 10-year yield sitting at 4.18%. The 2-year Treasury yield at 3.5%.
Meantime, we were discussing this earlier. Ford re-examining its EV strategy in a big way. The company's going to take a multi-billion-dollar charge. Phil LeBeau joins us with the latest. We were batting it around. I want to hear your take on where things are right now, and then we'll get into it all.
Well, where they are is the company is admitting that its previous strategy, it wasn't working. Was it a complete failure? No, but it was definitely not succeeding, nowhere close to profitable. When you look at their Model E business, I mean, we would routinely report when they had their quarterly and monthly sales, they were losing $40,000 per EV produced in the U.S. And that's why Ford is going to be taking a $19.5 billion charge, with most of that coming in 25, but also spread out into 26 and 27. That's all to write down their EV assets, impairment charges there, shift their production in North America. Some plants that were previously expected to produce a large all-electric pickup truck, they're going to be shifting over, maybe making an E-Rev, maybe also making a hybrid, and then there's going to be batteries for energy storage. So here's the new game plan from Ford. It's not giving up on EVs altogether. In the future, they will be smaller models. They've got what they call a UEV, an unboxed EV, new in development that's going to come out by the end of 27. That's going to be a prototype of what they're expecting. Lower price points, smaller EVs. They're going to be adding extended range EVs. The Lightning, for example, will not be a pure electric pickup truck. It'll be an extended range EV, and they're going to expand into hybrid models. Here's Jim Farley last night talking to us about why they made this decision.
Hybrid months is 30% of our sales. Imagine having a Ford where a whole lineup has hybrids and E-Revs, and then we'll have this very affordable EV platform, UEV, at very affordable prices of 30 grand. We think that's the right place to pivot. That's where Americans are today with their powertrains and what they want to buy.
He's 100% correct on that. And Ford realized this, Farley and his team realized this a while ago, that hybrids, that was the sweet spot of the market. And Ford has pivoted successfully into developing more hybrids. Their sales are up 19.4% this year. By the way, the company is raising its 2025 EBIT guide to $7 billion. Previously, it was between $6 and $6.5 billion. Bottom line is this, guys. It's clear. The market for electric vehicles is just not going to develop as quickly as many originally thought, let's say 5 years ago. Ford has got to make the pivot, and it's paying a hefty price to do this, but they're making the pivot towards more hybrids. And if you are going to have EVs, they're going to either be smaller or they're going to be extended range EVs, which, as you guys understand, has become a hot area for development within the auto industry, especially when it comes to pickup trucks. That's where you have a generator essentially on board. You fuel that up. That then powers the motors, electric motors for the vehicle, and you can get a range of 600-700 miles for some vehicles, or that's the expectation that's out there. And as a result, Ford believes that's where they will go when it comes to electric pickup trucks.
So, Phil, can you just weigh in on this sort of larger issue that, I don't know if you were listening to Melissa and I at the top of the broadcast when we were talking about just competitively where the U.S. ultimately is going to be 5 years out from now? Are we going to look back and say to ourselves that we made a tragic error in terms of not continuing to subsidize EVs, that our EV market has shrunk so much that we're not competitive with the rest of the world? Are we going to find out that the rest of the world's going to have to stop subsidizing their vehicles and there really isn't the market for this that we think? What do you think this ultimately looks like?
It all depends on what happens with China. Look, China has, for lack of a better term, bastardized the entire eco chain when it comes to electric vehicles and the global supply chain. The subsidies there and the flooding of the markets around the world has created a situation where even if you have the right approach and you're a legacy automaker, you're dealing with a situation where this country, because of what it has with the supply chain, has just flooded the world. They're undercutting people everywhere. And you're going to see this in Europe as they modify the expectations of what's to come when it is with e-vehicle emissions. They were going to be all electric requirements by 2035. They're probably going to modify that, make it either 2040 or make it much lower standards so that you'll see more gas-powered vehicles built in Europe. They have to do that. The European automakers cannot compete with China continually flooding that market. So to answer your question, Andrew, I don't know where we're going to be in 5 years. And it's not just a United States issue. It's a global issue because China has decided, come hell or high water, we are going to continue making electric vehicles. And they're going to be subsidized. They're going to come in at lower price points. And if you don't like it, fine. We'll sell them in Mexico. We'll sell them in South America. We'll sell them in the Middle East. Go to Israel. China EVs everywhere. And I know people will sit there and say, it's a small market. Does Israel really matter? Well, take a little Israel here. Take a South Africa. Take Latin America. Take Chile. Take Argentina. You start adding that all up, and you've got them dominating the world. That's what's going to determine what happens in 5 years.
So let me just ask a different question, which is to the extent that you think about the managements of these companies, whether it's Jim or Mary or any of the big American car makers who clearly went down this road of EVs.
Correct.
I think in part because there were subsidies and an expectation there was going to be infrastructure built and a consumer demand and all of the same things. And you say to yourself, if there was a mistake made in all this, because by default there was a mistake made, obviously not predicting the future, Which piece of the future do you think was the mistake in not appreciating the politics of this, in not appreciating the genuine consumer or lack of consumer demand? What's your thought?
It was the lack of appreciation, at least initially, that not everybody would want to go straight from an internal combustion engine vehicle to an electric vehicle. There was a lack of appreciation that hybrids would grow to the degree that they have. Toyota, which dominates the hybrid market, a lot of people sat there and said, well, you're dragging your heels, Toyota. The world is moving ahead with EVs, and what are you doing? You're selling RAV4s as a hybrid model? You should be out there pushing all electric models. Well, look who's laughing now. It has worked out well for Toyota. And some will sit there and say it's because Toyota had made the wrong bets when it came to fuel cell vehicles, etc. Doesn't matter. The overall lack of appreciation for the inability of people to go straight from ICE to EVs, I think that's the biggest mistake that was out there among the executives within the auto industry.
And then finally, I know we're going to have to go, but to Melissa's point, the Tesla piece of this, which is, here we are being very critical of a GM or a Ford or a Chrysler. You can go down this road to the same degree.
Yeah.
Clearly, Tesla has managed to make this work. And so the question is, do they just gain market share in this space as a result of all of this? Or does this flatten out? What does that look like to you?
It depends on who comes out with the lower priced models that are most effective. And Tesla has rolled out some lower priced Model 3s and Model Ys, and to the extent that they're successful is debatable, but that's the market right now. If you can come out with a $40,000 EV, a true $40,000, don't give me this song and dance that it's 40 and you're selling it for 55, a true $40,000 EV, that's where you will make hay in the auto industry over the next 5 years.
Phil LeBeau, thanks for your smart thoughts this morning. Always appreciate it. Nice to see you. When we come back, a lot more on Squawk. Help Wanted. We're going to take a look at areas of the labor market that's hiring right now as we kick off Jobs Tuesday. Yes, you heard that right. Jobs Tuesday. It isn't Jobs Friday. We'll explain in a little bit. And a reminder, get the best of Squawk Box in your daily podcast. You can follow Squawk Pod on your favorite podcast app. You can listen anytime. We'll come right back. Welcome back to Squawk Box. So we've got a highly anticipated jobs report coming in just a little less than 2 hours. Joining ahead of that number is Laura Ulrich, Economic Research Director at Indeed. Good morning to you. We're going to talk about what you're seeing in the jobs market, but before we get to this number a little bit later, is there anything you think we could possibly even take away from this number, or do you think that it's so backward looking and is going to have so many sort of different, one-time items in it that we almost have to just look away?
Thanks for having me this morning. I think this data will always need an asterisk by it because methodology is different, and to your point, it's going to be quite different than the normal jobs report we expect. However, I'll take whatever data we can get right now, and I'm really looking forward to seeing the data that we do receive from October and November.
And what's your expectation given what you know about the market through all the data that you look at?
Yeah, absolutely. Based on the data we have at Indeed and other things I'm reading, I'm expecting relatively sluggish reports for October and November. I would be surprised if the number, if we hit it out of the ballpark in those 2 months. But in our Indeed data, we're seeing kind of a continued cooling, but it's leveled off some.
In terms of wages, I don't know what kind of we're going to get, but is your sense that we keep having this conversation about affordability and where the economy really is right now. Given the data that you see, was there any new look at that?
Yeah, I think, in many sectors right now, this is an employer's market. It's a good time for companies if they want to hire. There's a lot of talent sitting out on the sidelines in a lot of sectors right now. And so in those markets, we wouldn't expect to see strong wage growth, right? When there's a excess labor supply, but there are still some fields, healthcare, some others where wage growth is likely still pretty competitive. But I wouldn't expect to see it pick up as long as the labor market stays as sluggish as it has been.
If it's as sluggish as if it ends up being as sluggish as you think it is there any argument that AI is having an impact on all this?
I think AI is having an impact in certain sectors, specifically in tech, and also some other sectors that we believe are heavily impacted, like marketing and accounting. But honestly, at this point, we think that there might be more of an impact from the anticipation of what AI can do than what AI is actually doing right now, if that makes sense, right? Companies are investing very heavily in AI. They've shifted.
And you just think they're holding off on, and therefore holding off on hiring, or just moving their spending to AI as a result? I mean, and then the flip side of that question is, if you don't think it's actually creating the productivity gains that they're expecting, could you ever imagine a moment where they say, this isn't actually working the way we want, and we actually need more people?
Yeah, I mean, you hear about that some, right? You have heard some companies come out. There have been some studies that show that some of the productivity gains are not where they need to be for the investment level that's occurring yet. I think the timing here is really important. AI is going to transform the labor force, but the moment in which it actually does that and actually has the capacity to take over jobs people are doing may not time perfectly with that investment, right? And so I think that's something that all economists are pretty interested in watching in 2026.
Okay, we're going to leave it there. Laura, thank you. Appreciate it.
Thanks.
Coming up, PayPal making a bid to expand its business to traditional banking. We've got the details on that next. But first, the AccuWeather forecast with meteorologist Bernie Rayno.
One more cold day across the Northeast today. Your AccuWeather exclusive forecast. Some sunshine, New York City, Washington, D.C. Less wind. Not as cold in the afternoon in Chicago, in Nashville. 75 degrees in Miami with sunshine. Bad news in the Northwest. More rain and flooding. Your AccuWeather travel forecast. No delays across the country, except perhaps in the Northwest. To help you make the best decisions and be more in the know, make sure to download the AccuWeather app today.
PayPal applying to form a bank that can offer small business loans and savings accounts. The company says the FDIC will review its application proposing the establishment of PayPal Bank. Bank charter applications have jumped since President Trump took office. Fintech companies are working to expand businesses and capitalize on a friendlier regulatory environment in D.C. PayPal shares are up as much as 1.5% in the after-hours session. Right now, they're higher by just under 1%. Overall, they're down close to 30% this year.
Wow. Meantime, President Trump suing the BBC now for up to $10 billion. The president accusing the British broadcaster of defaming him by cutting together parts of his speech on January 6, 2021 to make it look like he directed supporters to storm the U.S. Capitol. The clips omitted a section where Trump called for a peaceful protest. The BBC has apologized and admitted to an error in judgment over the edits, but has said there is no legal basis to sue. Meantime, when we come back, the biggest stocks to watch in the tech sector in 2026 and why, that's next, right here on Spark.
next guest is here with 2026 calls on tech stocks, including Google, which is up more than 60% year to date. Joining us now, Mark Mahaney, Evercore Senior Managing Director of Internet Research. Mark, great to see you in person. We mentioned the Google 60%. Most of that move was in the second half of the year, so it's sort of an interesting dynamic here where it's no longer a top pick because of the recent run, but you still think it is firmly in the hold, in the buy camp, I should say.
It's a quality compounder, so we've had a stock that went from 15 times earnings to almost 30 times earnings in a 6-month period. You rarely ever see that. I think the real opportunity was it was so oversold. I'm not sure it's overbought. I don't think it is. I think it kind of holds its multiple. It's kind of at the high end of the Mag 7 in terms of the multiples. But I think it can hold it, and now it's a compounder, which means I think they can grow 20% a year, so the stock's got that sort of upside. It's not dramatic, but it's a name that you want to stick with because they've kind of proven everything they sort of needed to prove, which is that they're successful up and down the tech stack. What else could get much better about Google? I think that there's a chance for a re-acceleration in revenue at search, at YouTube. Waymo's still building out, and cloud's going to be north of 40%. I think that kind of growth next year. So I just like the fundamental setup in it. If you're a long-term investor, you stick with the Google.
How do you see Gemini 3? I mean, part of the upswing in Google shares is the perception that Gemini 3 is doing so much better. How does that play out into 2026 in terms of its trajectory? What do you see in terms of uptake and other monetization?
I think actually that's one of the risks to Google because this is going to go back and forth. And, the ChatGPT 5.2 came out. I'm not sure it overwhelmed anybody, but, the models get better and better. And so the idea that Gemini is going to be the leader of the large language model board for the next year is probably unlikely. There's going to be a lot of competition in the space, which is great for all of us. In the meantime, I think you're going to get a new ad model at some point, or you're just going to get an ad model coming out of ChatGPT. So there's going to be real competition coming after search dollars. We haven't seen it yet, but it's coming. So you got like 1 or 2 pending negative catalysts. I don't think it takes the stock down a lot, and if it did, it'd be a great opportunity to leg into Google stock.
Do you think, though, on the large language model front, that it's about the model itself at this point, or I actually think the models are almost so good that there's an argument made it's about who productizes the models best and fastest. Meaning, and I've always thought that Google should be the winner of this by a long shot, given the proliferation of Gmail around the world and calendars and by the way, Android phones. That if they could productize things that actually really texted you back and really gave you an email to return and really saw where you were going next and was able to sort of think through all the different permutations. But for whatever reason, they haven't gotten to that place. And then the question is, can OpenAI, which doesn't necessarily have all that data, but maybe through APIs into all these other outlets or through an Outlook, Microsoft can do all of those things?
Well, I think what you said, the first part is extremely important. If Google got the right model, if it got the leading model, it had more monetization opportunities than anybody else because it could roll its large language model. It could roll Gemini 3, which they did very quickly, into YouTube, into Gmail, into Google Works, into the search, into YouTube, into across all of their assets. So could they monetize it? Absolutely they could. ChatGPT is not going to be able to monetize as well unless they build out those applications that have got 1 billion users here, 1 billion users there. That was always Google's advantage. The question is when would they really turn on the product? And it helps that you have a lot of great competition from ChatGPT for them to do it.
But I think the question long term is, are people going to go back and forth between a ChatGPT and a Gemini or some other service? Or do you think that you get sort of, because it's built into the product, that people then stay there? Or you could argue a flip side, which is the sort of persistent memory argument, which is right now ChatGPT has almost better persistent memory, knows you better, arguably, because it knows you better in terms of like maybe how you write or think, but it doesn't know all the data about you unless it's porting in through APIs into other systems.
I would hope that people would kind of use both and maybe other large language models. I don't think there are going to be that many used in the future. I think we'll get some sort of consolidation here. 2 or 3, maybe 4 max large language models.
Does that mean that the whole business is commoditized? And therefore, then, is there the value prop? If you say to yourself, is ChatGPT or OpenAI worth $1 trillion? Is that possible?
I guess if I felt like there were going to be 20 large language models, that would scream commoditization. If there's only going to be 3 or 4, that probably doesn't mean that. There'll be a couple. It's just that those large companies, the best models, are going to have a data personalization advantage at some point. And consumers are only going to reach out, and businesses are only going to reach out and use so many large language models. So I think there's going to be there's an actual consolidation.
All this then?
I don't know. That's one of the biggest questions. I don't know where Apple is. Apparently, the next version of Siri is going to have intelligence in it, and maybe they'll. I don't know. They're sort of the big question mark. My guess is that they're going to be so late to this. They are so late to it that it's going to be a structural disadvantage for them. But I don't cover Apple.
You've been in this industry for a long time, so you saw how the original search engine wars played out, where we had a field of a lot of search engines, and people were going, you know, they were going to DuckDuckGo and Ask Jeeves and Yahoo and this and that, and then it consolidated. Is that the template for this? Are we eventually going to go down to one leading player, a few other, you know, sizable players, maybe two other sizable players, and that's it? I mean, is there just going to be just a shakeout?
I think so. I think that's the consolidation. I think that's probable. I think there's just some natural human laws that lead us just to, you know, pick a few leaders. I hope it isn't as monopolized is too strong of a word, but that's pretty much what happened in search. I hope it isn't as monopolized as what we had in search. I don't think that's healthy for the ecosystem. And so far, I don't think it's shaking out that way. I think we're going to have a much more competitive environment with large language models than we had in search.
But the fact that Google has such a lead in search now, and you know that it did have an uptick most recently in terms of market share for search in general, that makes it the most logical dominant LLM, or no?
It certainly gives them a huge advantage. Yes. And it also means that, again, with all of those apps they have, they can monetize this better than anybody else can. But I think we're just starting to see ChatGPT. The gloves haven't come off yet in terms of the monetization models, and we're going to get an ad model out of ChatGPT. I know with Code Red, they're pushing it out. I don't think they're going to push it out that far. They need to generate the revenue, and I think they will, and I think they'll be able to. They're generating very high-quality leads, reasonably high-quality leads for the companies that buy all that search advertising. They're getting good leads from ChatGPT. It's just a matter of when ChatGPT wants to turn on the revenue.
Mark, great to see you. Thank you.
Good to see you,
Mark Mahaney.
Okay. It is almost 7 a.m. on the East Coast. You're watching Squawk Box right here on CNBC. I'm Andrew Ross Sorkin. Along with Melissa Lee, Joe and Becky are off today. We've got a whole number of big stories, including this. It's Jobs Tuesday. That may come as a surprise. It is not Jobs Friday. We're going to get the latest jobs numbers from the Labor Department, though. This is a combined report with information on October and November, rescheduled because the 6-week government shutdown prevented data from being collected, so it's going to be super backward-looking. There's going to be all sorts of one-time events in here that we're going to have to look through and figure out. We're going to have those numbers and instant reaction, but it could very well move the markets this morning at 8:30 a.m. Eastern Time. Meantime, Ford saying it's going to take roughly $20 billion in charges related to a pullback on investments in all-electric vehicles and a restructuring of its business priorities. Ford's plans include refocusing investments on hybrid cars, also canceling a new generation of large all-electric trucks in exchange for smaller, more affordable EVs. And Coinbase has officially moved its legal incorporation from Delaware to Texas, following in Elon Musk's tracks. According to an SEC filing, the company has now announced plans to make that move last month, setting unpredictable outcomes in the Delaware Chancery Court.
Let us check on the features ahead of those jobs numbers this morning. We gained a little bit of a ground gift. The virtually unchanged at the open, down by about 4 points. NASDAQ looking to open by 37 points lower. Treasury market fairly stable all morning, actually since yesterday for that matter. 10-year treasuries 4.18%, 2-year yield at 3.5%. As for the energy markets, all eyes are on Brent, which cracked $60 a barrel. We're down to 59.65 here, down 1.5%. WTI also down 1.5%. And take a look at cryptocurrencies. We've been watching this very closely. Crypto, BTC in particular, trading at the lower end of its recent trading range, but above the $86,000 mark. A 1.7% gain right now. Let's get to Dom Chu with a look at this morning's pre-market movers. Hey, Dom.
Hey, good morning, Melissa. Good morning, Andrew. So let's start with Zillow, continuing its slide this morning after reports that Google is testing out real estate listings in its search function. The listings appear to be powered by real estate data company House Canary and appear to also be available only right now in select markets on mobile devices. Now, that led to the stock shedding about 8.5% yesterday. That was its worst drop since February. Those Zillow shares are down another near 3% this morning in the pre-market trade. Also watching Gap shares right now in the green this morning, up by about 2.25% after they were upgraded to overweight from equal weight over at Wells Fargo. Now, Wells says that Gap could be a major beneficiary should the Supreme Court rule that some of President Trump's tariffs are unconstitutional. Wells also sees continued strong performance from the core Gap and Old Navy brands going into 2026. So that's the owns behind the bid, at least in Gap shares. And then Estee Lauder shares are on the rise after it was named to Bank of America's US 1 list. That's kind of like its top picks, its collection of top-rated buy picks. Estee Lauder shares up nearly 2%. They also, by the way, increased their target price on the stock to $130 from $120, which is a new street high according to FactSet. BofA says Estee Lauder is well positioned to benefit from a recovery in the beauty market driven by China and travel retail, two segments that have weighed on those shares in recent years. So keep an eye on EL. Now, for more on those and other top analyst calls of the day, subscribers can head over to cnbc.com/pro, where you can get all the detail and context around those notable analyst calls each day. Melissa, Andrew, I'll send things back over to you guys.
All right, Dom, thanks. Dom Chu. We have news just out from Kraft Heinz. The company has named former Kellogg CEO, Kellanova CEO, Steve Kaling as his new CEO. He will take over from Carlos Abrams-Rivera, who's stepping down on January 1st. Kaling will also join the Kraft Heinz board of directors and serve as CEO of the Global Taste Elevation Company, following the company's planned separation to two independent companies. He will be on Walk on the Street today, first on CNBC in the 10 o'clock hour. All right, let's get a check-in on the retail sector as we are now just 9 days away from Christmas. Joining us now, Oliver Chen, TD Cowen's senior retail analyst. Oliver, great to have you with us. Not much time for last-minute shoppers out there. Who seems to be doing the best so far?
We're excited about Walmart. Walmart offers great value, but also a high-end customer too. Also the AI story at Walmart in terms of lots of first-party data and using that for both supply chain as well as Sparky. We also like other ideas like Richemont and Cartier, and what we're seeing with the consumer is bifurcation. Strength at the high end, but also pressure at the middle and low. We upgraded Ulta. Beauty's a major topic and a highly giftable item too. And a lot of what's happening is returns to classics, meaning preppy with a twist. So overall, the consumer is stronger and better than feared. And our holiday forecast, we raised slightly to up 4 to 5.
Some might say, many will say that Walmart is expensive. Target, though, recently it's been on a 9-day winning streak, which doesn't put much of a dent in terms of the losses that is seen relative, in particular, to Walmart. But is that moat in terms of the spend that Walmart has committed to over years and making it more of an AI-forward retailer, is that too great for Target to overcome, or could there still be value here in Target? Could there be a turnaround here?
Well, Target's a work in progress, and the things that Walmart did, Target does need to do. It needs to improve the store experience, the supply chain, and as we think about Walmart, there are 3 things. It's digital advertising, it's the marketplace model, and it's AI. And that's a retail playbook which matters for all companies. Scale matters. So Target, we're watching it, work in progress, also bringing Target back, bringing joy back, and working on the merchandise and offering sharp values. So never say never, and better late than never, but we'll have to see, and there's new management there. On the other hand, Walmart is well on its way in building a marketplace and building a supply chain that integrates AI is very challenging. Another idea we like is Costco. Costco at this multiple at 40 times. We think that's a great opportunity too. It's number 2 pick after Walmart for us.
How does a Costco fare in this sort of environment where people are being more choiceful? And it does look like consumers are not necessarily gravitating toward large packages, large volumes of goods.
Well, what's brilliant about Costco is the iconic Kirkland brand. So customers love a great value no matter what, and they're trading into private labels, and it's a zero loyalty environment. Costco also has great chicken and great diamonds. So you're seeing Wagyu beef work in prime cuts, but you're also seeing chicken and ground beef. So you get that whole microcosm, and it has a very slim assortment and a customer who loves it, and a high level of renewal rates at 92%.
Yesterday we had Steve Leisman on explaining the results of the All-America CNBC survey. And shoppers are basically saying that things cost more money, so they're going to spend more, but it's because things cost more. What are we seeing at the retail level in terms of the impact of tariffs still, and the impact of tariffs to come? Because what stood out to me, at least in the Ulta call, was that they said that there's some products that still, they haven't passed through that tariff impact yet.
Well, analytically speaking, for sure, what we see ahead is more costs getting priced to the consumer. So far, the impact to financials and revenues has been around 1% in aggregate, and it's been
to margins,
yes to revenues, and margins have been better in part because inventories have been managed more tightly, better than we expected. So the price increases currently in the marketplace on an aggregate basis have been less bad than feared. But there's a dichotomy on with the consumer. The consumer is fundamentally strong, but sentimentally weak. So keep that in mind.
Say that again.
Fundamentally
strong,
but
sentimentally weak.
Like they don't feel good.
Exactly. And it's even more pronounced at middle and low as we look at our survey. And that's true because of bifurcation. We also see customized moderation, meaning consumers trading up, consumers trading down, consumers trying to be bougie with the budget. So
bougie with the budget.
And
There's a lot of good phrases today.
Is that just like choiceful?
Choiceful. It's another way to put it. It means look. Very simply, to keep it very simple, it's like you're looking for a great deal and you're trying to get the most for your money. And with transparency and AI, you can do that better than ever. So that's what's happening, and retail has to really execute to this however they can, which means offering you great opening price points, or luxury goods offering you more features for the same price, and offering Wagyu beef, prime beef, Cartier diamonds. You have to do both, but this is a world of increasing bifurcation where loyalty programs, first-party data, the power of AI is really segmenting customers too.
Oliver, great to see you. Thank you. Oliver,
Thank you.
TV.
Happy holidays.
Bougie with the budget.
I like that, right?
That's just a nicer way of calling somebody cheap.
Oh, so you're going to embrace it because
I am
calls you
cheap.
cheap a lot, right?
I'm a cheapskate. I'm a
I'm
cheapskate.
bougie with the budget.
I'm bougie with the budget. I'm not, yeah. You can call me cheapskate or bougie with the budget. Love that. Thank you, sir. Coming up, the results of the latest CNBC All-America survey tackling the affordability issue, inflation, the state of the economy. You do not want to miss this. I actually think this is going to be an interesting data release this morning. We're going to have it all for you next, right after this. Welcome back to Squawk Box. President Trump's approval rating remains challenged by the affordability issue. Our senior economics reporter Steve Leisman joins us with the results of the CNBC All America Survey. What are you seeing?
Yeah, yesterday we did what consumers were saying about it. Now this is the political side of it. President Trump's approval on the critical issue of inflation and the cost of living fell to a new low in the CNBC All America Economic Survey, with the president continuing to lose support, not just from the broader American public, but from some of his own key constituencies as well. The survey of 1,000 people nationwide found that over the course of the year, approval of the president's handling on inflation has dropped from 37% to 31%. Disapproval risen to 60% from 266% from 60%. The result, minus 23 net approval. President is now minus 35, with a further 8-point decline in just the last quarter. You can see that widening gap right there. Among the big changes from Trump supporters on inflation, Republican voters plus 58 on inflation are now plus 32. Blue collar was split, blue collar workers, now they're minus 30 on the president on inflation. And in rural counties, they were plus 13 in April, now they're minus 14, for a big switch there. For the first time since April, a majority of Republicans also rating the economy as just, fair, or poor. Democrats at 93%, independents at 86%, Republicans now 53%. That's above the majority level there. The good news for the president, the decline on inflation views has not hurt or even helped his overall economic approval ratings, though both remain underwater, especially economic approval at minus 11 on net. It's a feature of this second term here that his economic approval is below his overall approval. And that one reason why his numbers are staying up there is because Republicans remain solidly behind the president on the economy and on issues of immigration and tariffs, despite, you can see, their overall negative views by the public. 89% Republican approval on immigration versus 46% for the broader public, 81% on tariffs versus 41%. Still, the numbers are not trending well for the president and Republicans for the midterms. The public now prefers the democratically controlled Congress by 50 to 46% majority. It's a slim margin, but the biggest one we've seen since 2020. And I guess I'd say that politically, this is a big issue, but economically, that's where it becomes really interesting, because most economists and politicians are saying, oh, the tariff inflation issue is not that big a deal. What we're hearing from consumers and the way it's affecting political views suggests that price increases are a bigger deal now than they've been.
Well, particularly if you piece together what you brought us yesterday, with what we saw today, and that is people are spending more, and they say it's because we are paying more for the same amount of goods.
And we're not hearing it necessarily from the retail analysts that there's a problem out there. Remember, the Biden administration underestimated the effects of inflation on the political situation. That was a mistake they made. Not I'm sure what they could have done about it, other than not spend as much as they.
So if you were the president, what would you do right now?
I guess I wouldn't be saying that affordability is a Democratic hoax. And I'm interested because it doesn't seem like that political position is playing very well. I wouldn't be saying that.
But is there something you think that they could do about it?
They could back off tariffs. They could back off tariffs in a hurry, and you would probably see interest rates decline, and you'd almost certainly see inflation decline. What's interesting here, the mistake I think some people might be making is the overall inflation rate is kind of steady and didn't go up as much, 3%. But there is inflation in goods, and that's where it is. And our survey suggests that people are seeing it at the checkout counter, because what I checked yesterday was, if it was just a sentiment thing, then we wouldn't have seen it among people who had done their shopping. But people who did their shopping had the same view on prices as those who hadn't done their shopping. So people are seeing it at the checkout counter, and it's something that's out there right now. Now, the other thing the president can do is just ride it out, because if it ends up being a one-time increase in the price level, then you should see less of it next year.
Which is what Powell effectively believes, right? That it is going to pass through, and that they will get closer to 2%.
So you take it on the chin now politically, and maybe it hurts you in the midterms, but by next year, if there is not another increase, that said, I'm talking to some people that say we've only seen a piece of the pass-through on tariffs.
The only thing is that the inflation in goods is one piece of it, then you have the healthcare issue, you have all of these other things piling up on top of the consumer, and it's like you can ride that out in terms of the bump in goods from tariffs, but that doesn't isolate the inflation, insulate, I should say, consumers from the effect of inflation on other areas that they are paying for.
I also think that one tremendous value for this survey is recognizing that we live in a very distinct milieu of people who are wealthy and they're getting wealthier through the stock market.
Right.
That is not necessarily true for the bulk of Americans who are out there, 61% telling us they believe their wages are not keeping pace with inflation. And that's the average, that's the reality for a lot of Americans out there. So go online, read this survey, and see how average Americans think versus what is out there in your world.
Do you remember Greg wrote a piece 2 weeks ago in the Wall Street Journal about this idea of affordability being, he didn't say it was a con job, which is sort of what the president said, but that affordability is almost like a psychological sense of relativity that you really, that actually has no real basis in sort of history or where things, I mean, if you were to look at sort of where we are on a historical basis, you'd actually think pretty good, maybe, but maybe not.
There's no doubt there's a psychological aspect to this. It's in the headlines. And I was thinking about that this morning. It's like, here I am with the actual results of the survey, reporting it, and perhaps some of the survey results are a result of previous reporting. So it gets a little circular. It is true. However, I've also learned over the years, Andrew, not to tell people they're experiencing a different reality from the one they're telling us.
That was a mistake that Biden made, and a mistake that Trump made.
If you say things are bad, I'm not going to argue with you, because one of the things I think we know is that people know their economic reality better than almost anybody. It's why, by the way, sometimes we ask people, how's the country? And they say it's terrible. How are you? We're okay. We get a lot of that in these surveys.
Steve, thank you. And we should tell everybody that tomorrow on Squawk Box, Steve's going to bring us a special live interview with Fed Governor Christopher Waller. Waller, of course, has been in the running to succeed Jay Powell. Steve will bring us that conversation with Waller live from the Yale CEO Summit. It's at 8:15 Eastern Time. We were looking at the Kalshi numbers. So are you surprised that Warsh is now apparently outpacing, at least just by a hair?
Our report yesterday perhaps had an influence on that, where we heard that there was some pushback from Wall Street. I'm not surprised. I think the president has latitude to do what he wants with certain departments. I feel like he has less latitude with the Fed. And I feel like people on Wall Street have told the president, do what you want with Justice or the Defense Department, don't mess with the Fed. Make sure that there's somebody credible in there. It's so important for the Fed to have that credibility. And people, they scorn it, but remember, while we went through the high inflation period of the post-pandemic period, inflation expectations remained under control. The belief both on Wall Street and, by the way, in the general public, that prices would be kept under control remained there.
But you think that the problem that Wall Street thinks about Hassett versus Warsh is that they think that Hassett is more loyal or too loyal to the president, and that Warsh will be his own man.
Yes.
But if you're the president, you may not want somebody who's there.
But you also don't want to get calls from your Wall Street buddies that say, don't get this guy.
Yeah.
I think you want to have a little bit of approval.
By the way, Kevin Hassett will be on Squawk on the Street.
9:15 this morning.
And he changed his tune a little bit over the weekend, remember? Saying, I will be independent.
Right.
So he almost was addressing the criticism that we're reporting was out.
Bond market doesn't believe that.
But also said he was prepared to meet with the president. Remember, he said that was the other component part. He said, I'm going to be independent, but I'm prepared to meet with him. Very happy to.
There's a lot to talk about.
All of this will get addressed this morning, 9:15 Eastern Time. When we come back, an exclusive first look at the 2025 insurance costs from severe weather, with most of the damage happening in the U.S. We're going to have a full report on the eye-popping numbers next.
We've got a market flash on Pfizer, the company affirming its 2025 earnings outlook of $3 to $3.15 a share versus estimates of $3.13. Revenue guidance is roughly in line with estimates for 2026. Pfizer sees earnings from $2.80 to $3 per share versus estimates of $3.05, so lower than expected. Revenue guidance also straddled analyst expectations. Pfizer says its revenue forecast includes about $1.5 billion less in COVID-19 product revenue this year. They're also talking about their pipeline, which is pretty interesting. 15 clinical studies planned to advance in 2026, and mostly in phase 3. Stock barely moving right now in the back of this news.
Okay, meantime, severe weather causing soaring damage costs around the globe, but catastrophes in the U.S. are driving those losses. Contessa Brewer is at the table this morning. She joins us with an exclusive first look at catastrophe costs in 2025.
Good morning, guys. Nice to see you. Yeah, $107 billion. That is the estimate from Swiss Re Institute for insured losses from catastrophes around the globe this year. 83% of those losses happened in the United States, with the LA wildfires becoming the most expensive wildfire event in history. Severe convective storms with wind, hail, and tornadoes are also driving the losses. And Swiss Re points out prevention, protection, and preparedness are crucial. Insurers are really sharpening their focus on mitigation, the ways that customers can lower their own risks, whether it's clearing brush and trees from around properties in wildfire regions or building better where hurricanes threaten. When hurricane wind gusts hit 110 miles an hour, a 2x4 can become a spear, and standard plywood can't withstand that force. But increase the thickness of the wood by ½ an inch and watch. Helpful to know if you're boarding up windows ahead of a storm. Convective storms that produce fierce wind, tornadoes, and hail have become increasingly costly in the U.S. Building materials matter. FM employs 2,000 engineers who work with their commercial, industrial insurance clients. At FM's Rhode Island Research Campus, engineers use hail cannons to test roofing materials and solar panels to see which withstand the impact.
Those panels, when put on the roof of a client facility, will be resilient.
In the burn lab, teams test whether a client's facilities have adequate fire protection. Look what happens when there's no sprinkler, or they assess cleaning processes because even dust can be explosive. Companies then use the information to protect their facilities and inventories from catastrophic loss.
I'd rather our clients put that capital into risk mitigation than paying it to me in premium. Because in the long run, the trade's going to work out very well for both of us.
And across the industry, insurers are really pushing customers to invest in their own resilience. That can result in meaningful savings on premiums. In fact, USAA's CEO told me last week that they've contacted 3 million members this year alone to push for more mitigation. And a company like Hippo offers a comprehensive package of smart home equipment to its customers. They have shut-off valves for water leakage and surge detection, remote gas shutoff. And what they have found is that it really lowers the kind of catastrophic damage, the big money claims that otherwise might result.
Before, were they just not, we're just saying, okay, we'll give you the premium and that's it, and you do what you want, and now it's much more of a push?
Well, they feel like whether it's commercial clients or homeowners, if you have skin in the game, so your deductible is higher, that you have to take down that big tree that overhangs your roof. And think about all of the big money investments that are going into data centers. I mean, these are going to be $20 billion, $30 billion properties. For these especially, the mitigation planning that goes into it is so that would be equal to like a Cat 2 hurricane across multiple
Right.
states if you lost
So
one of those data centers.
Are any of these data centers being built in the wrong places?
There's no such thing as a right place now. The sort of, we were talking about severe convective storms. That's the whole middle of the country where you might think, okay, there's not gonna be hurricanes, but hail goes in, and especially where you're using solar power, those panels are especially prone to hail damage. So making sure that they can that can withstand hurricanes.
Amazing.
Thank you.
Sure.
Coming up, President Trump lighting a fire under the cannabis sector. We'll check out some of the names on the move next. Squawk Box returns in just a moment.
Welcome back to Squawk Box right here on CNBC. Take a look at the Dow right now, up about 2 points. Nasdaq down about 14 points. This moved around a lot this morning. S&P 500, we'll call it unch for now. We're going to get our jobs numbers at 8:30 a.m. Eastern Time. It's going to be backward looking both at October and November. With a lot of things that we're going to have to try to look through. But Treasuries right now, 4.1 on the 10-year, 2-year at 3.5. Bitcoin sitting just at about $87,000. It had gone down to about $86,000. I think when I saw you last yesterday, it was $89,000 in the morning.
President Trump says he is considering an executive order to reclassify marijuana as a less dangerous drug. He said such a move would allow research that cannot be done under the current classification. Pot stocks are up sharply this month. We did see them rise on Friday very sharply on the back of similar reports. Obviously, the sector is one that moves very quickly and swiftly, Andrew, on any of these reports, because this really would open up capital. It would open up the ability to list here in the United States for institutional money
But
to
most of
invest
all,
in
people
these
are able
stocks.
to walk into these stores and use credit cards. People would be right.
Right, it's a lot of barriers go away for these companies, for this industry, if it is reclassified as something less dangerous than
And
marijuana,
you've been
which is a
studying this
similar-
business forever. So what do you think?
Not forever, but it's about time, and we've seen these reports many times. We've seen the stocks move very sharply many times to the back of these hopes. So we'll see if this happens actually this time.
Big deal. Okay, coming up, a wide-ranging interview. We got Lazard CEO Peter Orszag. We can get into everything from the economy and the Fed to M&A and why deal-making needs a political strategy. We'll discuss that when Squawk Box returns. Welcome back to Squawk Box. We're going to get right to our next guest here to talk markets, the economy, the Fed, deal-making, M&A, AI, healthcare, and so much more. As Peter Orszag, he's the CEO of Lazard, former director, of course, of the Office of Management and Budget under President Obama. And I always think in this role you have your finger on the pulse of the corner office of businesses around the world, frankly. And I think we're all trying to figure out where things really are. We'll get some jobs numbers later today. But where do you think things really are right now?
I think things are good, confidence is high, but we also are living in a bifurcated world in which the U.S. economy in particular is increasingly a levered bet on AI. So the AI parts of the economy are booming and the rest is, I'd characterize as going sideways.
And so do you believe, though, that this sort of AI boom is filtering, cascading through the rest of the economy, or do you think it's genuinely concentrated? I mean, there's sort of two views. One is, yes, the money is concentrated, meaning coming through the system, but it's actually making its way through the system, or not really?
Not really yet, and I think the way this bet will play out just simply is either it'll work or it won't. If it works, top line growth is probably going to be okay, but I'd say we probably will have a jobs crisis because labor markets deal well with small problems that happen fast or big problems that happen slow. They do not deal well with big shocks that happen quickly.
You think a jobs crisis is coming, therefore?
Well, if the AI
success.
pulls off, pays off, I would probably put my money on that. The alternative is this is all overhyped. We're going to wind up with the equivalent of an inferior version of dark fiber, and then even top line growth
How
is
do we hedge
challenging.
against that? I mean, if
There has to be a third option. I want a third option. Right.
But by the way, you're investing even inside Lazard in a lot of AI. Do you think it's changed the jobs picture inside of Lazard itself?
Not yet, but I do think it's going to allow us to take the analysts and associates and even the VPs and upgrade their skills more quickly. And then the question becomes, how are you training the next generation of managing directors?
But is that less? I mean, one of the things we're seeing is kids out of college are actually having a much harder time getting a job. And is that a function of some of these white collar jobs where folks in your role may say, you know what, maybe we don't need as many analysts as we used to have?
Not really at Lazard yet. It may be true in professional services. There definitely are anecdotal reports of that.
last week at the Goldman Sachs conference, there was a figure, you're going to increase productivity per managing director by $1 million. And what is that mostly? Is that AI? Like, how do you do that? Like, what does
that was very
is that
specific.
AI?
I mean, we've already increased productivity by more than that. So I just finished 2 years as CEO of Lazard. By the way, more than 80% TSR, total shareholder return. So we're off to a great start. Very excited about the future. That was very specific about what happens when you bring a lot of new managing directors on, because we've been doing that.
Just training them.
And as they ramp up, you get a productivity benefit, because the first year or 2 or 3 on the platform, they tend to be less productive than once they get settled in.
How do you think about that, though, when you overlay AI on top of that?
Oh, I think there's
there's
a lot of opportunity. If you think about it, if we could have our bankers walk into a boardroom, not only with their own wisdom and knowledge, but with the collective wisdom and knowledge of everyone and everything across Lazard, that is a massive advantage, and that's what we're aiming for.
I want you to weigh in, if you will, on this Federal Reserve situation.
Sure.
We've been watching the prediction markets. Kalshi now has Kevin Warsh just above the other Kevin Hassett. Kevin Hassett, by the way, is going to be on Squawk on the street at 9:15 this morning. Who, just straight up, is there somebody you prefer?
I know both of them well. I think they're both more than qualified. I think the key question is, how do they perform in the job? They are both perfectly capable of being a independent, wise central banker. The question becomes, how will they behave in the job? And that, I think, is actually really hard to know ahead of time for anyone.
What do you make? So Kevin Hassett made some comments over the weekend that became sort of a talking point. This idea that he said he's prepared to sit and meet with the president regularly to discuss these things. Now, it's always been true, and you can maybe speak to this, because you've been, that the Treasury Secretary would meet on a daily or a weekly basis with the head of the Fed, and I'm sure would share his thoughts about what should happen. Oftentimes, I would imagine, communicating what the president may very well think. I don't know how much, though, they ultimately talked about interest rates themselves, and I also don't know if it's different if the president is sitting across from you eye to eye saying, this is what I need from you today.
Well, first of all, in my prior jobs in government, I did interact with the chair of the Federal Reserve on a regular basis. That's normal, as you mentioned. I would also note, I remember very clearly, there were meetings with the president where the Federal Reserve chair was present in the Oval Office. That also happens. I think the distinction is, are you talking about the broad state of the economy, or are you receiving direct input about the next Federal Reserve rate shift? Those are different.
What did you see? Okay, sitting where you sat.
Yeah, I never saw, at least the 2 presidents I worked for, direct the Federal Reserve chair to either cut or raise interest rates. It was more just, fill me in on what you're seeing across the economy.
And do you think that the bond market has a view about one of these players over the other, of the Kevins, for example?
Yeah, I think Wall Street seems to be preferring Kevin Warsh.
Because they think he's going to be more independent.
Because they think and also the irony is, if you look back at his statements, Kevin Warsh has been more in the camp of tighter monetary policy, which of course is the opposite of what President Trump says he wants.
So isn't that surprising then?
I think that's one of the reasons why, more recently Kevin Warsh seems to have been changing his tune a little bit, but I think this is one of the things the president will be looking at. Now, I would say, be careful what you wish for. There's a wide array of empirical evidence showing that an independent central bank actually is what a president should want because it delivers lower inflation and higher growth. And so there's a temptation to get in there and meddle, but it can be counterproductive.
Are we at a point here where if it is passed that the Fed credibility question comes back in play?
I think, there was a saying when I ran the Congressional Budget Office, you don't leave the dance with the one who brought you. So once in the job, the question becomes, how do you behave when you're in the job? And that's what determines independence. So I think it remains to be seen.
M&A, deal making. We've seen a lot of big strategic deals. Now this takeover fight for Warner Brothers Discovery, for example. But I was going to say, there's still a big question about exits in the private equity world and what happens to all of those companies. There's sort of a, I don't want to say a zombie situation happening, but we're getting closer to that. And I mention only because on the fundraising side, unless that some of these guys can actually get some cash out, there's going to be no opportunity to get some cash in.
Yeah. So I think 2026 is shaping up to be a banner year for M&A, and that's because the strategic incentive for scale is really strong. You've got a regulatory environment that is more accommodating. It's more political, but more accommodating. And then to your point, the next stage is also going to be private equity, where their investors, their limited partners, are demanding more cash back. They've been hesitating because the valuations on some of the portfolio companies were kind of whipsawed by the rise in interest rates. But that's kind of getting long in the tooth, and I expect that in 2026 you're going to see continued corporate activity, but also a bunch of sponsor activity.
Okay, you said the political piece. So much of this now seems to revolve around what the White House thinks. What did you make, for example, in the context even of the Warner Brothers Discovery situation, the president saying maybe the quiet part out loud, which is that he plans to be actively involved in the decision-making about whether that transaction gets through and who ultimately is the buyer to some degree?
Well, what I'd say is two things. First, anyone contemplating a major transaction, now maybe this is obvious to say, you have to deal with the kind of technical analysis that the Department of Justice and the Federal Trade Commission look at, the Herfindahl indices and all that sort of thing, but you need an over-the-top White House and cabinet strategy also. So that's point one. Point two is, look, the fact of the matter is the administration can move to block things, but they are not the ultimate decider. You can litigate those decisions, and so ultimately a lot of this will go to the courts, and we'll have to see how the courts view something that seems political as opposed to substantive.
So what are you advising companies to do in that regard then? Do you say
you have to do both.
Go to court?
Well,
you're not
hopefully you don't get to that point because you have a pincer movement in which you're dealing with the technical analysis and the over-the-top one. And if they're favorable to what you're trying to do, then you don't even get to court.
Can you remember a period of time where it was like this in this regard, that you were advising companies to come up with a strategy about how that you're going to influence members of the cabinet?
No, this is unusual, and there's a broader point here, which is the role of geopolitics in business decisions is much more important today. I'll call it contextual alpha. You can look at the underlying deal, but you have to take into account the context, or you're going to be making some bad decisions. By a wide margin, more important today than a decade ago.
On healthcare, big issue in Congress right now as we speak. We wrote a piece recently. We're not getting this morning.
Yeah.
We're not getting to the heart of the problem.
Right.
So what do you recommend?
Here's the issue. I mean, if you're just pushing around who's paying for premiums, you're kind of avoiding the real issue. The real issue is how do you get at the total cost of care? There is an idea out there that the way to get at the total cost of care is to have more consumer skin in the game. Give people money directly, and then they decide and bring down the cost that way. That works, but it only works a little. The evidence is strong. People do comparison shop. That's great. But if we took 20 people and said, let's take the 5 most expensive people for healthcare, those 5 are going to account for 85% of the spending. So if there's consumer-directed healthcare, which is mostly appropriate for the other 15, they're only 15% of the total spend. It's not going to move the needle that much. So you have to get at the total cost of care for those 5 people, the really expensive ones. And most of what happens there depends on what the physician is recommending. So the op-ed that I wrote is mostly about how do you change the recommendations that physicians are making. And here we come back to AI. There's a lot that can be done to narrow the variation across the U.S., which is massive, in what physicians recommend.
Peter, thank you for coming in this morning.
Great to see you.
Happy holidays. You bet.
Coming up, House Majority Leader Steve Scalise will tell us about the GOP's proposed bill to reform health care, plus how Republicans are addressing the affordability issue. That's 8:10 a.m. Eastern Time. Squawk Box returns in just a moment.
Coming up, the AI boom and the prospect of a bubble. We're going to look at valuations, the IPO window, and all the deals from a venture capitalist point of view. Don't go anywhere. Squawk Box. Coming right back after this. I'm going to talk some tech right now, AI valuations. Kanye Nagbella is managing partner at Kindred Ventures. Want to get into all of this with him this morning as we try to understand where this is all going. The venture business has been an interesting one. This could be a huge year for some of the vintages, but probably, what, 5, 6, 7 years ago, or what's going to happen in 26?
Yes, this is really an exciting year because you've got some of the biggest potential IPOs probably of the last decade, companies like SpaceX, potentially companies like Ramp, and then of course the big AI companies who are looking ahead, Anthropic and OpenAI, and these are companies that are going to be going public at anywhere from $500 billion to $1 trillion+. So that's really blockbuster IPOs, which are going to let a lot of air out of the balloon for some of this cash that's been going in without any end in sight on the other end. So it's actually a really important year for venture capital.
And the question is, how much do you think that's actually going to happen in 26? How much do you think gets pushed out to 27, 28, et cetera? And we talk about bubbles all the time. Is this the sign of one?
When we start the bubble question first, which is a very important one, and the thing about this economy that's really interesting is there's so much concentration, and you're seeing it in the public markets, of course. So NVIDIA is more concentrated as a single stock than you've seen probably in 40 years. Mag 7, 30% plus of the S&P, and the tracking error is totally off. And then you're seeing that actually in the private markets as well. And so if you look at the private capital that's gone into just the large foundation models, the frontier labs, that represents a higher percentage of the dollars that have gone into venture capital than almost any other time in the last 10 years. And that's because the narrative is so clear right now, which is that everybody wants to build the new compute stack, the new inference stack, and the new demand stack for AI. So whether or not that's a bubble actually has a couple of inputs that I'm looking at personally. One of which is there going to be enough demand for all this build out? And we should talk about that. Is the deprecation for all this infrastructure actually going to work in such a way that the unit economics make sense? Are the multiples that these companies that are concentrating all this capital that we're trading at reasonable? When I look at each one of those today, it actually seems more rational than you'd expect. There's one place that I'm tracking where there's a bit of concern, which is the bonds. So there's a big debt load that a number of these big hyperscalers and companies like Oracle and CoreWeave have taken on, where there is a point of concern. But on the multiples, on the deprecation schedules, and then on the demand, I actually feel pretty confident that we're in a healthy place.
Do you think that in terms of the large language models themselves, that they all become commodities? I mean, part of it is that they all may ultimately, if they're as successful as they want to be, you think that they would all converge?
There's two answers to that. The first answer is, yes, they become a commodity the same way that the hyperscalers made the cloud storage a commodity. That's a cloud storage commodity that's growing at $10 to $30 billion of revenue a year, 30 to 40% plus year over year. So even if that were a commodity, it's actually a really good business because there's just so much net demand. So that's path one. Path two, which is the path that I think we're actually seeing, is that each one of these models actually starts to specialize on certain areas where they become really, really strong. And so you're seeing Anthropic has really done a really, really important big investment into coding, into Claude, which is actually their enterprise agent. And between enterprise and coding, they actually have a true differentiating advantage in their technology and how that technology is able to deliver results for end users. Whereas ChatGPT and OpenAI is really focused on the consumer use case, and they're focused on media. Things like Sora, things like their Whisper model, which are audio and video, and then of course the chat model, which is really, really important for consumers. And then Google, which is the big monster, is kind of doing it all. But I think that actually is going to play out even more deeply as these companies further invest into each of these lanes.
Final question, is there a way to invest in this in some other way that, for a public investor today, that doesn't seem obvious to you?
Yes. If I were looking at it, I would actually be thinking hard about the agentic app layer. So the reasoning models just came out over the last 18 months, and these reasoning models are finally making enterprise use cases useful. I'm seeing it in insurance, I'm seeing it in law, I'm seeing it in healthcare, commerce, and so I would be looking for companies that are spending a lot of energy and time figuring out how to actually replace services with AI in productive ways. Peter Orszag earlier was talking about the way Lazard is doing it, and I actually think at a stock picker level, there's individual names where there's an incredible amount of margin expansion available.
Okay, we're going to leave it there. Thank you so much this morning. Talk to you soon. You bet. It is just past 8 a.m. right now on the East Coast. We're watching Squawk Box on CNBC. I'm Andrew Ross, working along with Melissa Lee. Joe and Becky are off today, but a lot going on. Among the top stories, the combined October-November jobs report set to be released in less than 30 minutes. The market may move on this. We'll see. The NASDAQ seeking approval separately now to extend trading to 23 hours a day during the work week. The exchange is asking the SEC for permission to add an additional trading session from 9 p.m. to 4 a.m. Eastern Time for those of you who want to stay up late, or for those of you maybe hopefully abroad looking to capitalize on demand for U.S. equities. New York Stock Exchange and CBOE also recently announced plans for round-the-clock trading. And the FT reporting that the U.S. has suspended talks on a proposed technology trade deal with the U.K. after growing frustration over slow progress. That deal announced in September during the president's state visit aimed to boost cooperation on areas such as AI, nuclear fusion, and quantum computing, but another demonstration of just how some of these deals, at least deals that appear to have been made, may not be so easy, maybe more complicated than that.
Yeah. Let's take a look at futures on this Tuesday morning. As Andrew had mentioned, we're awaiting the jobs report for November as well as October. Pretty flat across the board in terms of the pre-market. S&P looking to be down by just about 3 points. NASDAQ looking to lose 35 right now. Joining us now for more on the markets and jobs, Joe Amato, President and CIO at Neuberger Berman. Joe, great to have you with us.
Good to be here. Thank you.
It's interesting to get the jobs report now after the Fed decision. How important is this for you?
I think the data is really important. I think the state of the labor market is one of the critical issues in terms of determining what the Fed path is going to be. And, our sense is you're going to continue to see a grinding, weaker labor market, and that, I think, leads the Fed to be more dovish, possibly than the market's even expecting right now.
How do you think about the Fed in 2026 and the impact on equities, but in particular on rates? And I'm wondering because even if we get a new Fed chair, that doesn't happen until after May. There's a confirmation process. It seems like everything is very back-end loaded, and for somebody to believe that there are a lot of cuts in store, they have to happen in succession the second half of the year.
Right now, our base case is you're going to see one more rate cut. The market's right now pricing in 2+. Yeah,
okay.
And we think growth's going to hold up better, and inflation's going to come in better. So that's going to lead the Fed to be accommodative. But we're going to watch the pathway here based on what the short-term data shows. We think the short end's going to come down, the long end's going to stay reasonably stable. I think you've got return to the carry trade to a degree, which will keep the long end stable. So we think fixed income is going to be somewhat more boring next year than you saw over the course of the last year.
So even with central banks around the world raising rates, like the BOJ is going to be meeting, and they'll be that's not going to be pulling up our long end.
I do think you've got a divergence of monetary policy for sure, whether it's Australia, Japan, but at the same time, I think you've got accommodative policy in China, and I think you'll have accommodative policy in the U.S. But I think that's where we're at right now is this tug-of-war between what's the state of economic growth, labor market, and what's going on with inflation. That's why you saw last week with the Fed votes, you had a pretty big divergence. You had some people not wanting to reduce rates, others wanting to reduce rates a lot. And I think that's where we're at this rate, and that's why the data is so important, what we're seeing right now and what we'll see in the coming months.
So how does this set up for 2026 in terms of the equity picture?
I think the equity picture is constructive. I think we expect an increase in nominal growth in 26, which should continue to help boost earnings, which have been strong over the last couple of quarters. So you've got the reduction rates that have occurred over the course of the past period of time. It's not just the recent rate reductions. You've got fiscal stimulus, which is very much front-loaded in the first half of 26, purposely so, in the context of the political environment that we're seeing. And you've got deregulation, which has been kind of bubbling in the background that we think is going to be helpful in boosting confidence.
So the fiscal stimulus is, what are the main things? I mean, is it the tax refunds? It's R&D expensing?
I think it's incentives for CapEx. You certainly on the consumer side, you've got some level of tax rebates that you're going to see, which is always helpful to the consumer. But I think the more sustainable issue is incenting companies to invest more aggressively in CapEx.
And I have to ask you about the Fed chair. Does it matter in your view? Does it matter to the Fed's credibility? Does it matter to what the long end does in terms of rates? How do you view this?
I think it matters a lot. The Fed chair is an important determinant of the pathway, and having a credible, independent view from the Fed is critical to keeping the bond market stable. Right, our expectation here is the bond markets are going to be stable. If if you see the credibility lost for some reason and the long end of the curve gets unanchored, then I think all bets are off.
Are any of the candidates, do they concern you?
I think all the candidates are very credible. I mean, we know
Okay.
each of them reasonably well, and and I don't think the Fed independence is something that is like a light switch on and off. I think it will either grow over time or not, and I think the leadership of the new Fed chair is going to be important to determine that.
Joe, great to see you. Thank you.
Thanks, Evan.
Coming up, can Republicans get the House GOP health care proposal across the finish line? Majority Leader Steve Scalise is going to join us next. Plus, it's Jobs Tuesday. The combined October-November jobs report and October retail sales data set to be released at 8:30. The numbers and market reaction is all coming up. Do not go anywhere.
Our ETFs use today's best ideas to help bring tomorrow's goals within reach. Our broad suite of over 50 low-cost ETFs is backed by 150 years of active management expertise. Explore PGIM ETFs today.
At Corient, wealth management begins and ends with you. We believe the more personal the solution, the more powerful the result. We treat your goals as our own. We never lose focus on the life you want to build. And our experienced advisors design custom-built strategies to help you get there. It's time for a wealth management experience as sophisticated as you are. It's time for Corient.
Down, up, right, left, inside, out. Sometimes it's hard to make sense from nonsense. Go beyond the headlines. A trusted global perspective. The Economist. Know which way is up.
I am a coach and an alum of Girls on the Run. Kids today carry a lot of stress, from school pressure to social isolation to overuse of devices. We create a space where girls can connect, build confidence, and learn skills like managing emotions, setting goals, and speaking up. Each child's experience is different, and families need support. I'm proud to be part of a comprehensive solution to youth mental health. Get involved today at empowerourfuturecoalition.com.
One of my favorite pieces of advice, think big to accomplish big things. Have no fear of failure. It really does come down to just trusting yourself.
Julia Borston hosts CNBC Changemakers and Power Players. Listen now wherever you get your podcasts.
You're not going to believe this. I'm going to pour this popular sports drink into the new Sans water purifier and turn it into pure, clean water. Sans eliminates up to 99.9% of heavy metals, forever chemicals, microplastics, virus and bacteria, and much, much more. As you can see, Sans gives you nothing but pure, clean water every time, no matter how bad your tap water is.
Meet Omnilux Contour, an LED light therapy mask clinically proven to reduce fine lines and wrinkles. Find out how you can improve your skin at OmniluxLED.com. Precise designs, subtle curves, curated upgrades, elevated design for thoughtful living. Thuma.
Now to the latest in the race to be the next Fed chair. This morning, prediction market Calci puts former Fed Governor Kevin Warsh in the lead, with bettors seeing a 46% chance he will be nominated by President Trump. Previous frontrunner Kevin Hassett, who leads the National Economic Council, is now in second place. Sources tell CNBC Hassett's candidacy has seen pushback by high-level people close to President Trump. Some are worried the bond market could see upheaval over time if investors see Hassett as too close to the president. Hassett, by the way, will appear on CNBC 9 a.m. Eastern Time on Squawk in the Street, so don't miss that interview.
Okay, meantime, a Republican health care proposal is on thin ice in the House ahead of the coming holiday recess. Join us right now with the latest House Majority Leader, Steve Scalise. Good morning to you. Help us understand where you think this is. I don't know if you think our description of thin ice is right, but what you think the chances are that something gets done as open enrollment is literally happening around the country.
Well, thanks. Good morning, and thank you for having me. We've been working for a long time to lower premiums for all Americans, 100% of families across America. Democrats, as you know, have only been focused on trying to give big bailouts to insurance companies dealing with 7% of Americans. So big difference between the two sides. We're going to be bringing to the House floor tomorrow, on the floor on Wednesday, is the Lower Premiums Act. This is a bill to lower healthcare premiums for all Americans. It's going to be focused on things like association health plans, the Choice Act, which is a way to use health savings accounts so that employers can work with their employees and give them better options for lower premium healthcare plans. We do what's called cost share reductions, and it's basically a term up here in Washington to lower premiums for everybody in Obamacare. So if you want to stay in Obamacare, a lot of people probably don't.
Leader,
but for those people, that would be a 12% reduction.
Let's just take this down to the very base case. I'm a family. I'm a family of 5. Tell me, and let's say I want to get on this program. How's it going to work? Tell me what the program is that I'm currently on, and what you think the new program looks like. What's my deductibility look like? What do my premiums look like? Just walk us, sort of a basic American who's thinking about what to do here, how it's going to impact them.
Yeah, it seems like all the attention's been focused on Obamacare, which is not a lot of people, but it's a small percentage of Americans. But 80% premium increases just for people in Obamacare. We want to help lower their premiums, but right now nobody has options. It's really not a competitive marketplace. So if you don't like the plan that you have, it's really hard to shop it around, like, for example, car insurance, your homeowner's insurance. I mean, you turn on the TV, there are commercials with lizards and all kind of other animals that are selling you options to get lower insurance. You don't really have that in health insurance. So we want to open up the marketplace, because right now, if you don't have any choices, you're going to pay more. So we're going to give people the options to buy different kinds of plans that are better for them, lower cost, better coverage for their families, lower deductibles for their families. And then also, when you open up health savings accounts, you think about some of the abilities you have to work with your employer to get better options through your company if that's the route you go. Obviously, if you're already on Medicare and Medicaid, that's a different set of families. But if you're either in the private market or Obamacare, you have literally no options. We want to give people choices to get lower premiums.
Leader Scalise, to get to Andrew's question, though, how does an average American think about what their health care spend will look like under the plan that you put forth? You mentioned lower premiums, but how will this actually work compared to what is already being paid? Because that is the bottom line that people care about.
Yeah.
But when you just say lower premiums, it doesn't mean anything.
Right. A lot of the press only focuses on Obamacare. A lot of Americans still get their insurance through their employer. Well, right now, if your employer offers a plan, you pretty much have a take it or leave it. They're going to cover a portion, maybe a lot of that copay, and then that's the only choice you have. Otherwise, you're going to be out trying to buy insurance at 100% on your own. Nobody can do that. So what we do is set up what's called, in this case, the Choice Account. So it's a health savings account where if you can find a better plan for your family outside of your employer, you can use the employer money that right now he's spending on your higher cost plan and go buy a lower cost plan using the employer's existing money. Right now, that's not allowed in law. We open that up. So those are different choices that we're making available to people so that you will see a marketplace for insurance, for health insurance, just like you see it for car insurance and homeowners insurance, which, by the way, is a very robust marketplace. Pick up the phone, you can save $500, $700. You don't have that in health insurance. Wouldn't it be great if you actually had the ability to shop around policies?
Leader, how quickly
so
do you think
that's
this
what we're working towards.
Leader, how quickly, to the extent this gets passed, and I know that's a big if, how quickly do you think this filters out into the marketplace in terms of cost to the American public come 2026?
Well, we're going to pass this bill Wednesday, so it'll be over in the Senate. If it passes the Senate this week, a month from now, I can't predict the Senate schedule, but I think Americans, once they see this, are going to call their United States Senator, Republican and Democrat, because it will take 60 votes, make no mistake. Call your senator and say, hey, I want some healthcare freedom. I want some choices. We have PBM reform in this too, so you get lower prescription drug costs. Another big cost escalator in healthcare is in this bill. So a lot of options for families to lower costs. We passed it through the House, it still has to go through the Senate. So
Yeah, well, that's my
I
question.
want
What's
to
the
see
chance it
American
gets through
people
the
get
Senate, and
engaged.
what's the chance it gets to the desk of the president before the year's out?
Well, the president wants to sign this bill. The president's talked about this a lot. The president wants to see better options and lower premiums for families. He knows that the Affordable Care Act is not affordable. The Democrats created a system that's incredibly broken. They broke it, we're gonna fix it. But we gotta pass a bill first to do it. So I think the Senate's gonna be the biggest hurdle. We gotta get it through the House. It's never easy when we have a 2-seat majority. I'd love to say a lot of Democrats will join in, but for whatever reason, they are stuck in this Obamacare or bust mode where they don't want families to have options. They want to force everybody into a single-payer government-run system. That's not good for most Americans. So we're going to give those choices. You'll see a vote on the House floor. See where your member of Congress voted, but then get engaged with the senators to get this bill through the Senate.
Hey, Leader, separately, and this literally has happened while you have been, I think, on the air. I don't know if folks have been following this. There's a piece in Vanity Fair that has just come out, an interview with Susie Wiles, of course, who's the chief of staff to the president, who says she apparently sat for 11, there were 11 different interviews going on here with the cabinet team. Some astonishing quotes. I just want to read you this. I'm curious what you react to it. She said that Mr. Trump, quote, has an alcoholic's personality. She goes on to say that J.D. Vance has been a conspiracy theorist for a decade. She says Russell Vought, who's the budget director, is a right-wing absolute zealot, and that Pam Bondi completely whiffed in handling the Epstein files. This is the chief of staff of the president. This literally came out just this morning as we've been speaking to you.
Well, I obviously have not read that article. I'll have to read it. I know Susie, she's the hardest working person up in D.C. with the hardest working president in America, Donald Trump. By the way, he doesn't even drink alcohol. So not sure what that quote is related to. The full context would be helpful. But President Trump never stops working for American people. I've talked to him about health care, talked to him about a lot of issues, and he's engaged in all of them. He wants to help lower costs for families. Again, not just in health care. At the grocery store, look at gasoline prices. We're seeing a 4-year low in gas prices at the pump today. That's more money in people's pockets. We're seeing higher wages. We need to do more, and we're going to do more. But those are some good things that President Trump's already delivered on in less than a year.
Leader Scalise, you mentioned the affordability issue, which is a key one that both parties will face come midterms. The healthcare piece is part of this, but there's a broader sense amongst the American people that they are, even if their balance sheets in reality look decent, they don't feel good. Or maybe their balance sheets are not good and they don't feel good. And you mentioned things like the cost of fuel coming down, but the fact of the matter is they go to the checkout line at the grocery store and they are paying more. We had the CNBC All-American Survey, which polled shoppers, holiday shoppers, they said they're spending more because the cost of goods is higher. What is your message? Instead of just saying that fuel prices have come down, this has come down, people still feel strapped.
Yeah, they do, and think about this. For 4 years under Joe Biden, we saw a dramatic increase, a 40-year increase in inflation, meaning things cost more, government was borrowing trillions of dollars, jacking up the cost of everything, and your buying power got lower during the Biden years. And so we're finally starting to fix it, we're bringing that down, but it's taking time. And I know people, they want to see it all happen overnight. We're seeing good improvement, but not enough yet. We're still working on it. Look, next April, when people file their taxes, because of the tax bill we passed this year, you're not going to see it till you file your return, but most families are going to get over $1,000 back in their filing from the IRS because of no tax on tips, no tax on overtime, holding all the income levels the same so that we didn't get a tax increase. There was going to be a massive tax increase that would have hit. We're doing a number of things. We got a big housing bill coming up this week out of committee, and we're going to actually be focused on lowering the cost of home ownership. You talked about the Federal Reserve. I hope the Federal Reserve keeps lowering interest rates as we're reducing the deficit. The deficit up here plays a big role in interest rates back home when people borrow for things like home ownership or credit cards. And so we're finally getting control over spending. That's going to lower interest rates so people can go buy a home. and then we're bringing these housing bills. So all of it takes time, but we're working on all of it at the same time right now. And I think early next year, you're going to start seeing bigger indicators. Trillions of investments already coming into the country from deals President Trump has already cut. Manufacturing, higher wage jobs. You know, you're seeing it all. The AI revolution is bringing good jobs too.
Leader Scalise, I want to thank you representing the 1st District of Louisiana. We love Louisiana. We appreciate your time this morning. Look forward to talking again very, very soon.
Great stay. Well, thank y'all for having me. God bless and Merry
Thanks.
Christmas.
You too. Coming up, a look at some of this morning's movers ahead of the opening bell. We're coming right back.
Welcome back to Spot Talk. Let's get to Don Shoes taking a look at some stocks on the move this morning. Hey, Don.
Good morning, Melissa. Good morning, Andrew. We're going to start things off with shares of Kraft Heinz, which are ticking higher this morning after the company announced that former Kellanova CEO Steve Cadillac was be taking over as CEO ahead of the company's planned split-off, which is planned to take place next year. Cadillac previously led Kellanova through their split with Kellogg's back in 2023. He will lead the Global Taste Elevation Company following the split, which will include brands like Heinz, Philadelphia Cream Cheese, Kraft Mac and Cheese, and others. Meantime, you got Ford shares, which are, you can see, moving higher by about 1.25% after it announced it would take a roughly $20 billion special charge around its pullback from electric vehicles. The auto giant will shift its focus back to the hybrid vehicle side of things and smaller EVs as it cancels its next generation all-electric large trucks. Ford also announced it will be starting a battery storage business to capture demand for energy storage from data center customers. And NVIDIA shares are moving slightly higher this morning after it was named one of B of A's top large cap picks for the semiconductor sector. Keep an eye on those shares. Now, for more on those and other top analyst calls of the day, just head over to cnbc.com/pro, where subscribers get all the context and detail around some of those notable upgrades and downgrades each day. Andrew, I'll send things back over to you guys.
Okay, coming up next, it is Jobs Tuesday. The delayed October and November jobs report's going to be released. Our panel standing by with reaction to the numbers. And then the central bank, a big focus for investors as we await a possible Fed chair announcement from President Trump. Former Atlanta Fed President Dennis Lockhart's going to join us with his thoughts as well this morning. Do not go anywhere. We're coming right back.
We're just seconds away from the delayed November jobs report, October retail sales as well. Futures here holding steady pre-market, down by about 4 on the S&P 500. NASDAQ can be lower by about 41. That picture will change, obviously, in about 15 seconds' time. CNBC team coverage this morning involves Steve Leisman as well as Rick Santelli. Rick Santelli, let's go to you. You're standing by at the CME. Let's get straight to the numbers. But Mike Santelli, by the way, is not the NYSE. But Rick, let's get to the numbers, please.
Yes, October and November for the big jobs report. The only thing is, it's not Friday. Here we go. November's number comes in at 64,000. 64,000 on non-farm. And if we look at average hourly earnings, they're up 0.1% year over year, up 3.5. These are both a little bit light compared to expectations. The average work week contracts, excuse me, we're looking for a contraction at 34.2, comes in at 34.3. The unemployment rate, and this of course is what everybody's been waiting for, did indeed move up to 4.6%. 4.6% would be the hottest going back to July of 21 when it was 4.7%. If we look at the underemployment rate known as U6, it's at 8.7%. 8.7% would be actually the warmest going all the way back to July of 21 as well. And finally, labor force participation expanded a tenth. 62.4 was expectations, comes in at 62.5. 62.5 would be the best read since April when it was 62.6, which is where we started the year and indeed is the two highest reads of the year. Now let's go to retail sales, shall we? These are November numbers. Unchanged. Unchanged. We're looking for up 110. Unchanged comes in at, well, it equals where we were. To find a lower number, you have to go back to May when it was a negative number, minus 0.8%. Now, what happens when you strip out autos? It improves. So autos were a bit of a drag. Jumps up to up 0.4%, which would be the best since August when we were up 0.6. If you strip out autos and gas, it improves another 10, up 0.5%. And finally, the control group number, or retail sales core, is a very powerful up 0.8, up 0.8. Up 0.8 would be the best since it was up 0.9 in June of this year, and that was a high watermark. What has happened as we have done these numbers? We see interest rates moving to the downside, We came in at 4.16, down 1 in a 10-year, and we're now hovering right around 4.14, down a couple of basis points. A 2-year is down 5 basis points, so you see another steepening of the yield curve. It was at 3.50, so right now at 3.46 will be down about 4 basis points. And the pre-opening equities, well, the Dow is in the green, up 57 points. You know, I guess if you have to summarize these numbers, and I do apologize, all I see coming across the wires are November. I do not see October on the jobs front. Back to the panel.
All right, Rick, stay with us. Mike Santoli, by the way, as I mentioned before, standing by at the NYSE, but we do want to get to Steve Leeson. You've been pouring through the numbers here. What stands out to you, Steve?
Well, the layoffs at the federal government level now being tallied in the numbers. A massive minus 157 for government employment in the month of October. It was minus 5. So when you look at the October numbers, which were minus 105, layer in the idea that the private sector was okay at 52. The key that I told myself I was going to look at, I said, Steve, don't get bogged down by all the numbers, focus on one thing. The unemployment rate.
Yes.
Unemployment rate, the reason why we want to focus on that is where the key issue of labor supply and labor demand meet, and you get the ratio that tells you what's going on. And that number ticking up is a little bit weaker than expected. However, when I take the first part of what I talked about, which is the federal government side, I'm wondering how much of that little uptick in there may have come from the federal government side of people who want a job but did not find one after being fully and officially laid off in the month of October and into November. So it's a little bit weaker. I tried to ask Powell at the last conference, Mr. Chairman, are you essentially prepared for weakness? And he said, well positioned. So I don't know if this number is within the tolerance of, hey, we're good. We cut already a couple times, 3 times. We're well positioned now for that weakness that he expected. Remember, the chair sat there at the podium and said, it could be minus, another 60,000 after we get done with revision. So these numbers are okay in the private sector. We have to wait to see how the private sector absorbs the excess labor that has been laid off from the federal level. I'm not saying that labor was excess, they were just laid off and now they're excess.
Right, a lot more still to go through. Mike Santoli is standing by. Mike, as Rick had mentioned, we are seeing a pullback in yields pretty much across the curve. We also see a slight bit higher, and actually we're kind of flat on the futures front.
Yeah, with the reflex, listen, it was just a little bit of a firming up of the equity index futures. It feels like the first impression is it's one of the more palatable ways you can get the unemployment rate going to 4.6%, which is you still have net private sector job creation. It probably has dovish implications, at least on the margins, for the Fed. And I think the market has been locked into this rotation into economically sensitive parts of this market. It was even evident yesterday, even as we kind of have pressure on the AI CapEx trade that drives the indexes. So there's nothing in these numbers that I think is going to move the market really strongly off that spot, especially because there's such a strong confidence that we're going to get some kind of a economic reacceleration into the first part of next year with some of the tax stimulus hitting and all the rest of it. So an acceptable number. I don't think it's kind of game changing. You don't want to see weakness kind of continue to kind of roll through that unemployment rate at this point. But for now, not something that requires too much alarm. And so that you mentioned the benign, Treasury market response as well.
Yep, and we're back pretty much almost where we were at the beginning of this on the Treasury front, 4.17 on the 10-year. Let's expand our panel right now. Joining us here on set, Allison Schrager, Senior Fellow at the Manhattan Institute, and Natasha Sarin, a Yale Law School professor, president and co-founder of the Budget Lab. She's also a former Biden administration Treasury official. Allison, let's start off with you. What do you make of the numbers? Does it change anything? Does it change your view of what the Fed is going to be doing?
Not really. I mean, I think we keep getting these reports where you sort of have a labor market and, still sort of worrying inflation. And, if you're looking for an excuse to cut further, you could probably find it by saying the labor market's weak and you're going to do something about it. What jumps out at me is we still have very strong labor growth, which suggests inflation is not going to go well below 2. I think when you look at the summary of economic projections, you hear Fed officials, they seem to think that anyway, they're really like, at the very least, ending QT, maybe we have more rate cuts next year, seem to still think that inflation is going to magically go back to 2%. And I think this is just another data point that suggests that's just not magically happening.
And I think I agree with what Allison is saying, but I think there's a couple of pieces here that we sort of seem to have gotten ahead of ourselves with. One is that it looks like these 60,000, 50,000 jobs growth numbers are just kind of the new normal. And that's a pretty interesting fact. When you look just a year ago, you were seeing 200,000 private sector job growth in a way that's pretty striking, and it tells you something about there's both the labor supply side here that's pretty important, that in a world where so much immigration restriction is happening, you're starting to see that have real impacts with respect to the labor market. And also to what Steve was saying about where Powell is, I mean, he mentioned that a bunch of the revisions, he's a little bit nervous that the BLS doesn't really have the capacity in real time to be able to tell us what's happening with respect to business closures and business openings. And so some of these labor market numbers, which are already looking a little bit weak, might actually end up being revised down and might be inflated, which makes the Fed's job pretty difficult in a moment where we're also pursuing the most inflationary policies of our lifetimes with these tariffs. So I think it's a bit of a difficult balancing act.
It's actually going to be an interesting experiment, not necessarily good for humanity, but interesting for economists. There's always been this sort of debate, and economists were quite strident that more immigration boosts wages for everyone, labor fallacy, all this stuff. And now we actually have a big pullback in immigration. What's going to happen with wages?
Hey, is Rick still there? Rick, I'm just taking a quick look at the immediate reaction in the Fed funds market, and I do not see the market reacting in a way that suggests this is a game changer for their expectation on the Fed. I'll give you some numbers here. I've got a 22% probability of a rate cut in January. That's actually down. It's bouncing around, obviously. And then 48 or 49% for the rate cut in March, and I can tell you what that was going into this. It was 47, 48. So this is not seen, despite the increase in the unemployment rate, which was the thing that I thought would be what would motivate the market most to rethink the Fed outlook, is not doing so.
But I'll tell you what, I think the yield curve is where I would pay more attention.
Yeah.
I think the Fed funds contracts at this point, I think there's a lot of haziness in the clarity that traders are looking through. It's a bit foggy. But when you look at the yield curve steepening the way it did, it's actually rather incredible. The 10-year is exactly where it was before the number, and before interest rates dropped down to 4.13, it's right back. But the 2-year dropped 5 basis points, and it's a little stodgy coming back. So here's the way I would look at it. I do think these numbers are on the weak side. It's not horribly weak. The labor market, at least based on these data points, is in a downward trend. And I think that's reflected in a 2-year yield dropping. But try to explain the long end. It's long end because there's something better on the horizon with the economy, as we're starting to see with corporations when they tell us their tax bill is moving lower, more money in their pockets and revenue. These are good things for the economy. However, the other side of the mountain is that long rates are very stubborn here. And it's no matter where you look around the globe, we see the same dynamic. And I really think that is what the yield curve is telling us. And that's a little bit disturbing here, considering we're going to be competing with corporate America for the debt that's going to be building the AI infrastructure.
I think that's an excellent analysis. Rick, is that just one of a series of holiday ties you have, or is that the holiday tie?
Oh, it's one of a series. Get ready
Great.
for the next week and a half or so.
Let me just ask here. We used to have an economy where we would get a blip in the unemployment rate, and it would come down the next month, and the interpretation was people are coming into the workforce, and they're looking for jobs or get released, and they find them the next month. Is that still this economy? Would you give the unemployment rate a mulligan here and say they're going to come back next month, and this number could be on the way back down again?
I'm curious what Allison thinks. I kind of think we're in this like no hire, no fire moment in the economy, or there's just a lot of uncertainty. There's uncertainty about where tariffs are going to land. There's uncertainty about what's going to happen with respect to AI that you all have been talking about all morning and many other mornings beyond this one. And so I think what that means is that there's a bit of like reticence about how best, both from a corporate perspective, to think about hiring trajectories, but also as individuals who are in the labor market, how should they think about making some of these adjustments and moving on to new roles in a moment where there is just a lot of economic uncertainty.
Yeah, although we might sort of have sort of a bit of a boost next year. I mean, one, we have hopefully some certainty around tariffs. We just never knew what they were going to be because there's so much flux, so hopefully that calms down. And also we have a lot of the sort of corporate tax credits finally coming along from Big Beautiful Bill. So we might see a bit of a sort of uptick in hiring hopefully next year as sort of all these sort of expansionary policy take shape, and hopefully we have some more certainty around the tariffs.
So like with the Big Beautiful Bill, I mean, only a very tiny sliver of it was really about those types of sort of corporate boosts. The rest of it is just deficit finance tax cuts that go disproportionately.
Yeah, the depreciation.
No, but there's this depreciation thing that, by the way, Treasury tells me last week that they have not even put out the rules for it yet.
Yeah.
So it may be that companies have yet to really take advantage of a tax cut that they're not sure what the rules are around it, so they're waiting for the IRS to put that out. Put it this way, for what it's worth, there's a belief at Treasury that the tax advantage or the tax benefit is not fully appreciated among companies in the C-suite, and that there's a avalanche perhaps of investment coming next year.
And they've been anticipating this sort of for quite some time, so I'm a little bit skeptical and worry a bit that some of that is sort of wish casting around the guy.
But it was very effective in TGCA. Like, in restoring the full depreciation, really could have a boost like we had back then.
Has a huge boost. I just worry that all of this is happening in a moment of tremendous uncertainty and really high deficits.
The other thing, though, real
Yes.
quickly, is the tax refunds next year, which Allison also alluded to. That's something that's going to help out. Could lead to some hiring. We did see, by the way, I was worried about the November retail hiring because seasonals expect a big number, and we heard from companies they weren't hiring a lot of people this season. But that number, the retail trade number, was up by 6,000. So I was kind of surprised to see that. Maybe a miscounting there, whatever. But retail trade did better than I thought it would.
Mike Santilli, I want to go to you for some last words here in terms of the backdrop for the equity markets here. We're bounced back pretty much to where we were before.
Yeah, and I think that over the course of the day and the next few days, actually, I think we're going to have to test how much of that anticipated early 2026 economic pickup has been bought and paid for by this, again, rotation into those companies that would already benefit from it. So to me, that's what we're running into. I was just looking, banks are still bidding pretty well. You still have industrials performing fine. So we'll just see if there's any unwind of that rotation that we've been, basically in all month.
Okay.
I think the message today is to the private sector, hire a federal worker who was laid off, and then we'll be okay. Because the net, over October, November is negative when you add the two together, but substantially that's government layoffs.
All right. Rick, Steve, Mike, Allison, and Natasha, thanks so much.
Okay. Coming up next, what is ahead for the Fed? We're going to discuss it with former Atlanta Fed President Dennis Lockhart. He's going to join us with reaction to the data, what it means for the rate path. Maybe we'll talk about the Kevins after this. us right now to talk about how today's jobs number impacts the Fed's rate plan. Former Atlanta Fed President Dennis Lockhart, he's a professor at Georgia Tech. Good morning to you, sir. You saw the numbers. I don't know how much you take away from them at this point, how much you think even the Fed is looking at those numbers in terms of how it's going to impact their plans for 26 and beyond.
Well, I agree with much of the commentary we heard earlier. I don't think this report changes much, quite frankly. The committee is divided, but the body language I picked up from the press conference and some of the communication was that the Fed would prefer to pause for a while, wait and see how the economy evolves. And I don't think this report changes that. So the low probability that Steve pointed out earlier of a January cut, to me, is in line with reasonable expectations.
Well, what about the rest of the year?
Rest of the year remains to be seen. Of course, we have a change of chair, which means a change of leadership. So, much could change with that. But if you just take a look at it from the economic point of view, a good part of the committee is expecting one or fewer. I think the number is 11 of the 19 in their projections last week, one or fewer cuts in 2026. So it's conceivable we see quite a lengthy pause here to see how this economy moves.
Dennis, can you just walk us through, I mean, since you've been in the room, bring us inside the room in terms of, you said that you think things could change if there's a different chairman. How does that work in practice in the sense that we've seen the dissension on the board, we've seen it in the dot plots and everything else. You get a different person in there, but it's only one person. How does that change the dynamic fundamentally, if it does?
Well, I'll give you a couple answers. One is it is a consensus process, so the chair has to work with everyone else, 18 other participants on the committee, to come to a consensus that can be acted upon in policy terms. And that requires a certain style, and the new chair will, we hope, earn the respect of the committee. The second part of my answer is when it's a very close call, a chair who has earned respect gets the benefit of the doubt. The preference of the chair usually will prevail. The chair is only one vote and only one person around the table, but the chair can exert leadership when the situation is sort of indecisive.
Do you have a take? We were discussing all morning the Kevins, if you will, Kevin Warsh and Kevin Hassett. Kevin Hassett, by the way, is going to be on the broadcast just about, 25 minutes from now on Squawk on the Street. The betting markets now say that Kevin Warsh may get this role.
Well, they're both highly qualified, and I think they'd both be fine chairs. I suspect that Treasury Secretary Bessent is getting feedback from some of his friends on Wall Street that Kevin Hassett may be too close to the president and therefore would be interpreted as someone who's going to undermine Fed independence, whereas Kevin Warsh is somewhat hawkish in terms of inflation and is likely to be a bit more independent. That's the way I would read it, but it's going to boil down to a trust factor on the part of the president. And, I still would think Kevin Hassett is more known to the president than the other Kevin, but we'll see.
What did you make of Kevin Hassett's comments over the weekend that he would be prepared to meet with the president regularly and discuss issues about interest rates and the like?
Well, it's a deviation from the past practice. Fed chairs don't meet with the president very frequently, and presidents don't call up the Fed chair very frequently, at least in recent history. So I'm not terribly comfortable with that idea. When you meet with the president of the United States, there's no doubt there's going to be influence. and that influence could be reflected in preferences as stated in the meeting. So, to me, it's not a very comfortable situation.
Yeah, by the way, is that very different than the meetings that the Fed chair would have with the Treasury Secretary, in your mind?
Quite different, I think. As I understand it, the Treasury Secretary and the Fed chair meet weekly, and they talk about the economy. The Treasury Secretary doesn't really intrude on monetary policy, and certainly the Fed chair doesn't intrude on fiscal policy. They talk about the economy to compare notes. It's not necessarily coordination, it's just comparing notes. And that's a very frequent thing, and they're the two most significant economic policymakers in the country, so I think that's a perfectly healthy thing to do.
Dennis, I'm just curious how you interpret, how you view the American people's plight in terms of affordability. We had a retail analyst on earlier saying, people are fundamentally strong but sentimentally weak. And that seems to go through, many layers in terms of demographics. And at the lower end, people feel weak and they are weak. How do you sort of extrapolate that in terms of what we're seeing in the data and what people are actually feeling?
Well, people in general react very strongly to some of their retail purchases and how much those things cost. Sometimes it's even a bit of an overreaction. No individual, of course, experiences the inflation rate per se. They experience what they see when they go to the grocery store, or very importantly, the gasoline pump. And so those relatively few prices influence their sentiment, and I think you're seeing that in the consumer confidence and consumer sentiment numbers. The data show a little bit different picture, but believe me, individuals are not concerned with the macro data. They're concerned with their own spending power.
Dennis, I want to thank you. Appreciate it very, very much. And as we mentioned before, Kevin Hassett's going to be with the gang on Squawk on the Street in just a little bit. And then tomorrow, you don't want to miss, Steve Leisman is going to be with Fed Governor Christopher Waller at the Yale CEO Summit. That interview is at 8:15 right here on Squawk Box. And another name that has been mentioned as a candidate for the Fed chair role. We're coming right back. Breaking out Squawk Box this morning, the November jobs report was plus 64,000. That's better than the 45,000 expected. The unemployment rate hitting 4.6%, slightly higher than estimates. The October number showing a sharp drop in government jobs during the shutdown, but an increase in private sector jobs. Meantime, Bank of America naming NVIDIA its top pick for 2026, that is, with a price target of $275. Broadcom also on the bank's top picks list with a target of $500. NVIDIA is 16% from the October high right now. Broadcom down 18% from the high that it hit last week. In the meantime, Kraft Heinz has named a new CEO to the company that's going to start in January. The CEO recently led Kellogg through a split and became the CEO of Kellanova. Kraft Heinz becoming two companies in the new year. I want to thank Melissa Lee. Big interview with the Kevin, one of the Kevins, in just a moment. We're going to watch for that. Make sure you join us tomorrow. Squawk on the Street begins right now.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. Playing some catch up with the jobs data today. October jobs down 105K, but November is a slight beat, up 64K. Unemployment, though, rises to 4.6. That's a fresh 4-year high. 10-year pretty steady around 4.18. Our roadmap begins with this delayed November employment jobs number, topping expectations. As we said, 64,000 jobs last month. National Economic Council Chair Kevin Hassett will join us first on CNBC in a few moments with his reaction and, of course, the race for the next Fed chief.
Plus, Ford is going to record almost $20 billion in special charges. This as it pulls back from a lot of its plans to expand its manufacturing of EVs. The stock is higher in the pre-market. Speaking of automakers, Tesla shares hitting what is the highest level they've seen all year. And that, of course, is fueling Elon Musk's wealth, now measured at over $600 billion. That's never been seen in the 4 billion year history. I don't know. Go on with it.
Let's begin, though, with market reaction to the delayed jobs data, Jim. Once again, it's basically education and health services that are doing the lion's share of the work.
Yeah, we don't want that. That's the old days. I wish there'd be more manufacturing. I honestly think, the interesting piece today about Michael Intrater.
Yes.
In which you were quoted, or at least referenced.
It was quoted, I think, during an interview we conducted.
Yes.
Carl. So it's nice to know that we don't count at all.
You know, you drove right down to the heart of what I was going to say. It was so good. You were like a heat-seeking missile. I just think that one of the problems that I think Michael would tell you is we don't have, there's a mismatch. Like, we don't have the people who can do those jobs. They can't pour the concrete, they don't know how to put the rebar in, they don't know how to move the racks in, but we do have people who can do healthcare. And it worries me, because there's no change in that. It's not like we're putting so many people to work. And Michael Intrater sitting down with lots of good people trying to change the structure. But I would say, if I were President Trump, and I think we get to be a little bit like President Trump today, setup of our show, I'd say 64,000 jobs, 340,000 million people. Are you kidding me? That's ridiculous. We got triple that.
How do we do that?
1% raise.
1%. So you're now in agreement with the president?
I told you I was going to channel.
Oh, I see. Right.
That's what we have to do. You see, we can actually just play it straight and not get the right answer. Well, Mr. Hassel, would you lower rates? Well, I don't know the club side. We have to be a little more creative than that as journalists. And I'm saying that out of the time when I was a judge in The Apprentice, you don't just say, no, I'm sorry, just try that's not going to fly. You don't do that's not going to fly because that doesn't fly.
All right, but specific to the fundamentals here of this report, 4.6% unemployment rate, obviously October, but I'm not sure how much that counts. Right. What should the market reaction be, Jim?
Flat. I just think that there's nothing here that makes it feel like it was so different from what we were expecting. Although I do think that mosaic that you mentioned is disappointing because healthcare is more of a tax on the system. Government requires a tax on the system. I want to see manufacturing go up because this is the problem with where's the reshoring. You know, I had Lindy on yesterday. It's industrial gas, many different industrial gas are used in every part of the economy.
Yes.
And he said, "Where's the reshoring?"
It hasn't happened yet.
Right? No, it hasn't happened.
We have collected a decent amount in tariffs in terms of at least helping to reduce the deficit, I suppose. But the actual manufacturing boom
yet to occur.
Although it's interesting that people are now starting to recommend stocks like Gap on the idea that we're going to get the Supreme Court to go against the president. Well, I mean, you want to do that? You want to get that?
You're talking now about obviously the very important ruling on tariffs, whether he has the power actually under the Emergency Act that he's using.
Yeah, and now the Court of International Trade ruling that if in fact SCOTUS rules against IEPA, they can clear the way for people to sue for refunds, which some argue will be one of the biggest upside risks to the market in 26.
Well, look, all I know about this stuff is that there will be a president who will be very enraged, very angry, and do something new that makes it so that the rates go, I don't know, up and stocks go up. That's the holy grail. Remember, he's not focused on rates as much as he is on stocks. Long rates, because you can't control long rates. That's the problem. You can't talk to the long run.
No, you can't. And the 10 years once again above, I think it's above 4.1 right now.
Oh, yeah. We're closer to 4.2 again.
Well, we know that, let's get out of the vacuum. That's a great rate. It's just not a great rate versus that 3% rate that made it so no one wants to move. I have a 3% rate. I look at it every day, and I say, wow.
I've got a great one, but it comes up less than a year from now. It adjusts.
Oh, you
I know. Yeah. Something like 2.35, something crazy. Back from 7 years ago, whatever that was.
What are you going to do?
I don't know.
Try to get a second job.
I don't know what I'm going to do. I know.
Person's going to get a second job over here.
A person stock's going to bail me out, I'm sure. It's going to trade something like 10 times EBITDA.
Don't go to that 125th slipper. Stop.
Don't worry about the 125th.
Oh, yeah.
Stop worrying about that. Just worry about the multiple.
So the people at home where stock sells at 4 times earnings, they get this thing called Versant, and they think, all right, how do I sell that?
I'm going to talk about Comcast a little later.
Actually, yeah, there's some good stuff on it today.
No, I'm going to talk about it a little.
You have something.
I may.
I think it's a good tease.
Yeah,
To your point, though, Jim, about the macro, Besson on the tape today, he does see inflation coming down substantially in the first half. The tax refund season might be somewhere in the neighborhood of $100 billion to $150 billion.
We got this here. If you want to have a child, you get the Trump account. And look, I think inflation has peaked, except for cattle. When someone look at oil, I mean, oil goes down. I mean, oil is having a crash. But no, we don't talk about it. Why don't we talk about it?
We talk about it all the time.
We talk about it every day. What are you talking about?
On the 9. You talk about it on the 10.
We talk about it here. Wow, 55.
Well, thank you. There you go. See, he's finally waking up.
By the way, that
look
is...
at the commodities. That's all down except for steers. Because of how long those darn things take that. Babies.
Yeah, but that does have a deflationary impact. That is, what's that today? Is that Ukraine? What's...
I mean, there's obviously the Ukraine talks, some progress on security guarantees. The China data this week has not been good. That had something to do with it. This is going to be the worst year for crude, for WTI, since 18, and at this point, the lowest level since May 5th.
Well, it is so bullish, and I think that we have to recognize that that's a bill that everybody pays. Natural gas seems to have peaked out. I know the supermarket's more expensive. We haven't been able to get that down. And I think that if I were the president, that's what I'd be focused on. But he's not. He's not focused on that.
This is not a function, by the way, of an increase in production in the United States, which
It's
is
been
more or less
steady.
It's been steady.
It's been steady. I thought it would go down.
Yeah.
You know, we're going to take a break, David, because we have to get away.
Where are we going? We have to get away?
No, I never give those teases. What do I do now?
I don't know.
What do I
You're
say?
out there in the...
Let me return.
Yeah.
You say,
Yeah, when you come back, you can go with that.
In a moment.
People say that stuff all the time. And I
Don't
say,
go anywhere.
Come back.
Don't change.
No flipping.
Big interview coming up.
When we return, NBC Director Kevin Hassett on everything we just talked about, the jobs number, energy, inflation, the Fed, and a lot more. Take a look at the pre-market. More Squawk on the Street when we come back. Don't go anywhere. The U.S. adding 64,000 jobs in November as the delayed government data tops forecast, but unemployment did hit this fresh 4-year high. Joining us this morning with some reaction first from the White House is the National Economic Council Director, Kevin Hassett. Kevin, good morning. Good to have you.
It's great to be here.
A lot of information that the street's trying to absorb. How do you characterize both October and November?
Yeah, I think it's best to sort of combine the two. And if you do that, then you're looking at private sector gains of about 120,000, maybe 121. And then we dropped about 160,000 government workers, federal government workers, who are the people who took the buyout that we began that program in the spring and gave people to the fall to step aside. And so I think that from the private sector point of view, it's just about what we've been getting all year. It's solid upward trajectory. The president's private sector job creation since he took office about 700,000 jobs. And so I think that, like the vast majority of the Bloomberg people polled were surprised on the upside, and I think that we were surprised kind of not at all. We think it's about on trend is what's happening.
All right, so Kevin, Jim Cramer, I understand exactly what you said, but I want to be like the president. 64,000 people in a country of 347 million people. He calls you up for dinner, you come over for dinner, and he says, hey, listen, that's unacceptable. I need rates down to 1%. I need them now because we got to put more people to work. What do you say to him?
Well, my conversations with the president are private. I spent about an hour and a half at the Oval with him yesterday going over a whole number of topics, including today's jobs numbers. The bottom line is that the president thinks that interest rates can be lower, and I think there are a lot of people that share that point of view. And the reason they can be lower is not just mumbo jumbo. It's because instead of getting growth out of a big demand push, printing money, having Congress mail checks to people, we've got a supply push. We've got dozens and dozens of new factory plant openings. We've got huge construction employment in these numbers, and so we've got a supply side shock just related to the big beautiful bill and the trade policy. And when that happens, it puts downward pressure on prices and upward pressure on growth, and that's what we're seeing. And so he's right, and I think that a lot of people agree that there's plenty of room for the Fed to lower rates. And frankly, if you look at central banks around the world, they're looking at the same kind of things that I'm talking about. And so the Fed's rates now seem a little bit out of touch with the rest of the world.
Would you give us a pledge right here and take it down 150 basis points? Right here, right now. Why not say, if I get the job, that's what I'm going to do?
Oh, well, I think obviously if I were there, that I'd have to negotiate with the rest of the committee members and see what kind of a consensus could be driven. But I think that if you do really careful economic analysis and think about the difference between supply and demand shocks, then you can see that there's lots of room for lower rates. And this is a huge mistake that Janet Yellen's had made in the past, where they said that the Tax Cuts and Jobs Act was going to be inflationary. You go back and look, we got 3% growth and 1% inflation after a big supply side shock, and I think that's what can happen again.
We were talking a bit earlier on the show, Kevin, about the Supreme Court case involving IEPA. Howard obviously issued tariffs. I'm just curious as to how you're thinking about that. Should that not go the administration's way, given the importance it's had, as you've pointed out, in potentially reducing the deficit and obviously raising revenue?
Yeah, well, first of all, the deficit news has been really fantastic. And it's kind of funny because for the longest time, at least like the Democratic think tanks, they'd be telling you the only thing that matters is the deficit. Well, if you look at what's happened so far this year, year over year, by the calendar year, we're going to see a deficit reduction of about $600 billion. Multiply that by 10 and let there be a little growth, you're looking at 7 or 8 trillion in deficit reduction over the decade because of the policies we've adopted this year. About 1/3 spending cuts, 1/3 tariff revenue, and 1/3 Laffer curve-like growth from the tax cuts. And so with that big deficit reduction, then there's lots and lots of room for inflation to go down and so on. And so my view is that the deficit reduction is a key to the health of the economy, to lower rates. And if the Supreme Court were to do something about that, we've got backup plans, but it would be disruptive for a short while. Bottom line, though, is that we're highly confident that they won't do that, because in the end, there are two questions before them. One, is it an emergency, and how is it not an emergency if fentanyl's killing hundreds of thousands of people, and if the trade deficit is making towns into ghost towns? And then the second thing is, does the language that says that we have the authority to regulate trade mean that we can use tariffs? But how else are you going to regulate trade if not with tariffs? Maybe you would say, oh, you would use quotas, but if you take quotas and auction them, then that's like a tariff. So it feels like the Supreme Court won't have anything to point to toss out the case. We're pretty confident that it's going to go the way we want, but if it doesn't, we have backup plans.
You do, yeah. I mean, because there is a cogent argument that the other side has made in terms of some of the arguments your side has made that says, no, these are not emergency powers. So what are these backup plans? How much can we assume that you're going to be able to maintain the same rate, let's call it, of revenue coming in as a result of tariff-related things, if in fact it's deemed illegal in terms of the powers that he's using right now?
Right, well, there are things called 232s and things called 301s. And we have all these specific agreements with specific countries, which we could take those one by one without, like, if a country agrees to pay us a tariff, then that's not necessarily something that requires our IEPA authority to impose it. And so we've got deals, we've got 232s, we've got 301s. If we have to, we could put it all back together, but we don't think we're going to have to.
All right, so Kevin, we know that the president seemed to be uncomfortable with the way that he had to deal with Jay Powell, and Jay Powell being, listen, I'm very separate, I'm taking the answers. I think the president's kind of a head coach, and if you got that job, you're a player. Now, if the head coach says, listen, you're going to have to go this way, and this way is to take rates down 200 basis points right now. Are you going to tell him, no, coach, I'm not going to do that?
You know, the bottom line is that I talked to the president. When he says we could do this or we could do that, then he always has a reason, and you know that, Jim. You talk to him too. And so the point is that if he's got a good reason, and if I were there and I found that I agreed with the reason, then I would present it to the others and see what they think. But the Federal Reserve's independence is really, really important, and the voices of the other people at the FOMC, they're important too. And so the way you've got to drive interest rate movements is with consensus based on the facts and the data. And I would say that that's something that has been not really working so well for the Fed over the last few years. Like, what are the facts? So when they made a mistake on this or that, then why did they make that mistake? What model got it wrong? That's the kind of stuff that becomes convincing over time because you actually have a track record of getting things right, and when you get things wrong, you explain why and fix it. And so that's the way it moves forward. But the president is a seasoned observer of the economy, and if he has a good point, then I'm sure others will recognize it as such.
We were just talking, Kevin, about onshoring and waiting for more progress on that front. Manufacturing jobs in November, that's 7 straight monthly declines. Do you expect that to reverse in 26?
Yeah, it's definitely what we're seeing is you saw the increase in construction. We've been tracking groundbreakings of all these factories that have come forward from both the trade deals of like the drug companies onshoring production for national security reasons. And we're up to around 30 groundbreakings in September, and all of those are going to create a lot of jobs moving into next year. So yeah, I think that we're highly bullish on things going forward. And don't forget that the government shutdown is a time of heightened economic uncertainty where a lot of people just sort of hold off on hiring, hold off on this and that until they see that we're actually going to get the government up and running again. And so I think that the data that we're looking at now is partly colored by the government shutdown, and the bounce back from that is something that I think all of the observers should expect.
The Commerce Secretary's been on with us lately, suggesting maybe 6% GDP in 26. The president the other day in a meeting said, why can't there be 20% or 25% GDP growth? What is the street supposed to do with that kind of number?
As an abstract thought, I don't know what the highest growth ever is, but I doubt it made it to 20%. The bottom line is that if you go bottom up and you say, what's productivity growth right now? I think because of AI, it's maybe 2.5% to 3%. What's capital stock growth right now? It's probably around 1%. What are we getting out of labor? It's probably around 0.5% to 1%. So you're looking at the sort of supply side of GDP going into next year, telling us that we need to have a number that's north of 4. And so that's about as far as I think that I'm willing to go.
You mentioned AI. Obviously, the economy is a beneficiary of all those data centers being built to power it. But there is this existential question, Kevin, that I'm sure you have to be thinking about, which is what is the impact going to be on employment? Even if we ultimately end up longer term with more jobs, there could be a very significant dislocation in the labor force. How do you think about the impact of AI when it comes to the introduction of efficiencies that ultimately seemingly will replace many human workers, at least over some period of time?
Right. Well, what we're seeing right now, right, is that the workers who are trained with AI have increased their productivity a lot, which gives us that productivity growth I was talking about, and they've also increased their wages a lot. You saw there was really a blockbuster wage growth in this employment report, and so that's a big positive. And the way I think about that happening is that every worker has like a really great AI coach standing next to them saying, hey, do it this way, do it that way, disregard the advice of Kramer, and then wow, their productivity goes way up. But then over time, then there's a question of if I've got all these workers that are really productive, then maybe I don't have to hire a new guy because the guys who are here are already producing more than is demanded. But in equilibrium, what happens is GDP goes up, incomes go up, demand goes up, and we find positions for people who maybe move to a different factory or a different business that offers a different product. But that's that's the way it happens. Like electricity was positive for the economy, the internal combustion engine was positive for the economy, the computer was positive for the economy, and AI will be positive for the economy, and it won't cause disruption.
You don't think it'll cause any disruption shorter term, though? I guess that's the question. And again, we don't know the longer term because when we have intelligence that exceeds our own, Kevin, I think all bets are off to a certain extent. But you're not concerned at all about even a short-term dislocation? I mean, the buggy whip manufacturers certainly had to find something else to do for a period of time.
Yeah,
they probably were unemployed.
No, but think about it this way: the buggy whip guy had to find another job, and how did he do it? He maybe had a newspaper with line ads in the back, but now we've got a person who might have to find a new job who can search throughout the whole country on all these websites that tell you where the jobs are, and the number of job openings in the country is in the millions and millions. And so moving people from one job to another has never been easier and faster, and AI and the computer makes that even just more efficient a process.
Kevin, earlier you attributed a prompt to me. I think that was what's called a hallucination. I know that we have a bit of I think we have an emergency versus the Chinese. I think the Chinese are starting to get ahead of us when it comes to AI. I think that we don't have enough people that are building data centers. We don't have enough people, we don't have enough power. Can we do something, an emergency power, to catch up and pass the Chinese? Not like we had to do with Sputnik and Russia, because I think we're falling behind, and it's our responsibility to pull ahead.
Right, well, I don't think we're falling behind, and we definitely have the president and his team has put together a plan to rapidly accelerate data centers, the power production that we need to power those data centers, to get rid of the sort of red tape that makes it so the permits won't let you build the power jet.
Okay. I wonder if they took this AI a little bit too serious. Good morning, retail traders. It's Washboardjim with a sneaky snake trading strategy where I talk about chart patterns, moving averages, and being in the now. A little pop this morning. We'll see how long that lasts.
Ten-year yield dipping as well. So we are seeing some reaction to the data this morning with the retail sales as well coming in flat. Interestingly, some of the reports have been pointing out that if you minus autos, that was actually the drag there. It would have actually ticked up slightly higher there. So something to keep in mind. Also, as Nicole touched on,
Peace, Sammy.
Tracking very much developments as part of the peace talks and negotiations that are going on right now. Trying to potentially bring an end to the war in Ukraine. So we're seeing quite a significant move, particularly in oil markets. That is sitting at about $55 a barrel right now. So we are seeing lows and not seen since earlier this year around May. So something to keep an eye on, because some of the thinking here is the expectation that could mean more Russian volumes are hitting the market, adding to some of the oversupply concerns. And then also, of course, we continue to track the Chinese data, which didn't look good, which continues to hit the oil market as well. But we did see, as far as European stocks, some of the defense names, some of the energy names are selling off on some of that news as well. Let's see if we see any follow through in this market today. But I think a lot of attention very much is on this jobs data, Nicole. And then obviously we're going to be getting more information on the economy as far as an update with inflation also down on Thursday. And then, of course, we continue to track the trickle in at the closing sort of, I suppose, ceremony of the earnings season. And that is, of course, getting Lennar earnings later today. So a little bit of a snapshot of the housing market too.
Yeah, you and Marla, you'll have that later on the show. We're looking at some of these EVs. Yesterday, Tesla was shining, as Dan Rex was saying, the monster year ahead, and Mizuho now has more.
Mizuho's got a really interesting note out this morning, actually, Nicole. They've called it analog, and obviously there's been a lot of talk about the analog chips exposed to the auto industry. We were talking about Texas Instruments yesterday, but they've actually adjusted some of the price targets for Tesla now and GM. Now, let me just give you the headline. They are looking at a price target now.
Here we go.
On Tesla at $530. They've got an outperform rating there, and GM looking at $90 with an outperform rating as well. This comes even as their key points do point to a potential headwind in 2026 on slowing basically EV sales growth here. They also point to some of the EV model call-offs. I know that Diane is going to be talking about some of that, and the launch cancellations accelerating in the US. What they believe here is going to be the benefit for GM is the internal combustion engine improvements here, and also Tesla very much benefiting from robo-taxis and the FSD in the future. That comes 2027. So that's the reason behind some of the price adjustments here, even with EVs coming off.
Yeah, look, a lot of people who wanted an EV got one already. We'll have to wait and see. Sam Bott, it's great to see you, folks. The opening bell is right now.
interesting. is going on here? Here comes the pullback. Jimmy's waiting. Huh. IWM sits at 200. Oh, this is looking juicy. Wonder what kind of day we're going to have. Can you hear me, Randy? Okay. What kind of day are we going to have?
They have to get rid of their waste.
Yeah.
So we like that inelastic pricing model, but the company has always been very good at wringing costs.
Well, well. Jimmy ain't took a trade yet. PX. There goes a little bit of push. The video bounced back up. What's going on?
That could actually be possible if you do see any type of flush 67.20 to the downside. So what you are seeing from the options positioning standpoint is actually a little bit more volatility being priced in, and the VIX is kind of letting us know, at least for right now, we are seeing that kind of re-rate higher. But Nicole, under the surface, keep your eye out on this. The semiconductors, or the SOX index, if you will, is actually hitting or just hit the 50-day moving average and is now bouncing above that moving average. Usually, if you go back the last year or so, we do not see a flush below that 50-day moving average for the SOX, at least on the first attempt after making a new all-time high. So it's bouncing exactly where we need it to bounce, and that's probably why you are seeing maybe some buyers kind of stepping in some parts of the market for the S&P 500 in order to hold the 6,800 level. Keep your eye out also on the 50-day moving average for the S&P 500. I believe that's around 67, 64 if I'm not mistaken. That could also be a key buy area. So we are kind of breaking the consolidation range. We are trying to hold here, but if we get a flush, we get down to that around 67.20-ish area here, we're going to be starting to hit some key areas of support when you're looking across multiple sectors, and that could be an opportunity for buyers to try to step in and maybe try to buy this dip, if you will.
It's interesting because you have Wells Fargo joining in some of the forecasters for 2026 and saying setting projections of 7,400 to 7,600 next year. The headline of the article is why the SPY, Triple Qs, and SMH could be big ETF winners in 2026. You're talking about the SOX. Final thoughts.
Yeah, I mean, if you're kind of looking at a lot of those analyst expectations or the price targets, Nicole, we also have to be mindful. A lot of them do fail, and when I say fail, doesn't mean that they don't hit. They actually do, market does meet and exceed those expectations. So if that trend is going to continue, a lot of these price targets might be exceeded for next year, and they might be right. I mean, at the end of the day, we still have an AI theme taking place here. We have the technology stock, or ETF up right now, the XLK, and you can also see kind of a fundamental breakdown, at least for now, but we are holding that 50-day moving average.
Boom!
100-day moving, or the 100-day moving average, which is in orange. Once again, a key buy area for this market potentially here. So all is not lost. This has been a orderly sell-off, Nicole, and once we start seeing an outsized move of volatility for the technology sector, communication services, as well as the semiconductor sector, once we have that outsized a little bit more than what the S&P 500 is pricing in when you're looking at implied volatility, that usually has been that buy the dip opportunity for this market. We're just making our way to try to recorrect that vol dispersion right now.
Yeah, and you know what's interesting too? I'm seeing the market sort of moving as, you know, the 10-year was at 417, went up to 419, came down 418. It's moving around, and I think it's also maybe moving stocks a bit too with each tick. So people are always keeping an eye on those rates too. Kevin Green, great to see you. Thank you so much, always, Kevin. Now we speak to both Alex Coffey, this is our market meetup panel, Alex Coffey, Manager of Trading Services, Charles Schwab, and Dan Grant, Senior Specialist Retail Trading. Charles Schwab, it's good to see you both. Alex, some of your thoughts on the action today.
Yeah, I mean, action-packed last like 5-10 minutes or so. We got the S&P global PMIs. They all came in a little bit light, whether it was manufacturing, services, of course. If you miss on services and manufacturing, composite misses as well. But this seems to be a story of a intraday rally brewing in Meta, Broadcom, and NVIDIA, as those three names are really starting to get some price action to the upside here, contributing about 5.5, 6 points to the S&P 500, which is working its way back towards unchanged here in real time, Nicole. Also, the NASDAQ was down over 100 when we sat down, 5 or so minutes ago. It's now up 30 points. So a lot of flashing on the screen right now, a lot of action taking place here in this first hour of trading.
I'm seeing some of the best performers, Dell and Seagate, Southwest, just to name a few. And I like that you brought some of those names, Meta, Broadcom, NVIDIA, Expedia is a winner too. How about you? What do you think, Dan Grant?
Hey, thanks for having me, Nicole. Hey, I was kind of looking at rate side when the numbers came out this morning that we've been having a data desert over the last few months, and all of a sudden we're started getting all that data, and the market's reacting to it. We had rates going crashing down before the market opened here, and now they're almost back to unchanged, right? So they're pricing in economic weakness, almost no chance of the Fed cutting rates going forward. And we're showing the hedges are down at 3.15% right now as far as where the market could, need some accommodation. Bitcoin at 87,000. Crude oil continues to be a story, cheapening up everything down at $55. And something else that I kind of missed, I didn't realize that silver was doing its thing, up at $64 this morning. And yeah, that NASDAQ about a 200-point rally since from the lows.
Interesting. Also, Hassan, who was talking about jobs, GDP, income, and demand should be going up. I mean, he seemed sort of positive, trying to give a positive spin. I know Hassan and Warsh are the two Kevins that may take over the Fed. We'll have to wait and see. Alex, what would you like to add here?
Yeah, I think the data didn't do anything, Nicole, in my mind, to change the general trajectory of the Federal Reserve. And I think we're basically on a path now where maybe every quarter, for the time being, you get a quarter basis point cut. So maybe we're looking at March, 25 basis points, perhaps June, 25 basis points, and sort of that methodical easing, working our way back towards a neutral or even slightly accommodated rates, as opposed to had the data been very disappointing, maybe you would have gotten lower rates faster, but you're doing so because the economy needed something to save it from falling off the cliff. And so, in a way, it's more of the same. I know that isn't exciting, we want a headline, but more of the same has been a recipe for really, really nice performance for risk assets, stable bond market. So I expect more of that into the end of the year. We've talked a lot about the broadening of the rally. You don't see that today, but we also knew that these Magnificent Seven and AI names weren't going to go down without a fight, Nicole, and they're fighting back today.
Yeah, and it's worth noting some of the picks that we had. Ken Polcari picked, he picked Merck today as his pick. In the mid cap, he liked IonQ. Other winners today include the Gap and Estee Lauder. Those are two names doing well. Chris Versace picked Waste Management and Welltower. So a lot of names to watch here on Wall Street. Also worth noting that ARM's price target was lowered over at Bank of America. You can take a look at that, folks, if you're interested in that name. Good to see you both, Alex Coffey, Dan Grant. Thank you for being here. Let's check out the S&P 6811. So that level, that 6,800 level, has been very key as a support. So we'll watch for that. And on the top side, 6880 resistance for Kevin Green. Thank you for being with me. I'm Nicole Penn-Ladies here on Opening Bell. See you at 2 o'clock every day for the watch list. Sam Bonas is next with Morning Trade Live.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years.
Back at the 200. Excuse me. Something in my throat. I'm not feeling too good today. Oh. We're at the right shoulder on Spy. Yep. Double bottom on SPX. Prepare ye. Double bottom. The quiet man always gets his fish. 68.25s are diving.
Orange clean?
Hello?
Yeah.
There's a reversal. What happens at the 265? That's what it was. Boom.
till January, 42.5 puts, selling this week's 42 puts. Paying about $1.25, so a fairly cheap trade. Also capturing a little bit of term structure vol differential, able to buy about a 40, sell over a 50 this week, plus have 3 more weeklies. I can continue to sell if need be to what I term chop wood. So I just think, given the recent overly red hot rally in Southwest, I think it's probably due for at least maybe a pause in the rally or a slight pullback. Not looking for it to crash land by any means, but maybe just slow down the ascent.
Okay. Well, at least for now, today it is a bright spot in what is otherwise a down market. I mean, we're seeing pretty much 10 of the 11 sectors in the red. We're seeing a bit of caution off the back of some of the data and the economic updates we got this morning. What do you make of it?
Yeah, I think we'll continue to see that. We kind of are through earnings season. The Fed is done. All of the unknowns have become known here. We're kind of mired in the muck, I think, with the kind of old highs at 6,900 level on the S&P. Kind of the top here for the time being, and use the big round numbers, 6,500 down below, kind of that support level. So I think we'll continue to just grind sideways here until we get something to kind of break us out of this malaise. So I just look for more sideways price action, be it a seller on rallies, a buyer on dips, more of a trader's mentality in this market environment, I think makes sense.
Yeah. Couple of earnings as it tails out for the year, but
I don't know.
CPI on Thursday, so let's see if that manages to be the next sort of catalyst for any meaningful upside here, but we are seeing a pullback. We're at 67.84 right now on the SPX. Thanks so much for your insights today, Tim. As always, appreciate your time. Tim Bigham, options strategist at Pilot AI. Coming up, we'll take a closer look at the sectors on the move this morning and lots of moving markets overseas as well. A morning trade ride is back after this.
Trader for sure.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are. Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Welcome back to Morning Trade Live. I'm Sam Butters. Coming to you live from the New York Stock Exchange. It's time now to take a look at the sectors that are moving markets this morning. So I've got Alex Hopping to do just that, and joining me now. And it looks like they're moving in one direction, and that is lower. Alex, what stands out to you today?
Yeah, I was just catching the end of your last conversation, and briefly we lost even communication services. It's up 2 basis points here in real time. So it's a broad-based sell-off, Sam. Only about 25% of the S&P 500 stocks are higher on the session. And so you see that. You see basically every sector lower. You see volatility up a little bit here. You might think, oh, we're down big. And then you look at it, we're down 0.5%. So it's both broad-based, quite red, but what should stand out to you when you pull up the heat map is the colors are very, very dim. They're dull. And what that tells me is, yeah, there's a lot of stocks lower, Sam, but this is a much more unchanged market than the numbers and the market breadth suggests.
Right, okay, so just talk us through what you're seeing there. I mean, we've got a couple of names that are up among the Mag 7, just holding on to some fractional gains there, the likes of Amazon, Meta, for instance. Away from, some of the key names, is there anything else that sort of sticks out to you today?
Yeah, I mean, intraday today, it's been pretty action-packed in this pretty relatively tight trading range from about right here as sort of the low mark to up slightly on the day that we saw about 45 minutes ago when I was on with Nicole during opening bell. And the difference is, as you see it in the Magnificent 7 heat map, is a name like NVIDIA is sort of bouncing around between $1 and down 50 cents or so. Right now it's down about 35 cents, and you've seen the market take a leg lower. NVIDIA has a very outsized impact, but it's not alone. Meta, of course, has slipped a little bit off of its intraday highs. Some of these other names softening just a bit. But a name that we don't include within the Mag 7 that has an outsized importance, especially in recent weeks post its earnings, is Broadcom. Just about an hour ago, Broadcom had a nice little day brewing. It's now down $2.50, about 70 basis points. That's weighing on the S&Ps as well. So some of these big-time AI chip makers slipping a little bit intraday after trying to stage a rally in the first hour of trading.
Yeah, that's right. I mean, it certainly looked like some of the more beaten down sectors in recent sessions, things like technology, for instance, there have been some potential buyers sort of stepping in there, but as you say, very much losing steam over the last course of the half an hour or so that we see now. Alex, thank you so much for getting to process some of the movements in your markets this morning for us. Let's find an outscope now and take a look at global markets. European defence and energy stocks lower on the session off the back of developments in peace talks to bring an end to the war between Ukraine and Russia. Prospects for a deal have also been weighing on the oil market, as you highlighted, on expectations it could mean additional Russian barrels hitting the market and fueling the oversupply concerns. Also tracking reports that China has started granting licenses to Europe for companies to buy critical minerals needed for sectors like renewable energy, oils and defence. And we have a big bunch of PMI readings out of Europe as well earlier today, which showed a mixed bag. Eurozone composite PMI slowing to a 3-month low as an improvement in France was offset by weakness in German manufacturing. Meanwhile, data out of the UK also showing that the jobless rate had hit its highest since the start of 2021. Both the ECB and the BOE will meet this week. And out in Asia, the sell-off continued overnight as regional risk assets track the rotation out of tech on Wall Street here. The South Korean coffee leading decline, shedding over 2%, falling through the 4,000 mark for the first time in nearly 2 weeks. Hong Kong Hang Seng Index also feeling the pressure as tech names like Baba and JD slumped. The index sitting below the key 26,000 level, while over in Japan, Nikkei 225 dragged down over 1.5%. So that was the damage report out in Asia overnight. Well, coming up, it's time for Inside Out. We'll take a closer look at the weight loss drug trade and bring you an example trade for Eli Lilly, the morning trade line comes up.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Coffee.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
Going to the VWAP.
Certainly being short to near-term catalysts
Next Trend Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered. Get inside the minds of pro traders.
My point is that they're getting
George.
the rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. schwabnetwork.com.
Trade line. So Eli Lilly marginally lower this morning after Xylo upgraded the shares to buy neutral with a 12.30 price target. The stock is up 70% from its post-earnings low in August and is just at 5% below its all-time high. We are currently trading at 10.53 and change, down around 0.8% on Lilly right now. Let's go inside out on this name and weight loss drugs across the space. And joining us now is Tom Kulik, CEO, Strategy Asset Managers. Thank you so much for joining me.
Thank you. Thank you. Happy holidays.
Yeah, happy holidays to you as well. Thanks so much for being on the floor with us this morning. Look, let's talk about Eli Lilly. It's been doing some good things lately and it's been rewarded.
Yes, they have. So last week they came out with the results of some of the trials that they have on their triple agonist drug called retatrutide. About 29% weight loss reduction in people, but it's not dissolving the muscle tissue. And so the advancements are there, but also the most important thing that people are experiencing are anti-inflammation. And so these next generation drugs are advancing, and you're going to see somebody like Lilly take this drug into different categories to help people not only with obesity, with anti-inflammation, and potentially even expanding into what it could do for the body long term.
And this is obviously something we've seen across the space with competitors like Novo as well, is that finding those other additional benefits coming from their sort of traditional obesity and weight loss drugs as well. How are you looking at Eli Lilly stacked up against some of the competition out there?
Well, if you look at the macro picture, Lilly stacks up very well. The GLP drugs, when they first came out, was the biggest class of drugs in the history of drugs coming out, even eclipsing some of the cancer drugs that are there. Now they're evolving, but what Lilly can do with this is they're finding additional benefits, as we just discussed, with the anti-inflammation. And what could this do to the 40% of the people that are obese out there? And let's look at a global population. How does that carry over to making a healthier you for the new year? What's the New Year resolution for people?
And what is the New Year resolution, I suppose, across healthcare as well? I mean, what's going to be our big story into 2026 for some of these names? Because we continue to track...
1 minute it's up, another minute it's back down. 1, 2, 3.
It's been driving some of the concerns around valuation this year as well, particularly for Novo, but also with respect to some of the tailwinds offered by, some of the Trump administration's involvement on shoring, manufacturing, investments.
Right.
What's the big story for next year?
What is the big story?
Market outlook for us at Strategy Asset Managers, we're an active manager for separately managed accounts. We think that there are a lot of tailwinds. One, interest rates are coming down. positive reinvestment back into the United States. Tariffs are going to settle, and then you've got a positive Trump administration with policies. That all sets the stage for some type of what-if scenario. What if we continue on this track for advancements in the market for the next, how about 2 to 3 to 5 years? This also tails over into some of the tech sector, the healthcare sector, industrials, and the United States is leading the way. We like it.
Do you like healthcare as a group moving into 2026?
I look at healthcare specifically as there could be a lot of improvements. We obviously talk about the insurance side of things and healthcare in general. Our healthcare plans have escalated 20% per year for quite some time. What could bring that down? Well, somebody like a Lilly or the healthcare drugs that are out there, the pharma drugs out there right now could have a positive impact on reducing rates. If you can get people off of being obese, anti-inflammation and pain, and how about other areas, you can actually pull costs out of the system or expenses out of the system.
Yeah.
We think that there's going to be a positive impact on GDP going down the road.
What about the positive impact, or at least the spin-off effects onto other parts of the market? I mean, just things like apparel and everything associated with the so-called Maha movement. I mean, what are the sort of trickle effects of that?
We've got great analysts at SAM. Joe Traba, Alex Hagstrom, myself talk about what the impact could be on somebody like an Aloe or a Lululemon.
Right.
How about some of the fitness companies that are out there? But it really has a trickle-down effect, and that's where we see the shrinking of this expense that's going out there for the healthcare industry and more efficiencies out there. I mean, it's really going to be a great decade for people wanting to stay in shape and make themselves feel better about themselves, and that's the apparel industry and potentially even a healthier side. What about protein? Protein was not very popular to talk about. Now it is. You need protein to keep muscle, and that's what some of these weight loss drugs now are preventing the disintegration of muscle tissue. I mean, it's going to be a good 2026 in my book.
Yeah, plenty of things to look out for. Tom, it's been an absolute pleasure. Thanks so much for joining us here.
Thank you very much.
Happy holidays to you and your families, and safe travels as well.
Thank you very much.
Tom Gillick there, CEO, Strategy Asset Managers. Appreciate your time. Let's trade it now with Tom White, host of Fast Market, and an example trade for us this morning for Eli Lilly, Tom.
Yeah, stocks had a spectacular run, and it continues, right? You got an upgrade today out of Daiwa Securities. If they continue this momentum and out-innovate their competitors in this space, especially Novo Nordisk, it may continue. Healthcare's had a nice rebound. So I looked at a strategy that takes advantage of upside, but then gives myself a little bit of downside protection also, while still taking a bullish sentiment. This is a high-priced stock, so using the option market, it creates a lot of leverage, lowers that input cost also, and you can still stay risk defined on this. So I looked at something neutral to bullish on here. I looked at a put butterfly that's unbalanced or broken wing on this one. And I went out to the January 2nd weekly cycle, so about 2.5 weeks to expiration. We're going to buy one of the 1040 strike puts. We're going to sell 2 of the 1035 strike puts, and buy 1 of the 1010 strike puts. So you can see it's unbalanced here. And you're actually going to collect a credit of about $5 on this trade. So what does that mean? Well, anything above the 1040 strike, I just get to keep that $500 per butterfly that I buy on this one. And then you can see here for the risk profile, you get a little bit of a kicker, right, at or near that short strike at the 1035 level, where I can get max profitability. Now, if I collect that $5 credit, where's my break even? Where do I start losing money? And that's all the way down at 1025 over the next 17 days. That's about 3% below the current share price.
1, 2, 3, boom!
Downside. You're still having that sentiment
Perfect.
that, hey, I want the stock to go higher. But even if it does pull back, you're wrong, and if stock pulls back, maybe the overall market pulls back and drags Eli Lilly down with it, you're still protected by another, over 3% down to that break even at 1025 on this one. You're risking about $1,500. Your max profitability about $1,000, but that's at or near that 1035 strike. So 3 out of 4 scenarios, you profit on this one, saying the stock was higher, stock stays right here. Stock goes lower, you're wrong, but it still remains above 1025. You're going to have profitability on this neutral to bullish long put butterfly for a credit.
Okay, thanks so much for that, Tom White. An example trade for us this morning on Eli Lilly. Shares trading down around 0.7% right now in what is a broadly down market today. We're at 10.54 and change for Eli Lilly, but a lot of the positive tailwinds our previous guest Tom just mentioned as well. Let's just check in with the markets as we stand, because we have certainly seen stocks losing some altitude throughout the course of the last 90 minutes or so, as we have a little bit of a rethink about some of the data we got out this morning. We've got the S&P 500 down around 0.3%. The Nasdaq is flat. The Dow losing some steam as well, and so is the Russell 2000. So a bit of a cautious approach, risk off in the market. We are seeing a sell-off across most sectors today, so we are seeing a general pullback in trade today. Thanks so much for joining us here on Morning Trade Live. I'm Sam Barnes. Download the Schwab Network app available in the Apple App Store and tuning 24.
She says, don't get wild.
We've got Trading 360 coming up next with Marley Hayden. I'll catch you later on. Market on close at 3 p.m. Eastern. Have a great
Marley.
day.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Think so, huh?
Inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years, through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Good morning. We're 90 minutes into the trading day. Welcome to Trading 360. I'm Marley Caden, coming to you live from our Chicago headquarters. Here's what we have coming up in today's show for you. In our 360 Spotlight, we'll highlight 2026 as we wrap up 2025 and look ahead at trends that you might want to monitor as we head into the new year. And Roku was double operated at Morgan Stanley. We'll take a look at the news and an example trade in our disruptor. Then in our 360 round, we'll look at AI in 2025 and if it will continue to drive the markets in the new year. Before we get to that and more, though, let's see how the market action is faring as we start our day We are seeing a bit of red across the board here. The NASDAQ, though, just below the, oh, there we go. We're adding some yellow to the board. Unchanged on the NASDAQ. The S&P trading down 0.25%, 67.9981. The NASDAQ unchanged at 25,067. On the Dow, we're trading 1/3% lower, 48,267. And the Russell 2000 is trading more than 0.1% down at 25,2689. Taking a look at the 10-year, slightly lower at 418 right now. The dollar down 0.2 at 97.75. Gold is higher though, up 0.4%, 43.5230. Crude oil, though, continuing to fall down more than 2.5% to 55.31 a barrel. And Bitcoin still below that 90,000, that psychologically important round number at 88,115, but that is higher than the 85,000 handle that we saw yesterday, about 2.5% higher on that one. I do want to bring in our first guest, though, and talk about one of the big stories this morning. Alex Coffey, our senior equities contributor, joining us now to talk about Ford. Now, we are seeing Ford marginally higher this morning, despite them taking a potentially massive, nearly $20 billion hit to their current quarter, and also announcing that they are going to stop production on their EV F-150, at least temporarily.
Yeah, I think the market appreciates the decisive nature of this decision, and there's a lot of details. This was a statement issued, and of course, Mr. Farley, CEO of Ford, has been on several interviews discussing this. But let's go through kind of what we know and some of the thoughts. So, as you mentioned, Ford Motor announced they're going to take a $19.5 billion charge tied to a sweeping overhaul of its electric vehicle business after struggling for years to make it profitable. They're canceling a planned electric F-Series truck, shifting that production towards gas and hybrid vehicles, and repurposing an EV battery plant. This will ultimately convert its signature electric F-150 Lightning pickup into an extended range hybrid vehicle. They expect these moves will make its EV operations profitable by 2029, and it's boosted its guidance to $7 billion before interest and taxes, up from a prior estimate of $6 billion to $6.5 billion. When you look at this, Marley mentioned most of this is going to take place in the fourth quarter in terms of where these charges will take place, but really stood out to me. In an interview with Bloomberg TV, Jim Farley, Ford's chief executive officer, said, I quote, "It didn't make sense to keep plowing billions into products that we knew would not make money. We had to make this choice." So it's a very, very dramatic pivot, but it's a decisive one, and it might just be kind of the cruel reality of where the consumer is and where the economics are, especially as we watch policy shifts out of Washington really change those economics for so many of these different businesses.
And it is interesting, too, that one of the plans that the company announced that I think may be an additional reason that we're seeing some of the move to the upside is that they're going to take some of the EV battery capacity.
I gotta go.
For energy infrastructure and growing data center demand. So we're now seeing a car company enter this massive space where we continue to hear about this opportunity, and that this opportunity, and a lot of the guests we're talking to saying they think a lot of the winners in this are going to be those who can actually supply some of the capacity. I wonder if we'll see other car companies follow suit.
Yeah, they definitely put a roadmap out for, hey, you have these assets, you're maybe going to use them differently. This is one of the more intriguing options for how they're going to use them, but also shifting their production to where the consumer is, and that's, at least in the larger vehicles, favoring longer range hybrid vehicles as opposed to pure play plug-ins. But he did say, Mr. Farley, that is, they're not going to cede the future to China, and that they are adding that newer line of lower cost EVs as well. So it's not completely ripping the Band-Aid off from the whole operation. It's shifting the focus where maybe those more, light duty, heavy duty pickups, maybe that's more of a gas powered vehicle, hybrid at the very least, than some of these smaller vehicles can compete with the BYDs and the like.
Well, we're seeing the honesty met with positivity today for Ford trading up about 0.5%. I'm thanking Alex Coffey, co-host of Next Gen Investing, for breaking that Ford story down for us. I do want to welcome in our next guest, so talk more broadly as we head into the end of the year and some of the action that we're going to see. And in 2026, joining us now, Larry Werther, the chief U.S. economist at Daiwa Capital Markets America. Larry, thank you for...
Yeah, Josh, you want me to get a key made and put it back in that box? Be a good idea. What's the combo number to that box?
9239.
9239, okay. Okie dokie.
Jim, you're the best.
Yep. I'm meeting him at 11.
Awesome.
Okay.
All right, buddy.
Yep.
Thanks, Jim.
Bye.
See you. Bye.
Fed policy, relative valuations in the equity market, so there's certainly a lot swirling around.
You're tracking close to 3% growth in the third quarter. You are saying you had a markdown for fourth quarter growth because of the government shutdown, but you're seeing expansion lasting through 2028 in the note that you sent over. What do you think the single biggest reason that we're seeing this resiliency in the U.S. economy is?
By and large, I remain constructive on the U.S. consumer. Recall that the consumer sector has weathered now several bouts of rapid underlying inflation, but all the same, the labor market right now remains pretty good. Shoppers are still showing a willingness to spend, even though consumer confidence has been in the low end of the range of current expansion. So right now, my forecast primarily hinges on the consumer sector. I would add also what I view to be a dynamic business sector. And importantly, I think investors, within businesses, as well as consumers, certainly next year they will be cautious.
Well, we lost support, but we're still above the orb.
I don't necessarily see the thesis being derailed, unless I'm projecting that the economy remains on a growth track over the forecast horizon.
Now we're at the orb.
And I'd like to get your thoughts on this K-shaped economy that we keep talking about, especially as we got a lot of these retail and restaurant earnings. Is upper income spending going to continue to hold up? And Doug, do you anticipate in 2026 and even beyond that growth becoming increasingly more uneven?
So to answer the first part of your question, I do think that upper income
Does it make any sense?
will remain on track. Wealth positions are elevated. Cash on hand and liquid assets for upper income individuals are still strong. Moreover, there are elements of the One Big Beautiful Bill Act.
Big beautiful bill.
That benefit upper income individuals, namely the increased SALT deduction. So then all of that will provide a tailwind for ongoing consumer spending for your upper income individuals. Middle and lower income individuals is
big,
more dependent on
beautiful
the labor
bill.
market. Their marginal propensity to spend is contingent on solid underlying labor market conditions or
Oh boy.
labor market, which I think are holding up all right now. But I think we could see some additional weakening among middle and lower income individuals next year, especially if the labor market continues to soften. So I think what we'll see next year is a continuation of this K-shaped story with the upper income households holding up well.
So if consumers and households are the key growth engine in your thesis, we've got unemployment rising, we've got delinquencies climbing. What's the tipping point where you see consumers really starting to pull back in any part of our K-shaped economy?
Well, certainly, the linchpin there is the labor market. I remain guardedly optimistic, but all the same, 4.6% unemployment that we saw today was my projected peak, which I had expected to be reached in the first quarter of next year.
Oh,
so that begs the question,
panic attack.
Start to contract, should the unemployment rate drift towards 5%? I think there will need to be a review of my expectations for the consumer sector. I would add, though, Marley, not to be underestimated, the business sector certainly pinned on the AI story remains solid. CapEx was certainly strong in the second half of the year thus far. So the consumer, again, is the linchpin for my projection, but certainly we don't want to, throw out thoughts about decent business investment as well. But again, specifically with respect to the consumer, hinges on the labor market, and we just have to watch the next few months' worth of data very closely.
Certainly, and I was going to ask you about you foreseeing that we were going to see an unemployment peak around 4.6%. We got there a little bit faster than you predicted. So I'm putting you on the spot here because you haven't had time to adjust any of your thesis. But do you see now that could push even higher? Especially as Powell has suggested that payrolls may
Good
be
question.
overcounted. Are we seeing job losses under the surface that are going to come to the surface in early 2026?
So that's a challenging question, and
That is a challenging question.
I think part of the jump in November.
Hard to answer.
In October, there were 160,000 layoffs among federal government workers.
Yeah, I gotta go.
Tied to previous labor force reductions related to DOGE efforts in early 2025. I think that introduced a little bit of volatility into the unemployment numbers. So near term, you could see them ease a little bit, maybe the rate fall back to 4.5%. I would add also
back to the orb.
Claims are still range bound. The NFIB index last week saw a bit of a positive move in the labor market indicator associated with the survey. So I'm still trying to look at the labor market from a glasses half full perspective. But I do especially think in light of Powell's comments about the overcount in payrolls, in light of some elements of the report today, I do think caution is warranted. But again, you can't jump to conclusions based on any one report, especially when the Labor Department noted that statistical analysis, could be hurt by the government shutdown, that your standard error for data over the next couple of months could be wider. So I'm in wait-and-see mode, but certainly I remain vigilant on the labor market.
And my last question here, I wanted to talk about AI because you mentioned it there. We've seen AI investment as a bright spot, even with this pullback that we're sort of seeing in the last couple of weeks here. How much of overall business investment growth is now dependent on AI and us being in the early innings and not in this bubble scenario that keeps getting discussed?
I would say a good portion of it. I mean, there's even been arguments that GDP, which is really the best metric that we have on CapEx, is undercounting to a large degree just the amount of AI investment that's going on under the surface. Look, the AI story is a compelling one. I think we are in the early stages. We're starting to see some knock-on effects on productivity. So I think over time, AI is transformational, and it means outstanding things with respect to the U.S. economy. That being said, though, there are always winners and losers in the early stages of investment. We saw this with the dot-com bubble. We saw this earlier with fiber optics and other communication-related technology at various points in the past 2 decades. So at some point, I don't think I'm going out on a limb saying there's going to be a repricing of certain AI stocks, and maybe we're starting to see the early stages of that. In total, though, I think the AI story is broadly compelling. Again, though, it's just in the beginning, there are going to be some firms that seize the day and others that ultimately are valued too high by the market currently.
Larry, we appreciate you. Oh, continue. Go ahead.
No, that's it. Thank you.
Well, we appreciate you taking the time to speak with us. Some great insights there. That's Larry Werther, the Chief U.S. Economist at Daiwa Capital Markets America. And we've got plenty more for you to come on Trading 360. Of course, we've got the big three coming your way. 3 stocks, 3 charts. Kevin Green will go through the technicals for us, and Jessica Instant will take us through her picks. GE, Vernova, NASDAQ, and Seagate. That's next on Trading 360 on Schwab Network.
Knock 2. I'll be back.
Iconic trading floor in the world. This is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute 5-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right where it counts.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get up there.
Where are you going?
Schwab. Schwab, a modern approach to wealth management.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. We've got 3 stocks and 3 charts here. Kevin Green joining us today to take us through the charts, and here to take us through the trades is Jessica Inskip from stockbrokers.com. Great to have you both with us today, Jessica. I'd love a big picture thought on the market action we're seeing. We got some important data this morning. Some of it, albeit backwards looking, but important numbers nonetheless.
That it was, the quality of the data is certainly important, and we're seeing that key theme emerge, which is the bifurcated economy and that K-shaped economy. But I do want to point attention to that unemployment number around 4.6. During the FOMC press conferences, I feel that Powell gives us some really important instances, and this brings me back to, I believe it was May 7th of this year, where we had unemployment around 4.2%, and he characterized that as low and consistent with a balanced labor market. The phrasing was in the low 4s. So I've been watching since that moment. Anytime we move from the low 4s, so above 4.5 or greater, which we have. So I think it's going to be interesting to see any commentary we have from him from here, but I think that this actually warrants more of a cut. I think we might have a reacceleration perhaps next year because of fiscal policy and things like that. But if the risk is to the labor market, and we categorize this risk as low for employment being balanced, and now we moved out of balance, so that risk is more skewed towards the labor market, I do argue that this warrants more of a cut, which should bode well within markets next year, and I don't think that's what the market is pricing in right now. So I think something to pay attention to, how rates react and all of the economic data we have until the next meeting.
All right, so let's get to your first pick here. We're talking about GE Vernova. They've had a very good last couple days. They're up almost 9% just in the last week of trading. You walk us through this pick and what flagged it for you?
Absolutely. We've been talking quite a bit about data centers, and actually going into 2025, that's one of the key themes that I called out was data center construction, infrastructure, industrials, and also retail trading. GE Vernova goes into that data center play. It's becoming a critical power supplier for AI data centers, but there's grid delays that push customers toward on-site generation. And so why this matters for GE Vernova, data centers are turning to this on-site power because grid interconnection timelines, those build-outs, they take a while and they're very uncertain, and we want to see fiscal policy follow through, and I think they could be a beneficiary from that. Additionally, we've got a shift to this high voltage power, which creates new opportunity for them to earn customers. But I want to look at their backlog due to this issue, if you will, of longer backlogs. It's high quality and it's on track, especially as we go into next year and then 2027, due to the way that they have conservative order booking. And additionally, there's expansion, but what I like is their execution discipline. They require permits, storage fees, and supply chain stockpiling with those rare minerals, and that reduces risk with those delays in the backlog.
All right, KG, so as we take a look at the chart for GE Vernova, what are the technicals telling us? Because it has had a pretty meteoric rise from the tariff lows we saw in April.
Yeah, I think it's up around 150% from those lows here. Obviously, the stock has been in a bullish trend for all of this year, and it may continue actually into 2026. And if you're looking at this time last year, we had this falling wedge pattern that kind of took place. You started seeing lower highs as well as lower lows, and we saw a breakdown to the downside to that 200-day moving average. But ever since then, we did see a positive cross with the 12 EMA above the 26 EMA, and then we also started seeing a situation where the stock was able to get to around $650 $200. We are now in a bull flag type of pattern, or were in a bull flag type of pattern. We consolidated here a tad bit, and then we saw a breakout to the upside. That was on the back of maybe some updated guidance numbers from the company, which gave the stock some enthusiasm here, and we've been able to continue to hold that breakout. Now, the next area of resistance that you're looking at is around $750 here, so be mindful of that. But the stock is still seeing RSI that's making higher highs as well as higher lows. MACD in a bullish formation, 12 EMA above the 26 EMA. So this is a stock that actually can continue to move higher here. And what also gives it a little bit more of an advantage is the fact that it's high price. So if the stock's sitting at around $600, $700, $800, it's harder for institutions to really try to short this name. That gives it a little bit of a benefit as well. So overall, the trend still makes higher highs, makes higher lows. It's still overall bullish for this name.
Yeah, the last 12 months trading up more than 100% for GE Vernova. Now, this next one we don't talk about as a trader, as we're going to trade it very much. We're talking about the NASDAQ here, ticker NDAQ. What flagged NASDAQ for you?
Well, it was initially a headline where they proposed the 23-hour weekday trading, adding new overnight sessions from 9 p.m. to 4 a.m. with the SEC. And we've seen this, at least in the retail trading world, this expansion of market access that starts with overnight, that's even event contracts, but we have an increase of retail participation. And that retail participation is going global. When we have overnight trading in this additional session, it's not necessarily domestic users, it's global. It's our friends over in APAC that are trading on their timeline. And NASDAQ also has exposure to tokenization and those other type of assets and digitization that allows for further access, and that's still a key theme that I'm going to see accelerate, or at least I believe to, into next year in 2026. Additionally, there is about 60% of NASDAQ's revenue comes from their AUM-based index funds, and there's recent data that shows investors have been rotating a little more out of active equity funds and into passive equity funds, which means that's going to translate into NASDAQ earnings. So not only do we have just retail trading expanding, markets going global, but passive investing is growing, which is very good for NASDAQ. They make money off of transactions and this data. They're making moves to make that expand.
All right, Kevin, so as we look at the chart for NASDAQ, what are the technicals telling us?
Yeah, you can be actually optimistic that the stock is just consolidating right now and preparing for a breakout to the upside. The stock has pretty much tracked the S&P 500 or the NASDAQ 100, if you will, and rightfully so. It's an exchange. It does make money on volatility, but it also can see some pullbacks in the in the near term if market outlook is a little bit bearish here. But this time last year, we were pretty much in a consolidation pattern. We saw those lows from the tariff fears, and then we have seen the stock move up ever since here. Now, it did hit that $97 level. It has pulled back, consolidated, leveraged the 200-day moving average as an area of support. It was making lower highs as well as lower lows. Ever since hitting that 200-day moving average, now it's making higher lows, and that's something that's really key. And you can make the case that it's just in a consolidation or a cup formation with that neckline at $97.50. And if that's going to be the case, you look at the high and low between that cup, that potential cup pattern that's taking place, it's around a $12.50 move. You add that to the breakout high here, you're looking at around $110 as the next major area of resistance. RSI making higher highs, higher lows as well. MACD in the bullish formation, 12 EMA above the 26 EMA. This actually looks like a textbook base and potential breakout here over the next month, 2 months or so. So I can see the optimism and when it comes to the fundamentals as well as when it comes to the chart pattern.
All right, Jessica, this next pick here had a big headline of its own when it announced it was getting included in the NASDAQ 100, but the NASDAQ did its reconstitution announcement, which is effective December 22nd. We're talking about Seagate here, who had already had a really good year up to this point. Walk us through your pick.
Absolutely. So part of it, that headline, is important to pay attention to, and which flagged my attention. And then diving deeper, they are a core supplier of data storage hardware, which is used in data centers, servers, and AI infrastructure, that theme that we're going to continue to see. Then to add this to my longer-term portfolio, I like to deploy cash-secured puts, and I love the trade construction and setup that I saw with Seagate Technologies. So I can sell a 30-day cash-secured put at the strike price of around $290. What I'm doing is I'm creating an obligation to buy the stock at $2.90. And earlier today, I could collect a premium of about $20.90 a share. That represents 7% based on a $2.93 stock price. So that is a healthy premium in a 30-day time frame. The way that this works is I am risking that entire purchase price of $290 per share. Remember, one contract represents 100 shares, but I'm offsetting it by that $20.90 per share, that's 7%, which effectively allows me to buy that at a discount. And the reason why I like to deploy this, if a stock has had a really high run up, I pull up the quote and I see that it's up a large percentage for the day, I don't want to chase that. But what I'd like to do is create a cushion. So essentially I've created a cushion of $42-ish, so $20.90 to the upside and $20.90 to the downside based on my stock price. So this is a long-term bearish, short-term neutral play, and it allows me to add Seagate technology to my portfolio if something happens and we move below $2.90 a share and I'm assigned.
All right, KG, so as you take a look at the technicals, knowing that potential example trade there, how are they lining up?
Yeah, if you kind of look at the technicals, the stock has obviously been in a bullish trend, but you can also make the case that maybe it has run up too far too fast, just given the cyclicality of the business. If you look at it this time last year, we were in a consolidation pattern, or basically consolidating in a range before that breakdown for the tariff lows. Now, we've been in an uptrend ever since, and you can see that with that purple trend line here. That's going to be the primary trend line. So until that actually breaks, you got to kind of be a little bit more bullish than bearish on this name. But we are also seeing, once again, a defined range to the upside, making higher highs, making higher lows, and we actually got fairly close to that upper end of that support area of around $320. It looks like it's trying to pull back. The 20-day moving average over the last, let's say, 2 months, 2.5 months or so has not been a key area of support. So even though it is for some stocks, other stocks, maybe it's not going to be that significant. So I would actually kind of ignore that 20-day moving average and really focus on the 50-day moving average, which obviously the stock did hit. And had a nice hammer candle and moved a little bit higher here. Any type of breakdown below that $240 to $230 range here, you get a little bit more bearish on this name. The reason why I also kind of bring this up as being potentially bearish, you have a bearish divergence taking place in the RSI, making lower highs as well as lower lows at this point here. And MACD in a potentially bearish formation where the 12 EMA is about to test the 26 EMA. So bullish overall, if you're looking at it, you took the name off of the chart here and you look at it and say, hey, this is a bullish chart. You add the name back onto it and you look at the cyclicality, and then you also see the multiple for this name along with some of these technicals. You get a little bit more concerned that a pullback here could be warranted over the next month and a half.
And right now, Seagate trading down a little bit more than 1.5% at 280.89. I want to thank you both for being with us today to walk through the big three. Jessica Inskip, the Director of Investor Research and Stockbrokers.com, and Kevin Green. Thanks to both of you again. Coming up next, we're going to spotlight investing trends for 2026 and what market trends you might want to keep an eye on. That's next.
My man. Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network. Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Welcome back to Trading 360. I'm Marley Caden here in our Chicago headquarters. Let's head out to the New York Stock Exchange for a check on the markets and welcome in Nicole Petalides, host of Opening Bell and the Watch List here on Schwab Network. Nicole, great to have you with us. We're 2 hours into the trading day. We've got some of the delayed data that we've been waiting for, and we saw markets do a little bit of a turnaround on it. What are some of your thoughts so far this morning?
Yeah, I mean, we've gotten jobs, retail sales, PMI, and all of these things put together gave us an array, as you said, of delayed data to digest. And so the market did move around. It's also worth noting that the 10-year bond yield has gone up to almost 4.20 and now is at 4.16. And I'll start with the jobs picture. And November was okay because you had 64,000 jobs, and that beat the estimates of the 45,000 estimate. But we do see an unemployment rate of 4.6%. Make note of that number because that shows a higher unemployment rate. The prior month, the October month, where you saw over 100,000 jobs lost, just caught people by surprise. I mean, they just didn't expect to see that. So that jobs picture still shows a weakness and unevenness. And we did see the likelihood of a cut in January by the Federal Open Market Committee move up to 29% from 24%. But as one of our guests noted, as you know, Marley, there's so much information, economic information that will come in, CPI, PPI, and other pieces of news. You'll get the jobs report for December, for example. You'll get all of that before the January meeting. So I don't think we can hold our breath for anything at this moment. Other movers and things that we've been watching, we had a guest on who picked Merck, and there's still people who are just out there still feeling more optimistic than pessimistic. Oil is at the lowest that we've seen since May, and this is on peace talks with Ukraine and Russia and that coming together, and that seems to be going well. And some of the laggards are Valero, Occidental, EPAM, Molina, just to name a few. And we have winners too, of course, but mostly laggards.
Yes, definitely on the laggards. But let's talk about one of the winners today. We're talking about Southwest here, and even some of the other airlines all moving in sympathy on this move higher, and also probably combined with those lower oil prices we're seeing. But Southwest hitting a 3.5-year high after getting an upgrade at Barclays.
Yeah, that's some good news there, right? And the price target now is $56. The prior price target was $34. This stock is trading at 42 and change. So $56 continues to show more upside potential for a name like Southwest, ticker symbol LOVE. It's already year to date at 27%, and in 6 months it's had a nice run of 36%. The Jets ETF has also been at new 52-week highs. So what is behind the Barclays call, and why do they like what they're seeing with Southwest in particular? They see material improvement in its relative revenue generation growth going forward. They talked about the new commercial strategy that they like a lot. They're very positive on that, and I'll explain that in a moment. And also just idiosyncratic stock opportunities in transports and airlines overall. Let me get back to the commercial strategy that they like and they feel positive. They talked about the assigned seats. A lot of folks remember, you go on Southwest, you don't have an assigned seat, you get a number. I did it for the first time a couple of months ago. I couldn't believe it. it's an experience. I mean, maybe people love it or hate it, I don't know, but it certainly was an experience. Bag fees, things like that. Also, you know, just the fact that it's been years of stagnant, if not contracting, industrial economy, a volatile travel market. So they put this together and they talk about the relative revenue generation that this company is likely to see, and in the future, you know, in 2026. So really, you see a record-winning streak here, 11 straight days. Is the stock overbought? Of course, we had guests on saying that, in fact, he felt it was overbought because it's had an incredible run. 11 straight days is pretty great, but it's a nice move here. And so the new price target is $56. And I will note, as I look at the JET ETF, I'm just curious because that has been also at 52-week highs, and that too is at 52-week high today. Marley.
Thanks so much, Nicole. We appreciate you breaking that down for us. Southwest, you know, trading higher, up more than 2.5% this morning, along with several of the other airlines, like you mentioned, the JET ETF up as well on the day. That's Nicole Fedelides. Thanks again for that. Coming up, we'll have our Disruptor segment. We'll also take a look at trends to watch in 2026, which is a midterm year. We'll be right back.
The Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
and on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Marley Caden, live in our Chicago headquarters. It's time to spotlight investing in 2026. Joining us now is Lucas Downey, co-founder of MoneyFlows.com. Lucas, thank you for being with us today. You know, we've been talking about 2026 and trends to look out for, but something we haven't highlighted much is that it's also a midterm year, and that potentially changes how investors should be positioning themselves coming into that year. Now, you've sent over quite a bit of data showing that midterm years tend to underperform. Why do you think that pattern persists? And do you think that the setup is the same for 2026?
Thanks for having me. Yeah, we were looking at some data going back to 1960, and we looked at the presidential election cycle. So year one, midterms, pre-election, and election years. And I think a lot of people are surprised to find out that midterm years tend to be rough years for the market. The average return since 1960 is a negative 1%. And if we think back to the last time we had a midterm year, it was 2022. Markets were basically in a bear market, down 19 and change. And then if you go back 4 years prior to that, it was 2018, markets were down about 6%. So there tends to be this choppiness that, occurs every 3 to 4 years. You look at bear markets, how often they come around. It's usually between every 3 and 4 years on average. And I think it's, lines up with midterms. We know that there's going to be a lot of mudslinging that goes on during midterms, and maybe that's a little bit of the skittishness that happens with markets. Maybe people are worried that the control of Congress can shift. So all of these, I think, come into play, and as we look at how the markets are trading now, it does seem that some of the big bellwethers, the big mega cap tech, are starting to take a breather as we start to see more broadening in other areas of the market.
So as we are starting to see some of that broadening and that tech pullback that we've been witnessing over the last couple of weeks, are you watching a possibility where this leadership may continue to fade out in 2026, or is this cyclical and we're going to get these mega cap names leading again?
Well, I mean, it's really early to see. We were looking at our data before this, and we noticed that in the month of December, about 80% or more of our inflows that we're tracking are in this small and mid-cap space. So you're seeing a lot of money going into healthcare, a lot going into banks. You're seeing it also in staples and some industrial pockets. And then you really have seen an absence of these continuation inflows into some of these Mag 10 stocks. And so, you know, a lot of people have been all in this AI train. It is well acknowledged. And valuations are a little high on those ends. So it just seems to make sense that there is room for, you know, other areas to start to participate in 2026. So we do think it's further to go. You look at rates coming down, it just seems like a nice cocktail for leadership shift.
So if we see that leadership shift alongside of the historical dip that we typically see in a midterm year, what tactical shifts would you recommend for investors?
So we really like value-oriented areas. We like dividend growth. So specifically, we've been telling our customers to be focused on banks. They're going to have some stimulative effects as rates come down. Also, healthcare was abandoned months ago. People, hated it. It was one of the biggest underperforming sectors, I think, ever relative to the S&P 500. You're starting to see that start to come back. So there's a real world, real economy type stocks that we think are undervalued. Also, the discretionary space looks very interesting right now. We know that sentiment is pretty lousy right now. When investor sentiment is low, you tend to see discretionary stocks outperform. And so, you look yesterday, you see Tesla's doing well. That's one big piece of the discretionary space. There's other areas. There will be some tech names that are going to work, but as far as just, you put your chips in and hope everything goes up, it might actually be a bifurcated market.
And for investors who specifically want to hedge against the potential volatility that we've also historically seen in a midterm year, where might they look or where might they put their money?
That's a great question. A lot of people have been putting money towards precious metals as a type of hedge, just in case, we have some issues. People are worried about the amount of debt that is out there. Other areas you could be looking at is, you could put a hedge on for the S&P 500. Why that could be interesting is if 40% of the S&P is, big cap, mega cap tech, if those do tend to underperform, you would expect that the index would be relatively muted there. But we still are very constructive on stocks. We just think that the players, could start to shift a little bit. But overall, this is not a bearish call per se. It's just more of a be open, be willing to expect that there could be some change in leadership.
Fascinating chat, Lucas. We really appreciate you bringing that research and also highlighting the importance of acknowledging it is a midterm year in 2026, and that could make some potential changes to the market action we're seeing. That's Lucas Downey from moneyflows.com. And now it's time for our Disruptor segment. George Tillis, our senior markets correspondent, is here with today's company. We're talking about Roku after Morgan Stanley double upgraded shares to overweight today. George, what's behind that call?
Actually, a few things. Actually, corresponding to your previous guest, there's some political element to the call as well for Morgan Stanley. But I think one of the broader things about Roku, first off, is the pivot of the business. It really was traditionally sort of a video on demand or ad-supported business. They're actually moving quite rapidly into the connected TV space, where they're going to be moving or pivoting towards subscription services. So it's sort of a net monetization model, but also subscription-based model. The other thing about Roku is they also have ad technology in the background, which competes with the likes of companies like Trade Desk, and that's sort of a value tech proposition for the underlying business. Now, if you look at the call for Morgan Stanley, they did double upgrade it, and they moved their target quite aggressively from $85 to $135. So they do see the connected TV growth that I mentioned just a moment ago as a primary catalyst. They also see the ad market actually quite healthy going forward. In particularly, they suggest that the political advertising next year is going to be very accretive to Roku, plus sports advertising, as well as the fact that they see the profitability profile for Roku improving to potentially get profitability for the first year. And if you look at the last 4 quarters for Roku, they essentially lost about $28 million, which again is a loss, but nonetheless it's still a small loss compared to the $4.5 billion in sales. Just going back a couple of years to 2023, they lost $700 million. So the profitability profile is improving alongside maybe some of the catalysts that Morgan Stanley suggests. And like I said, the political ad space looks pretty promising next year. Sports ads, but also the connected TV subscription-based model that they're moving into.
Yeah, interesting. They're highlighting that connected TV should be the fastest growing area in the healthy advertising market, and we saw these connectivity-enabled TVs as one of the top items bought during Cyber Week. So, an interesting setup there. But as we look to trade this for example purposes with Roku, how would you structure an example trade here, George?
Okay, so one of these about Roku, and I didn't suggest a chart on this one, but you have to look at a longer-term chart. It's on a basing pattern and potentially could break out. One of the things you have to keep in mind too is maybe earnings coming up in February. Just something that I suggest keeping in mind. If you look at the daily chart on Roku, it's having a tough time breaking through the 110 area, which is some levels corresponding back to October even recently in the last week or so. So with the markets being relatively tepid or weak, not moving higher or lower, so let's just call that for what it's worth. I do think that there's a possibility that Roku pulls back, but it's still in a nice daily uptrend. So I'm going to suggest here that if you want to play the pullback but also stay bullish with some premium harvesting, you can sell a put spread going up to January, the 3rd week of expiration, and then sell the 105.95 put spread. So sell the 105 put, buy the 95. You can earn about $2.50 a share or $250 a contract. So the whole premise behind the trade is to essentially hold the 105. Your break even is a 102.5. Your max loss is 750 on 250 premium earned. And that will occur if the stock gets 95 or lower by expiration. So again, the 50-period moving average is right around these levels, split between the two strikes around $100. But nonetheless, again, there's a possibility that Roku breaks out, but it's too soon to tell.
All right, George. Well, Roku trading down just ever so slightly on the heels of that double upgrade here, up down about 1% at 107.96. Thanks to George Tillis for the news and that example trade there. And coming up next, we've got our 360 round. We'll take a look at AI as we head into 2026. That's next.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Tommy.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me. And my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
This is Fast fast market built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Welcome back to Trading 360. I'm Marley Kaden. It's time now for the 360 round. For that, let's bring in our panel to discuss the outlook for AI in 2026. Joining us now, Noah Hammond, CEO of Advisor Shares, and Daniel Rubino, the editor-in-chief at Windows Central. Daniel, I'd love to start with you. We had AI in 2025 seemingly focused on building capability. What is 2026 really about? Is it scale now? Is it monetization? Or is it consolidation?
Oh, great question. So there's a lot going on here, right? The issue with AI, I would say right now, is there's a lot of parts of it in different apps and different aspects of our lives, but people haven't been able to sort of kind of connect all the dots yet. And so what you're going to see is a more personalized AI, what's often referred to as agentic AI, start to come forward in 2026. So everybody's familiar with ChatGPT. It's just a simple bot. You go in there, you ask questions. It's a little bit boring. The next stage, though, is that AI becoming personalized. So it actually knows who you are. It learns from you the things you've asked. And it develops its own personality in response to you. So you're going to start to see this stuff become hopefully more useful, because I would still say that is the biggest problem right here. You do have a segment of people who use AI every day and love it and are more productive and are being great creators. Then you have a large segment of the population who just don't get it. They don't see the big deal here. Sure, okay, I can improve my photos, but how else does it help improve my life? And so that's going to be the challenge in 2026, where we see this AI basically evolve to become more comprehensive. It does become a little bit more in our lives every day. It's going to be integrated into browsers and shopping, of course, and every company is going to try different things. It doesn't mean, of course, it's all going to be a success, but you'll see companies experiment to see what works and what doesn't.
And Noah, coming to you, we continue to have this conversation about AI being like an arms race here. So I'd love to get your thoughts on who's actually winning right now and by what metric investors should judge that.
Sure. So I think right now, when you look at rankings at least, and so there's different approaches on how you might rank it, certainly just on the quality of the software and the results that you get, or from an investor perspective, you want to look at market cap for some of these companies. But based on model performance, the LMSYS chatbot system that tracks and ranks these different AI programs has Google at number one, but with XAI as a close second. So those seem to be, I'd call them almost more retail friendly. Not that they're not used institutionally, but Anthropic, which comes in third, is one that you see that has probably a bit more corporate usage and support. But certainly from an investor perspective, right, which ones are going to make it, which ones have the opportunity. You've got companies like Google and XAI that have ecosystems to use it, maybe even Anthropic as well to a certain extent with Amazon. OpenAI is going to really have to compete for business, try to pull in search, try to pull in advertising, try to sell to institutional clients. And so, picking a winner at this point might be too soon. You can probably be, at least where they're public, invested in all of them. But I think it still remains to be seen who's going to be a winner. And I still think you'll have an environment with multiple winners, not hundreds, but certainly tens of winners in this space.
And Daniel, you brought up the consumer and sort of how we have this bifurcated user of AI, where some are all in on AI and others who are just sort of shrugging their shoulders at it, not really interested. In the next year, as AI really becomes more a part of everyday life, where are daily users, do you think, going to see the biggest impact, including those people who are not actively seeking it out?
Yeah, so that's going to be the real challenge, right? We got to move beyond this idea of like chatbots. It's literally the most boring aspect of AI. Sure, they're kind of fun to use, but it's going to be in things, to borrow page from Apple here. They want their technology behind the scenes, right, not up in front. And that's where AI really wins. So, for instance, companies like Eufy and now Ring make smart cameras for your house, and not only can they, of course, identify people versus, say, a dog coming up in your yard, but they can actually identify the people via facial recognition. Now, there's a lot of controversy around that. But that is one aspect. We're getting previews right now for CES coming up at the beginning of January. We've already seen like a toilet that analyzes your urine for health concerns, or mirrors that can actually measure your blood pressure, right? So these are all instances of machine learning and AI in our lives, but it's not something you directly pick up and it's like, I am now using AI. And that's really going to be the future here. You're going to see just everything around you kind of get smarter. You're not necessarily going to know how it works, what it's doing, what it's even called, but it's going to be all these features sort of improving our lives daily. At least that's the goal. I'm sensing a lot of blowback right now from consumers who are either tired of all this or sort of, there's a lot of promises, plus the threats of eliminating jobs is not helping. So I think there's a lot of challenge here to build up confidence in users.
And Noah, last question coming to you is sort of a double question. We're a little bit tight on time, I'll warn you before I ask it. What do you think the most overhyped AI trend is coming into 2026, and what's the most underappreciated?
I honestly think it's probably more the retail usage, sort of mom and pop, and as he just described, the chat box, sort of aspect of things. What's I think, appreciated is its productivity, right? In the workplace, whether it's design, whether it's accounting, whether it's finance, legal. You've got a big project that you're putting together in an Excel spreadsheet with, 2 different data sets or things like that. And the ability to accomplish those things so much faster is where I think AI is going to have its biggest impact and probably, as you mentioned, impact on jobs as well.
Well, I want to thank you both for being with us to preview AI, which of course will continue to be a top theme in 2026 as well. That's Noah Hammond, the CEO of Advisor Shares, and Daniel Rubino, Editor-in-Chief at Windows Central. Also want to thank all of you for joining us today on Trading 360. I'm Marley Caden. You can download the free Schwab Network app available in the Apple App Store and tune in 24/7 on SchwabNetwork.com. I'll be back with Sam Bottas of Market on Close at 3 p.m. Eastern, 2 Central, but stay with us. Fast Market with Diane King Hall is coming up next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, and not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th for 2026 Market Outlook, your guide to the forces shaping stocks, local markets, inflation, rates, and more. Hear from experts on where the markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network. I'm Sam Bottas, live from the New York Stock Exchange. When the market moves, we're on it. getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Welcome to Fast Market here on Schwab Network. I'm Diane King Hall. Coming up on noon Eastern here at the New York Stock Exchange, the stocks are taking a step back today as investors process the latest economic data, which shows some weakness in the economy. Let's get right to it, to a check of your scorecard as we hit the lunch hour on Wall Street. The S&P 500 right now is lower by about 1/3%. Seeing broad-based weakness across sectors, but again, off by just 1/3%. So we'll see if the bulls manage to turn things around later in the day. The Dow right now is off by 0.5%. NASDAQ 100 flipping just above the flat line right now. We'll see if that holds and builds throughout this hour. Russell 2000 lower by 0.5%. Here's the roadmap for today's show. We'll look at example option strategies for Tesla, which has made quite the comeback recently. Plus, the team from Lifefolio will be along with new sentiment data on Darden. It's got earnings this week. And Lennar is also on our radar ahead of its earnings. Those come after the bell today. Now that we've got the roadmap for today's trading action, it is time to bring in my co-hosts and trading veterans. You've got Tom White in our Chicago studio. Kevin Eames joining us live from the CBO. As you know, we've got covered from exchange to exchange and beyond. All right, we got a slew of economic data today. We had October numbers showing the economy lost 105,000 jobs, but November was better than expected with a gain of 64,000. Tom, I want to go to you first and ask the question, how do you square all of this?
Well, I think it kind of is reflective that the jobs market is still weak at this point and not improving like maybe we anticipated. Maybe there's more pain. I think if you take a look and take a deeper dive into the numbers, the losses of government jobs, we're at the lowest level that we've seen in a decade, basically, on those numbers, and that's probably a good thing. As you shrink the government here a little bit, but it's impacting these headline numbers at this point. I think one of the things that sticks out the most is that unemployment rate up to 4.6%. That's the highest level since 2021. So we're still at full employment, guys. I don't think it's anything to kind of get excited about or volatile about at this point. But at the same time, it's just kind of confirmation that the Fed, after 3 rate cuts this fall, is spot on, just because of the weakness that we've seen in the jobs market. And if you take a look at maybe the wage growth, a little bit came in a little bit lower than expected, but on a year-over-year basis, about 3.5, 3.6%. So that's a positive. Also, that's starting to come down a little bit. But I think if you take a look just at the jobs number in general, it kind of confirms what we've already known, that the jobs market is weakening. We're in that no hire, no fire type of situation, but I don't think there's any red flags, and the market's kind of reflective of that. There's not really any red flags at this point.
Not really any red flags at this point. To me, that was initially the read when the jobs numbers came out this morning, Kevin, which we were watching as it looked like the direction of the market was going to be higher. Now, listen, we were going through a lot of economic data fast and furious because we're playing catch-up. What's your read-through when you think about this and the market reaction?
Good morning, Diane and Tom. Listen, I see things differently. I think the market is getting this slightly wrong, and here's why. I think this is an economy with private payrolls growing and government payrolls decreasing, not by weakness, but by choice. by an on-purpose shrinking of the U.S. government. This month, another 6,000 jobs lost. Now, all those people that took the early resignation, deferred resignation, that hit during October. That was 162,000 jobs. But those were all the people that took that. So that's not necessarily people getting laid off. They took early resignation. Now, that means year to date, since President Trump came in office, since January highs, 271,000 government jobs have gone. That's how much government jobs have gone down. Yet the private sector continues to grow. Now, the unemployment rate did tick up 4.573, rounded up to 4.6, but labor force participation rate went up by a 10th. That negates some of that increase. So I think with the wage data coming down, remember, wages had exploded during COVID and the government spending that came after that. Those wages are starting to come down now. The inflation picture is looking better, and the overall path for lowering interest rates is looking better. I think this is a U.S. labor market switching from government jobs. Remember, the Biden administration, last 12 months, averaged 41,000 jobs a month. Average. Now we've lost 270,000 since then. I think this is a much healthier private sector that we're looking at here. Not perfect. I mean, the higher interest rates did their job, which was slow the overall economy. Now it's time to get them down to neutral, or maybe even a little lower.
You know what is speeding up, or I should say flying high, are shares of Southwest. Those are taking off today after Barclays upgraded this stock to overweight. And it's been catching some momentum recently. It looks like the analysts like the direction that the company is going. Bags don't fly free anymore. You've got to sign seats anymore. Tom, what do you think about this take when you look across the analyst views?
I don't know. I think if you're an investor in Southwest over the past few years, you're finally going, it's about time, maybe, to management at this point, because now they're going to try to compete on equal footing with some of the bigger names in this space, and that's Delta, United, and American Airlines at this point, getting rid of those no bag fees, assigned seatings, reconfiguring some of their planes. That's probably going to be a benefit for them. They're going to start opening some airport lounges too, because they realize what the other big three have stated over the last couple of years, that premium is outperforming. People will pay more for premium seating. International is booming, and then business travel is starting to come back. So that's a positive for this company. I think one of the caveats that you have to look at, that Southwest is on a 12-session win streak, hitting highs that we haven't seen for 3.5 years. But at the same time, look at the price of oil, crude oil. What does that mean when you're at basically 5-month lows in crude oil? And if we break down through 55 and go towards $50 a barrel, that's going to help their margins immediately, because if they're not doing that much hedging, you've got crude oil prices just streaming down. Jet fuel prices will start to come down, and that goes right to margins immediately. So that's been a benefit, because it's not just Southwest that's rallying over the last 2 weeks. It's Delta hitting record highs. It's United Airlines. It's American. They're all doing really well because they haven't seen any pullback in demand at this point. We are in that holiday travel season, so that's a benefit also. But you start taking a look at crude oil and jet fuel prices going down to levels that we haven't seen for years. That's going to be a definite benefit for this company, on top of the upgrade that we saw at Barclays today.
Okay, Kevin, what's your take when you look across Southwest and the momentum it's had recently?
Diane and Tom, there was a time not long ago that Southwest was one of the premier airlines in this country, right up with all the efficient names like United and Delta, and it lost its way. It forgot to update their technology. It had that horrible Christmas season a couple of years ago, and it's been in a winter ever since then. So slowly but surely, this is still a well-run company, but they're clawing themselves out of this, getting their technology up to date, becoming a real airline where you have seats and all these things that the other assigned seats and boarding and luggage and all the things that make these other airlines more profitable. Now, but more legroom, by the way, too. You're not just packed in there anymore. So the tweaks that they're making are finally starting to pay off. And this is a company I think has a fairly bright future if they don't have another one of those mishaps like they did a couple years ago. That was brutal, and it took forever for this stock to recover from that. Maybe it's starting to now. The Barclays upgrade signals that maybe they're through that really rough period in their history.
You guys chuckle out of me, Captain, because when you said now we'll have seats, we always have seats, not like it's the bus where we have to hold up and hope we don't fall. I know, I got you caught yourself, you caught it. It's been an outperforming year-to-date compared to the S&P 500, but let's go from sky to the ground. We got Ford in focus today. Initially, those shares were shaking off the news that the company will take about $19.5 billion in special charges. But now, as we hit the afternoon hours, shares are, under a little bit of pressure. Tom, what's your take when you look across this? Because initially it looked like the market was shaking this off and saying, okay, it looks like some of this was in the past, so we don't have to account for this. What's your thought?
Well, I think if you take a look at the legacy automakers, GM's right in there, GM's hitting 25-year highs today, is the fact that they've become a little bit, a little bit more flexible as far as pivoting at this point. If you take a look at the push away from EVs, they're going to start ramping up hybrid. That seems to have worked so far. They're going to continue to do that, dropping this higher priced F-150 Lightning that wasn't selling well because it was such a high price point. Internal combustion engines, ICE engines, they're cheaper to produce, and they still got great margins. And the companies kind of made that realization that, hey, we're not going to pivot into EVs completely. And then you start looking at the regulatory side. A lot of what the previous administration put into place as far as probably goals that couldn't have been met, that they slapped on some of these automakers, they're kind of pulling back from that now. And that's going to be a benefit for the automakers at this point. Consumers still stretched at this point, but the activity within the space is still pretty robust at this point, even though the prices are high, because the consumer is actually pushing loans for these automobiles down to or out to 7 years and maybe even further in the future. Who knows? But at this point, I think the things that we used to look at with the legacy automakers like GM and Ford was that they were slow moving, right? But now these new CEOs are getting in there and they're pivoting when they have to. And they're making probably better decisions at this point. But going with the hybrid strategy that seems to be working, it doesn't hurt that fuel prices are coming down. That's a little bit more money in the pockets of consumers also. If you continue to look at just the metrics that you see out of the automakers, they haven't seen a real big pullback. The biggest pullback's been in EV sales at this point, and that's why they're pivoting away. Just like GM took a big hit as far as billions of dollars that they've kind of wasted, and Ford, they've thrown in billions of dollars since 2023 into this, and now they get to pull back a little bit, and I think that's what investors are looking at here.
And the EV space has been more challenged this year. Kevin, what's your takeaway looking across Ford and the announcements they made about the charges and just the impact to shares?
I think this is a major mea culpa by them. The good news is, when they took this $19.5 billion charge to basically wind down a lot of their EV stuff and transition back into a hybrid model. And by the way, kudos to Toyota, who, when everyone was rushing towards EVs, they stayed with the hybrid model. They got a lot of criticism for it, and now it's turning out that was the right model for them, the right business model to do. And this, I believe, that this country, from an infrastructure level, is not ready for EVs, and now you're starting to see that. There was a government push into EVs. Those numbers were not realistic, and now everyone's adjusting back towards normal. Internal combustion engines are still extremely popular. The future is still going to be electric cars, but it's further out unless you can bring those prices down. And when Elon Musk, when everyone was criticizing him for bringing down and cutting margins, lowering the prices, this is why he basically priced them out of the business. And so they couldn't make it work. So it's a good move by Ford. The stock actually rallied for a while because they were able to raise some of their full year guidance, but all things considered, this is an exit of the EV market by Ford, guys.
Well, let's talk service now, you guys. It's gaining some ground today. I mean, it had been weak recently. It's got a mixed bag of analyst adjustments. You got Guggenheim, who's upgrading it to
that's good news. Now.
Zuho, though, lowering its price target. They are still constructive on it, though. Tom, what's your take?
Yeah, I think it's getting bifurcated from the
Now took a beating yesterday.
Now, you look at the Guggenheim report.
Not now, but yesterday. Now took a beating yesterday, but not now. It did yesterday. Now did. Do you understand me now? It's now or never. I'm here. I'm here. We're at the VWAP to spy. / is at the VWAP. I met a real estate broker. It's kind of neat. Young guy. He had chin up in the air. Pretty good 6 foot tall. We have any real estate brokers in here? No. Magnificent. Are you a real estate broker? That's what I thought. Bull versus bear.
bear time. So before we get to these example trades, we have to talk Tesla and your take. Kevin, I'll start with you. I mean, when I was looking at this earlier, there was pressure on Tesla earlier. Then it started, coming to the flat line. Now it's higher. Buy more than $5. If it closes at these levels, we'll hit a new record. Kevin, what's your take?
Yeah, what's your take, Kevin?
I think there's big momentum here. I think the news out of the other car companies is actually good news for Tesla. You saw the note that Zuho raised their price target to $530 from $475. Hitting the tape right now. Morgan Stanley, here's the headline: seen meaningfully expanding robotaxi fleet in 2026. All the futuristic things we were talking about with robotics, robotaxis, full self-driving, those are not the future anymore. Those are coming soon. And now some of the stories coming out that Tesla, if you want full self-driving in those cars, it's a software update. You don't have to buy a new Tesla to do that. So all that is a software update. So Tesla's got massive momentum now. You're starting to see it in the name, and it's hitting new highs, Diane. I tell you, I'm a big fan of the news flow, and the news flow in Tesla is all positive right now.
Yeah, the news flow seems to be on its side in an upbeat way, especially lately. Tom, what's your take when you look across Tesla?
Yeah, we talk about this one quite a bit.
Yeah, you badmouth a lot.
The stock is not based on EV sales because if you looked at November U.S. sales, they fell about 23% to about 39,800 from over 51,000 a year ago. So it's not,
shut up.
The positive price action, as Kevin mentioned, isn't because of EV sales at all. And those are going away. Those sales are starting to
right.
The fact that you don't get the tax credit anymore. And people are switching back to ICE engines or hybrid at this point. But we always talk about this one. It's bifurcated, just from the analysts, from individual investors. You either love it or you don't. And you take a look at the expectations moving forward. Robotaxi rollout to over 30 cities in 2026. That's what they're talking about. They're continually upgrading their full self-driving. They're trying to work in the fact that they can get rid of the driver in the robo-taxis that they existing have right now in Austin and another city, and that's probably a benefit for them. You throw in the humanoid robots also, and the expectations on that side. Yeah, there's a lot of hype around this stock. It's run up pretty far, pretty fast, back to those highs that we saw last December. So yeah, it seems like the momentum's with this one.
Yeah, and I know we have a headline up saying the all-time high of 488. That was an intraday high, so we'll see if it hits that. It was all about this time last year, 17 to 18 key days on the calendar as it relates to those highs.
Look good.
So let's get into the example trades. Kevin, let's start out with yours. What's the approach today?
So the paper money trade that I'm looking for, I'm the bull side of
paper
the bull bear
money
discussion, Diane, and I looked at something. Remember, the good news is you have elevated levels of implied volatility in that front expiration. So if you think this thing could go, it's only Tuesday. I looked at a very short term, buying December 26th, selling December 19th, the 495 call calendar. Now, I did this $5 ago. I put it in about $3.90. It's now trading about $4.40 because the stock has moved about $5 higher since we put this in. Now the vol has come in a little bit. They expect to move was 20. Now it's about just under $15. So the strikes actually still line up at $495. So the 1 week $495 call calendar, Tom, it's collecting theta, it's bullish, and you can extend duration into a type of a vertical spread if it gets up towards 495. But this is one that is looking for a move at or near the 495 strike, in line with that expected move for the day, the expected move for the week, about $21. So a little higher even now. Tom?
Yeah, let's break this one down. The 495 strike going out to the December 26th weekly option. That's expiring in 10 days. Buy that 495 call. sell that same $4.95 call in the near term December 19th options that expire in just 3 days, paying roughly about $3.90 debit we've got on here. As Kevin mentioned, it's a little bit higher because the stock's moved higher. It's over 15 bucks off of its session lows here. But the debit you pay is going to be your risk. So if you pay $430 bucks per spread. If you pay $390 bucks per spread. But I think the key here is you want it to go up and grind up towards new all-time highs at $495. But you've probably got a range between just above 470 on the downside and just below maybe or near 520 on the upside to potentially be profitable on this 1 week wide bullish call calendar here that expires in 10 days. I think one of the big things is you're selling the near-term options that have higher time decay. So this is positive theta type of trade. The 495 calls that are about 15 bucks out of the money to the upside, those still have $4.30 worth of extrinsic option premium in them. It's $15 above the current share price, and you still have over $4 that need to come out of those options if the stock stays here. So positive time decay on this.
6,800s.
Just grind up towards that 495 level. But hey, even if it remains here, you could potentially be profitable on this range-bound, slightly bullish call calendar here, taking advantage maybe the lower vol as the stock's risen to those all-time highs. But Kevin, I'm going to flip the script on you. And this is more directionally and a little bit more aggressive to the downside here in Tesla. We're not to the January 2nd weekly option, so we're going to get rid of some of that maybe volatility around the holidays here that expires in about 17 days. I'm going to buy an unbalanced put butterfly if you think maybe it's time for this stock to kind of maybe consolidate, pull back a little bit. We're going to buy one of the 480 strike puts that's at the money. We're going to sell two of the 460 strike puts, that's where you want it to go, and then buy one of the 455 strike puts. So in essence, you're buying that $20 wide bearish put vertical, offsetting some of the cost by selling a $5 wide put vertical with that same common 460 strike where you sold two options. You're going to pay roughly, I've got 740 debit on here, that's where it was trading earlier. It's trading closer to 710 right now, so you get it a little bit cheaper, but that's because the stock has moved higher. Now, if you pay that $740 debit for it, there's your risk, $740 per spread. You need the stock to go below 472.60 to the downside thereabouts to get below that break even where you start to see some profitability on this one, Kevin. But this is almost like a moderately bearish kind of look at this trade, Kevin, over the next 2.5 weeks.
Yeah, definitely directional, about 12.5 short deltas. And you're looking for a move towards that 460 strike. Remember, the move we're looking at right now is about $15 or $20 for the week. All you did was look at a $20 move on the downside and do the 480, 460. Then you sold the 460, 455 to lower that net debit. You're looking for a move right to as close to 460 as you can get, Tom. However, because you're unbalanced, because you're $20 wide and $5 wide on your verticals, you hold on to profits on the downside as far as it goes.
Yeah, and as you mentioned, even if it goes below the 455 strike, because you made it unbalanced, or we made it unbalanced, or a broken wing butterfly, is the fact that you still have more than a double the profitability below the 455 level at this point. So it gives you that exposure to the downside, but it lowers your initial cost on this, as opposed to maybe buying the 480, 460 put vertical. That's still a bearish trade, Diane. But this one, offsetting some of the costs and debit on this, and that basically takes away some of the risk on it. But you lose some profitability below 455 on this bearish put butterfly here to the downside, kind of going against Kevin's bullish call calendar.
All right, there you have it. That's the bull-bear debate on Tesla today. Thanks, guys. Coming up, we've got cash tags. The team from Lightfolio will be along with news and data on Darden Restaurants. Scott earnings due later this week. Stay right here on Schwab Network. Fast Market. We'll be right back.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you know, you could have done better.
goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Vardis live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market here on the Schwab Network. I'm Diane King Hall alongside Tom White in our Chicago studio. Time now for our cash tag segment. For that, we want to bring in our next guest, and that is Landon Swan, co-founder of Lightfolio. Today, taking a look at Darden Restaurants. All right, Landon, when I look across one of your charts, I notice what comes to mind is the K-shaped economy, right? And one of the things I notice is the lack of momentum I see, for instance, in Capital Grille, very little momentum in Longhorn. How should we interpret your latest data?
Yeah, I think what we're seeing is it's kind of interesting because when we talk about how the retail sector has been doing this holiday season has been really strong. I mean, the data, we expected it, frankly, to be weaker with the K-shaped narrative, but we're seeing a lot of strength coming from people. People are spending, consumers are spending a lot retail-wise, but not so much in restaurants, and it's actually making us wonder if maybe there's a trade-off there. Maybe, the gifts are taking priority over the dining experiences, and so we already knew that people were trading down for sure. In fact, Olive Garden even talked about that in their last earnings report. Even though the customer stays within their portfolio, Darden is making less because they're trading down their smaller margins. But you can see here across some of their platforms, Chewy's the big winner. I mean, that was a great acquisition for them. But some of the names that give us a lot of concern, obviously Olive Garden is the one that should stick out to everyone. That's their biggest one, 40% of their revenue. And that number is particularly concerning because if you look at what our data was last quarter, we had them at +8. Same-store sales were basically +6. So we were pretty close now. Now we've got them at -12. Now, I'm not saying they're going to come in at -12 same-store sales, but it's a big shift to the other side. And then again, very similarly, if you look at Longhorn, they were +5. For our data last quarter, and that's what they came in at same-store sales. Now we got them at -1, or +1, excuse me. So it's still a shift in the wrong direction, though. But Olive Garden is the big one, really moving in the wrong direction. And I think it has a lot to do with, again, people prioritizing what they've got money to spend on. It looks like the priority is spending on physical goods and experiences, trips, things like that, but not so much dining on this. And if you're forcing people to choose, that's what they're going with. We're also seeing that, as they mentioned in their last report, business dinners during the week are decreasing significantly. It's just not as much, especially at those high-profile, those higher earning restaurants with higher cost restaurants. So a little bit of a concern on Darden. And if you look at what happened last quarter, I mean, I think they went from like 209 to 192 or something like that on earnings report. They dipped even lower than that, but over the last month or so, they've made a nice rebound, which in my mind, is a good setup for a bit of a bearish look going into this one, just because, again, their two biggest names that we've got have trended in the wrong direction on the data, and I think that they may come in soft here on this earnings report.
And when you take a look at their portfolio, they've got everything, right? They've got Longhorn, they've got the high end with Ruth Chris and Capital Grille, but then, Olive Garden, which is their staple. Are you guys seeing any traffic flows across all these restaurants, these casual ones? Because Olive Garden was doing well on these meal deals, right? The inflation buster meal deals. Are you guys seeing any let up in traffic for any of these days? Because it looks like a lot of your data is starting to weaken here, along with the stock, which is off about 19% from those all-time highs we saw about 8 months ago.
Yeah, absolutely. In fact, when you look at the chart of that kind of combines everything, that line chart that we've got, you can see overall the shift on all of their portfolio moving in the wrong direction. There's actually a bit of a divergence when you look at the stock price versus the blue line, which is our data. It's not huge, but it has moved apart. It's going in the wrong direction, and again, that is led by Olive Garden to the downside. And just based on what we're seeing and what we're hearing from social media and how people talk, I think that value has been really important. So I'm a little surprised to see the weakness coming from Olive Garden, because they have made a definite effort to get that, become a value place. I mean, it made sense. I mean, if you're going to McDonald's to spend $12 or $15, why not go to Olive Garden to spend $12 or $15? It's a better experience, it's better food, and I think that was their case that they made to people. It did pay off for a little while, but maybe there's some fatigue. I'm not sure, but I just know that over the last quarter they shifted from +8 to -12, and that's a big move. Again, Longhorn was a 4-point move in the wrong direction. This is a 20-point move in the wrong direction. It's by their revenue leader. 40% of their revenue comes from Olive Garden. So I think that's really the story, is what's going on with Olive Garden. Why have people started to fall out of favor with it? I know they've got some problems with beef prices and imports on shrimp prices, things like that. I don't think that's all of it. I think that, again, some people are having to choose between, do I get, do all the loved ones get all the gifts that they got last year, or do we go out to eat? And I think people are choosing, let's give them all the gifts and let's hold off on eating for just a little while. So this may be just some temporary pain, but I don't think investors are going to like hearing it either way.
So you think it may be temporary pain? Because that's a good point that you brought up in terms of the trends you're noticing where consumers are putting their dollars. Because, for instance, just anecdotally speaking, when I went out recently with my son, I was like, oh my gosh, this is so expensive to eat. And I'm like, it's so much cheaper to eat at home. I wonder if the competition it's partly competition on the home front. It's just cheaper to cook at home. And as you mentioned, the gifts. People still want Christmas.
Yeah, I think you're right, and so we did see a lot of the themes kind of playing into Darden's favor for a while, depending on which brand you're talking about. The trade down was working. I mean, Olive Garden is a trade down for some people, and it's a trade up for others. It just depends on what you're talking about. But they were a value play for a while there, where they hadn't been. I think that was a good move for them. Again, I think that's where they got to +8 on the last quarter, but now it's shifted, and so we're a little bit concerned there. But I see so many of these trends moving in the direction of, it may be just temporary, but you can see here, if you look at some of these competitors, Darden started on this list at -6, where Bloom and Outback is top of the list. So some pretty interesting dynamics that we've got going on right now. It seems that restaurants overall are on the wrong side of the trading economy, or the trade down economy right now. I think it's maybe a choice economy right now, right? It's not just, well, I can eat Olive Garden instead of McDonald's, or I'll eat Olive Garden instead of Ruth's Chris. It's, I want to get my kid that gift instead of going to Olive Garden. I think that may be what's happening out there. We'll see if the data comes in as we predict. We'll see if they're able to sort of spin it that way and to say, look, this may be just a little bit of a temporary thing. The data early on, and after this, we expect to do better in January. I'm not sure, but again, just based on the stock running up a little bit over the last bit, and all of the data on the top 2 brands moving in the wrong direction, has us set up for a bearish play. Not like a push your chips in and buy out of the money puts, but a disappointing earnings report from Darden Restaurants today.
We just got a new phrase there, choice economy, different than the K-shaped economy that we've been talking about for a while. Thank you, Landon. That is Landon Swan, co-founder of Likefolio. All right, for the trading perspective on all things Darden, let's bring Kevin back in here for you guys to have a final thought on this, Tom, based on the insights from the Likefolio team. Tom?
Yeah, it's kind of reflective if you look at a one-year chart, how, everything was going well for a lot of these fast casual or casual restaurants, just because they could offset maybe some of the losses on some of their names, like the high end for Darden, while Olive Garden was doing well, Longhorn was doing really well also, kind of offset some of the losses there. But I mean, the stock last quarter pulled back pretty significantly post-earnings. Brinker had a decent, one of their competitors had a decent report here, Kevin, but the option market, Kev, pricing in about a plus or minus $11 move, and I think that's probably the, as far as Likefolio data, that's the most bearish I've heard those guys talk about this stock in a while.
You guys are bringing me down. You're taking me out of the Christmas spirit. By the way, my own personal influence, I was just in a Seasons 52 restaurant, packed, loaded. And that's one of Darden's signature restaurants that they serve everything under 550 calories or below. I think, remember, this stock is already sold off, and the problems with that young consumer, that's that 25 to 35 group. I'm not sure that's a Darden restaurant customer. I think they'd like it to be, but I'm not sure it is. Tom, I'm a little more bullish on this than everyone else is. So why? Because of the sell-off, because of their ability to manage everything. The job they did in COVID, it was spectacular how they managed expenses. I think they'll continue to do that. So I looked at something where, remember, they don't have weeklies. So you have to, I went out to the January 16th expiration, bought the 185 call, and then went to the December expiration, sold the 200 call, Tom. So if you look at the move out to expiration, it's about $11.50 now. I'm doing the 185.90. I put it in at $6.15. It's trading right there at $6.15. So I'm doing a call diagonal in Darden restaurants with a month, and then you could, extend duration and make this a vertical spread. But right now, I'm looking for a little bit of recovery. I think the price action, where it's back up through the 50-day moving average, is pretty impressive, guys.
Yeah, let's break this one down. Because they don't have weeklies, that's where you got to start adjusting maybe the length and duration of your trades. But let's get into Kevin's example here. January 16th monthly options, so just about a month until expiration. Buy the at-the-money 185 strike call. It's got the higher delta, right? It reacts more like the stock. Then against it, about $15 higher in the D19 monthly options that expire in just a few days. Sell the 200 strike call, $15 wide. Bullish call diagonal, you're paying only $6.15 debit for it, so less than half the width of this call diagonal because of the vol dispersion that we talk about, where you're buying a lower volatility out in January on that 185 call, selling higher volatility in that near-term December 19th 200 strike call. Pay a $6.15 debit. Anything above about 188, 189 is going to be potential profitability on this. But you can see here from the risk profile, you make the most money on this type of bullish directional trade up or near that 200 level, but because you're paying less than half the width of this call diagonal, anything above maybe 188, 189 is going to be profitability on this. Kevin, you mentioned this is a bullish example trade taking advantage of that vol dispersion. I was just looking at if you wanted to flip it and go along with Likefolio's data on this, if you were to buy the January 185 strike put and then sell the near-term December 19th, the monthly options on the 170, so $15 wide bearish put diagonal, you're paying about the same, about $6.20, so that would kind of flip this, but you're talking about a bearish strategy, but using the same strategy to take advantage of that vol dispersion on this one. So Kevin, going against Likefolio's grain here, but you could also do a put diagonal if you follow Likefolio and think it's going to go lower, but Kevin's is definitely bullish here, Diane.
All right, that's good stuff there. We've got the breakdown coming up, guys. Got to look across Lennar. It's got earnings due after the close of trading today. It's been a difficult year for the home builders. We'll be right back.
Stay connected to the markets in the Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on the Schwab Network. I'm Diane King Hall, live on board the big board. Before we get to the breakdown, let me give you a check on where markets stand as we get closer to the bottom of this hour. We are still looking at some red on the screen and weakening throughout the hour. The S&P 500 lower by more than 0.5% now. Dow lower by nearly 0.75%. NASDAQ 100, which was positive at the top of this hour, now lower.
Nose.
A little bit more than 0.25% there. Russell 2000 lower by 0.7%. The housing sector has continued to struggle in 2025 amid affordability and inventory challenges, and Lennar is next on deck.
Okay, here we
to
go.
release its quarterly results. Those come after the close of trading today. Analysts are expecting the home builder to post revenue of more than $9.1 billion. But the big question will be, how much did Lennar have to rely on incentives to stoke demand? Time now for the breakdown. For that, we want to welcome in George Silla, Senior Markets Correspondent, for the fundamental look at Lennar. So, George, Lennar's got results due after the bell today. Home builders have had a difficult year. I just wonder, well, first, I guess let's go through the expectations for this one. What's the expectation?
Yeah, I mean, so if you look at just the EPS numbers, $2.23 estimated. Now that's expected to be down 44% compared to last year, where the company printed $4.03. If you look at top line sales, expected to be down about 8% to $9.13 billion versus last year's $9.95 billion. So again, take that into consideration. The quarter that they're about to report, ending, of course, last time around, is expected to be down both in sales and earnings. I think the other thing that investors and analysts will be looking for is the scorecard, and the scorecard is attributed to Lennar. Prints in terms of new orders, estimates have between 20 and 21,000. If you look at average selling prices as well, 380 to 390,000. The other thing is one of the focal points for Lennar, which is the largest home builder by revenue, generating about $34 billion based on trailing 4 quarters. Financial service operating earnings. This again includes things like mortgage services, real estate services, even insurance pass-through services that the company's expected to continue to generate. Now, The thing about Lennar is, yes, it's a very challenging environment. If you look at the chart, the company printed about $191 just going back to, last September. So the stock is down significantly, down year to date as well, about 22%. One of the things you have to be mindful of is, irrespective of price getting cheaper, it is not getting cheaper in terms of earnings. And what I mean by this is that as prices are moving down, the earnings estimates are actually coming down on a consensus basis. Going back to last quarter, they were around $8.95 for this year. Now it's $8.21. Next year, they were around $9.85, all the way down now to $8.87. So we're looking at prints in terms of earnings multiples, 14.5 for this year. We're looking at 13.5 by next year's earnings. Those earnings multiples haven't changed, is my point, irrespective of the fact that price continues to drift lower. So you get an idea that the estimates are continuing to fall for Lennar. So that might present a challenge going forward, especially if they don't hit some of their other scorecard metrics like gross margins, which are expected to be around 17.5% of sales.
And George, the thing is that I know when I talk to different analysts in the space, the thing that seems to be most concerning is they've continued to have to do incentives that's been eating into margins. And it doesn't seem like there's necessarily light at the end of the tunnel. It immediately on that and having to do all the incentives.
Exactly, George.
Selling prices have come down. Final thought when you look across Lennar and the home builders.
Well, I think a lot of these factors, play out to what we're seeing in terms of the distribution of price action in the chart.
L-E-N.
If you do consider,
I always did like that name.
The business roughly $29 billion, they do have essentially about $7.4 billion in cash. Now that has increased by about $1.1 billion since last quarter. But the debt load also increased by $1.1 billion. So they did issue some debt as of late. At least the last quarter, as far as I can see, they had that cash, which is kind of a substantive position, about 25% of the market cap. So they do have financial flexibility. They do have capital investment capacity to expand their business. The question is the market going to be receptive to new capital expenditures, new homes, or are they going to have to continue to discount the homes to move the inventory off their books? And that essentially is going to hurt the EPS numbers as well as the top line sales for 24.
All right, thank you, George. That's George Sillis, our senior markets correspondent, with the fundamental look, the breakdown on Lennar ahead of its results. Let's get Tom and Kevin back in here for example trade purposes. This time Tom's got the example trade in Lennar. So Tom, you heard the breakdown there. What's the approach that you want to take?
Yeah, the bar's low, but maybe it should be low. I wrote about this in our newsletter today, just due to the fact that interest rates are still elevated. 30-year fixed mortgage rate been bouncing around between about 6.2 and 6.5%. That's still elevated. I mean, maybe not for Kevin and I. I mean, those are standard kind of interest rates that we saw 25 years ago. But at the same time, they're still elevated compared to what we've seen over the last 10 years. And I think this is one of those names, and maybe this sector has been in that rolling recession due to the fact that, hey, you know what? It stagnates people moving when you've got low interest rates versus where they are right now. A lot of people are locked in under 3, under 4, and that's not going to make anybody move if your monthly payment goes up. So they've got some headwinds. Margins are getting squeezed due to incentives also. I looked at this one. The option market's pricing in, Kev, about a $6.40 move either way in the shares. The stock's pulled back about 13% this year, and far off those highs that we saw just about 13, 14 months ago of over $193 a share. So yeah, maybe recessionary here movement in the sector. So Kev, I looked at something. If you're going to take a directional bias, even with earnings coming up, there's not a ton of extrinsic option premium. The volatility is not like super elevated at this point going into the report. Only a plus or minus basically 5.5%, 6% move in the shares expected. But I went out to all the way to the February monthly cycle here, Kev, looked at something directional. If you're bullish on this name, this may work out if the stock does move higher or maybe rebound. But give yourself 66 days in this position. Buy the at-the-money 115 strike call, in the money by a couple
vertical.
Bucks, and then again sell the 130 strike call. So a bullish $15 wide call vertical, paying roughly about a $6 debit. That's where it's currently trading right about now. So $600 in risk, that can expand to $15 over the next more than 2 months in this trade. So Kevin, taking advantage of not really super elevated implied volatility, but I think the key with this directional bias trade, if you think there's a rebound, you've got plenty of duration. You got over 2 months in this position.
Yeah, 66 days, and then all you did was take that at the money or slightly in the money strike, line up the expected move about $15 out till February 20th, and that helps you create your 115, 130 call vertical. You know, the chart, can it go to 130? Of course it can, right? That's right back to where it was not a very long time ago. So if you're looking for a recovery in this name, this could be a spread that lines up with the implied volatility, the expected move, buying the at the money call, selling about $13, $14 higher, Tom.
Yeah, you make a good point there, Kevin. A week and a half ago, the stock was above $130 a share, so it does have that potential to get above there. If you pay that $6 debit on it, there's your risk, $600 per spread. You can see there, takes your break even up to 121 on a percentage basis. It's not a monster move on this one. Pay a $6 debit, that's your risk. Potential to make an extra $900 if the stock goes above 130 into expiration over the next 66 days. So there you go, Diane. If you think a rebound's coming, this trade gives you duration and maybe some of that flexibility where I don't have to wait 66 days to get paid on something like this if you get the move that you need prior to maybe earnings or prior to that expiration on that front also.
Okay, and speaking of earnings, to recap what the expectation is, Street looking for EPS of $2.23. Revenue is expected to top $9.1 billion. We'll see. It's been a tough year for Lennar. That's going to do it for us today on Fast Market. I'm Diane King, all alongside Tom White and Kevin Hayes. Download the Schwab Network app. It's available in the App Store and tune in 24/7 on schwabnetwork.com. Stick around. You've got Next Gen Investing coming up.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey Bob.
Hey Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, I had a stroke?
Yes. Now we're in the car together almost daily. I started to realize what can I pick up from my dad. He's been with Schwab for a long time.
Jim, my financial
professional consultant. I programmed 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at schwabnetwork.com.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey. And Alex, as we check out the markets here, we were talking before the show about how it does feel substantial. We are down, about 1% in the Dow as well as the Russell. So it's definitely some more substantial pressure than we've seen to kick off our show in the last several sessions. But it's also coming off of basically markets being at all-time highs.
Yeah, so I always feel the responsibility that we bear as market commentators on days like this to kind of take a step back, take that, big picture viewpoint and kind of, I guess, illustrate that, not everything's falling apart. And that doesn't mean, and I'm the first to say, that doesn't mean there's not risks. That doesn't mean that it might turn into something and snowball into something far greater than it's been so far. But it does feel like, a very broad sell-off today. It does feel like every attempted
Jim's getting ready.
failed. And it's felt that way for a couple days now. And then you look over at where the S&P 500 is at 6760. We're only a couple days off of all-time highs. We're within, a percent or two, and maybe 2.5% of the all-time close. And you start looking at it and you say, maybe we've been a little spoiled. That doesn't mean that you shouldn't demand, success in things and performance that you want. But at the same time, it's like we know these things don't happen in a straight line. How far removed are we already from that massive drawdown that we saw in the first and second quarter of this year? And almost quickly forget, things were really scary then, and how quickly they recovered. And I'm not calling for something similar like that again. It's certainly always lingering and looming around the corner, some sort of drawdown. But you look at this market, and in April, I think we'd be over the moon with the performance that we ultimately had this year. In early April, it really looked like things are falling apart a little bit.
And for good reason. We were talking about basically the entire economic pricing system that we knew as the United States. We operated in a very different import and export world than we do currently. And so I do think that with all of these inflationary fears, there's proof in the pudding, frankly, about the strength of the U.S. consumer, also the price of oil, which I know we don't frequently talk about on the show, but you're seeing some deflationary measures that are also encouraging.
Yeah, to some extent, right? Because deflation can be scary if it's overdone. So we are threading a very tight needle. You look at the jobs figures, that 3-month average is 20,000. Well, it's still a positive number. That is something to be happy about. And for those who were worried about cost pressures, it's hard to have an inflationary environment when growth is really anemic. And we're getting to that point where we're kind of in this holding pattern. But I do think it's, important to look back in time and say, look, April and the sell-off in March, objectively that was overreaction, and the fears were overblown. We can say that in hindsight, I think now. But that doesn't mean that every time we go down that you shrug it off and you kind of do that stocks only go up things. That's not true either necessarily. Now over time, history has shown us that risk assets like equities do outperform over time, simply, partially because they're priced in dollars, and we know that the value of the dollar has eroded over time in terms of purchasing power, just how the system's built. But I know we're kind of saying two things at once. I would say is we overblow the fear, but we also over-rotate into complacency too. It's somewhere a healthy, pragmatic place is somewhere in between those two places.
I also think we diminish, the strength. I feel like anytime we see positive economic figures, any positive developments as far as relationship with China, it's like we're so quick to be like, well, this is right now, wait and see. But oftentimes good news is good news.
Yeah, I think that's a really good way to put it. It's well put in the sense that we're sitting just off all-time highs, not for a coincidence.
Mm-hmm.
We're in this productivity boom from what this technology that is in the process of being rolled out will potentially bring. And technology largely throughout history has been productivity positive and deflationary in the sense that, it's just more efficient. It's not been negative deflationary. Now, there are questions we don't shy away from them. We've talked about, if you eliminate jobs, which seems to be the easiest way to make some of these technology investments make sense, that adds some, other questions to the mix. But, we're sitting just off all-time highs. Interest rates have been relatively range-bound. Volatility is very, very normalized into where it is. There's a lot going well now, and that's not to say that we couldn't continue to sell off, but we'd be selling off for a very different reason, it seems, than we have in times past.
Yeah, because it did feel like, in the spring, for example, there was, good reason to have
there was fear.
Yeah,
there was definitely fear.
Even more widespread than just, market participants. There was fear, I think, in the general country where people were saying we're going to curb our spending, we're going to change our purchasing habits because we're concerned about the price of goods. And so I think we started to see that normalize. It's still, I think, being reallocated into different pockets, but all that to be said, you look back at the year that was, and I definitely agree that from April to now, you'd be very relieved with 2025's overall performance. And the analyst community has been busy, and so that's really where we will focus much of our attention for the next hour on. We have a lot of analyst upgrades, downgrades, just basically updated coverage as we do approach Force 2026. So we'll dive into some of these analyst calls to kick off the show today, and then we'll also look at some charts and example trades in Lennar as well as General Mills. Now, for FOMO, we're discussing a name that is not frequently a FOMO candidate, that is Southwest Airlines, which is getting a positive call out of Barclays with all of this massive revenue opportunity from, of course, now having assigned seats, having to pay various baggage fees, and being more like a traditional airline operator. And so Barclays sees this massive opportunity for Southwest. We'll dive into that note later on. We'll also discuss some broader auto market trends. As we know, Tesla, Ford, GM, Rivian, they've all been busy as of late, and we'll close out our show very timely, of course, with a discussion on Ford, which actually had some of the most interesting news of the day, is that now is expecting to report about $19 billion in special items related to this restructuring of its business related to EVs. So that is not a small price tag.
I'm really looking forward to that conversation with George, because agree, disagree, whatever, dollars, all that, that's part of the story. It's a very important part of the story. But I respect the decisive nature of the decision and the quick pivot. If something's not working and it's sort of a tease, stop doing it. Find something else. That is your responsibility to stakeholders, and apparently Ford is leaning into that and really making a sharp pivot. So how different things have turned out over the last several years, and some of those projections we were getting just a few years ago in terms of electric vehicles, but maybe a conversation for later on. Let's get some of these movers, though. Okta on our list. I'm shocked to see there's actually some green on the screen here. Ford's, bit of stock that's done pretty well, but it's, lost its gains. Okta is still up almost 2%.
Okay, and I think that the Okta note is especially interesting because it highlights something that a lot of the analysts were more cautious on yesterday. So it just goes to show what a different session can bring. But Jefferies is upgrading Okta to buy from hold. Price target was raised up to $125 to share from $90. So nice upside from here. But this was part of their broader 2026 software outlook. They said Okta has a significant opportunity as it does attempt to build a complete identity platform and capture growing agentic demand. They also do believe the stock's value dislocation has become too significant as the company has faced several fundamental catalysts now in fiscal 2027 from various things like improved execution, secular agentic tailwinds, as well as the potential 4 estimate revisions, of course, to the upside. So we talked a lot about these software names yesterday because there was a different software world. Obviously, not all software is created equal, but more of that caution out of like ServiceNow, Adobe, but Okta, of course, has a very different type of software exposure, being more into this cybersecurity nature of things, where I do have to say, I fully believe if you're a believer of AI, you have to be a believer of cybersecurity because the two go hand in hand.
Yeah, it's kind of in a specific part of it, which is like authentication and identification. And so you start thinking about the more we interact with data and things that need to be protected, whether that's as consumers or as agents of big businesses, small businesses, and medium-sized businesses. What is ubiquitous across all that? You need the protection. And what's a really, really important way to start protecting some of that data? Identity and authentication. So, yeah, fascinating company, but also not the only player in the space. And so that's important to know, too. Just because something is needed doesn't mean that a company that provides that's going to be the winner itself. We'll stay within sort of this 2026 outlook season now for analysts. But I'm not sure this Mizuho note or not is for Zscaler, but I'm just going to say it's a very busy time for analysts.
It is. So yeah, okay, and speaking to our cybersecurity world, and obviously Zscaler, different than Okta, but more similar than, say, just comparing it to like a broader semiconductor name. But Mizuho is upgrading shares of Zscaler to outperform from neutral. Unchanged price target, though, of 310, so also would imply significant upside from where we are currently trading. But they cited valuation, saying that shares are now, again, too attractive to ignore, and that they, having sold off despite reporting a very solid fiscal first quarter, they also are confident that Zscaler remains very well positioned within Zero Trust. With the stock down about 31% since the end of October, investors, they said, are now being very well compensated for some of that sort of downtrend, downward price activity that we've seen, frankly, in Zscaler shares. So I will say that from, of course, us covering just the cybersecurity stocks post these earnings moves, broadly we saw a lot of weakness post earnings, but that doesn't mean that the earnings were bad, because I will say that from a broad standpoint, we saw really great numbers out of cybersecurity this past quarter, and frankly, I think that another good point is to be made, hey, a lot of these names that sold off, always an opportunity.
Yeah, exactly right. And I do think this was a part of Greg Moskowitz' 2026 update, because he's the same analyst that covers ServiceNow. And we have a ServiceNow Mizuho note, and I know there's also, I think, a Guggenheim one as well that we're going to talk about. Also, I want to take a second, Jenny, before we get to some of those news headlines, just do a PSA. ServiceNow is scheduled, it looks like, for a split on Thursday, 5 for 1. So when you see a very different price tag, if you're an investor, just know that's why.
And that's a great reminder, and obviously an important event to keep on the radar. And we've seen stock splits in the past be actually a huge boom for shares. Not huge, but oftentimes it has not really been that way in the last year or so. It's not necessarily a shoe that you'll see this be a huge upside catalyst. I mean, I know stock splits they shouldn't be a huge upside catalyst, but I feel like we've seen more evidence of, hey, it doesn't always mean that necessarily everyone wants to then buy your shares.
Yeah, well, Netflix is a counterexample. Certainly, Chipotle has been a counterexample that it's not always well, but NVIDIA made a stock split, what was it, like 120, adjusted for the split, at least one of the splits ago, and it's 175. Oh, and by the way, it's like $40 off its highs. So I always said it doesn't change the value, but it may spark interest, because it may be a stock that was $700, now trading at like $150 or whatever it would be. That invites a new type of investor to consider buying it.
Yeah, there's a psychological level, I think, of course, feeling like you're getting shares in a more relatively, say, capital efficient way than previously prior to splits. But to dive into some of these ServiceNow news that we're seeing today, we are seeing some actually positivity after yesterday. It was pretty downbeat. Guggenheim did upgrade shares of ServiceNow to neutral. And we're seeing a nice % gain today after somewhat taking on the chin yesterday. But they did say that valuation, again, behind some of these upgrades, as they did say there could be further downside from here. But they've always seen this name as a quality software franchise. So, I mean, talk about direct contradiction with a lot of the pessimism yesterday. Part of that was also due to a bit of an acquisition news. So don't necessarily take yesterday's price activity as like driven by one analyst. It was just one conviction. Right now we are parsing through all of the various expectations for 2026, and I want to like keep track of this better because for all the analyst notes we talk about, it's like how much of these, obviously get paid to be correct and paid to make a call, but you always like to know like the end of each year how many of these calls were correct.
Yeah, well, one thing I would say too is the announcement of the deal was this Armis company, which is like this IT security type company. So that would be, in my mind, and correct me if I'm wrong, it would be kind of a second meaningful pivot into
correct him if he's
cybersecurity.
wrong.
Really ServiceNow's bread and butter, but they're creating a new vertical within their company. They're kind of a data management, and it does seamlessly fit within sort of this idea of workflows.
You're
and
wrong.
That works on, but at the same time, Mizzou, although they have an outperform rating, Greg Moskowitz again, as part of this 2026 outlook, lowers the price ratio to the pre-split level of 10.50 down from 11.50. So the bull is getting a little bit less bullish, and the bear is getting a little bit more neutral. So take that for what it is.
Yes, the Civic Average is a bit more guarded now as we, of course, approach a lot of these predictions for the next year. But what has not been a guarded story as of late has been GE Vernova, which has been on an absolute tear. We're up now 13.7% this month. We are also now up about 106% on the year. And no surprise, a lot of different conviction on this name, but I will say it's pretty overwhelmingly positive, as we did see Morgan Stanley raise its price target to $882 a share with an overweight rating. Goldman also raising its price target to $840 from $735. Also with a buy rating, Wells Fargo, another analyst, $831 from $717 with an overweight rating. So all that to be said, this name has made a really nice move, and it's been one of the more consistent players of this year. It's well above its 15-200 moving averages, and also it's been consistently that way.
I think in some ways too, I'll preface what I'm about to say with
higher lows.
The stories like this one that
we got higher lows.
Very obvious, but have a very clear narrative that you can lay out and say that makes a lot of sense. That's not to say that GE Vernova should be worth what it is now, or it could go higher or go lower, but that this has been a performing stock, given the fact that we know this build out in AI, which has not slowed down, has really changed the dynamics of power demand. And so it's a natural, first order derivative of okay, well, that means you need more electricity, you need more power. Who does that? And it's the same way, in hindsight, some of these quantum computing stocks, rightly or wrongly, it's okay, well, what's a natural place of research and development based off AI and technologies? Quantum computing. I like that there's a very clear fundamental picture, and in hindsight, you're kicking yourself, you're like, how did I not see this if you didn't? All that to be said, though, when you look at this, I think sometimes we forget that what we're looking at is companies, and it's not just numbers on the screen, all these dollars flying around. It can be something that brings some optimism and faith back into the things. Okay, this is the kind of company that makes sense that it's outperforming. There's no questions here. I don't think anybody would argue against that. GE Vernova, right place, right time.
And I will also say this is a great example, and I know every company is different, it doesn't always work this way, but a great example of why sometimes breaking up various aspects of your business can actually be hugely lucrative. We've also seen GE Aerospace, for example, of course, is part of the broader GE company formerly. It's also still up 78% this year and has a market cap almost double that of GE Vernova. So they've both been, separately, very, very successful.
This is such a good point, and there's companies that, we'll not talk about. One of them might be Mag 7, maybe a couple of the names in the Mag 7, where it's they've become conglomerates in a way, and it's what does making an airplane have to do with generating power? Maybe you can tell me, but they seem pretty different. And so it's sometimes the sum of the parts actually isn't greater as a whole, they're actually better as parts.
Alphabet, Microsoft,
Amazon is a cloud company and an e-commerce company.
Yeah, we can just go down the list of these tech conglomerates, behemoths, if you will, that have just gotten somewhat difficult to sort of gauge, what part of their business does she will care about on the back of some of these earnings announcements and various news updates. But we'll leave it there for the top of our show today. Coming up next, though, it's time to look at Lennar as well as General Mills, which very different performers than a lot of the winners that we were just discussing. As Lennar here is down about 14%, while General Mills is also seeing some weakness, a pretty substantially different year for the home builders as well as staples.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl?
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time to discuss some charts and some example trades and 2 names ahead of earnings, because even though we are very earnings-light, it's always earnings season if you're a believer, of course. But joining us now is Ben Watson, Senior Manager of Trading Services for Charles Schwab. And so, Ben, first and foremost, thank you so much for joining us on the last full week of trading of the year.
Yeah.
I wish we had 2 better performers to discuss, but always opportunity in some of these names that are a bit downtrodden. So we'll start off with Lennar here. It has not been a super strong quarter thus far for a lot of these home builders, as we're seeing this deferral mindset still weigh on a lot of the performance. But hey, again, always an opportunity. So walk us through the technicals here.
Yeah. And you're absolutely right. I mean, up is an opportunity, down is an opportunity, and so is sideways. It depends on what you trade, what you do with it.
Yep.
And
exactly.
Lennar had been on a little bit of an upward trajectory going into that September timeframe. In fact, it had just seen in really early September a golden cross, the 50 period moving from below to above the 200 periods simple moving average.
It did.
For longer term investors, that can oftentimes be an entry signal, but in this particular case, the promise of that golden cross kind of faded into more sideways movement, because really from that September timeframe till now, it's been oscillating.
See the head and shoulders?
Right around that 110, maybe on the downside, and around that 120, 130 range to the upside. That range is constricting or squeezing down into a narrower area. You can kind of see the symmetrical triangle almost, if you will, as it comes towards the apex of that triangle. Nevertheless, a couple of levels of horizontal support, namely right around that 117 mark, some short-term resistance overhead right around that 121, kind of caught in between the 2 moving averages there as they oscillate sideways. And when you're caught between the moon and New York City, Jenny, what do? Well, you look for some kind of momentum to push one way or the other. This isn't seeing a lot of that going into the earnings announcement, so the earnings could be the catalyst. At the same time, if there's really no change in the expectation from a rate perspective or from demand for new home builds, then it really could be more of the same, more of that sideways trend along that 200 period moving average between the 200 and the 50 here, Jenny.
The one thing is, I think always encouraging is the homeowners have exposure to different types of consumers. Like we know that some are more of the affordable first-time home buyers, others are more exposed to the higher price tag homes.
Right.
They all seem very out of reach to myself, but I can at least appreciate that they offer some diversification across those that are interested in buying a home or purchasing a home for the first time. So really great breakdown on Lennar here. And so now as we do think through looking at Lennar for example trade purposes, again, it has not been a super strong season for home builders, as I feel like we said last quarter, because it was kind of the same narrative being echoed by a lot of the CEOs. But all that to be said, we are hopefully in an environment from like a Fed perspective, a rate perspective, that is becoming a bit easier for home buyers. And I know that this is, I think definitely something that's top of mind for so many consumers right now.
Yeah, and the stock itself has kind of had some fits and starts, right? I think Ben laid that on the chart. It's been pretty range bound. And so you said neutral can be a strategy. Well, that's what we look at here. A neutral, range bound iron condor spread using that elevated implied volatility around this uncertainty of the earnings event to sell some implied volatility, sell some options premium in a risk-defined manner, collecting a credit and looking for kind of a boring, basically unchanged, if possible, earnings report or at least reaction to it. And so this is the December 19th that expires at the end of this week. 118, 117 strangle with $5 wide wings. That'd be the 123 call and the 112 put. It's pretty tight around the current share price, almost like a straddle, if you will. So you're going to get a bigger credit than we typically would give on a $5 wide spread. You'll get the 350 credit for this example. That'll create a max profit if it stands between 117 and 118 at expiration, where you can collect that 350. But it also creates a range between 113.5 to the break even to the downside, and then 121.5 to the upside, where there's some varying degrees of potential profitability. So this is again kind of like some of the other strategies we talked about, Jenny, where the more accurately you project where the stock is, the better it can perform. So the closer to unchanged it is, the better it would do. It does have risk definition though, and the max loss in this case is $150. So looking for a really boring reaction in Lennar post-earnings, and for that to hold throughout the end of the week.
Okay, well, Lennar, of course, today reporting, and then we do get to hear from General Mills, and then tomorrow morning. And so, Ben, walk us through this chart, because they're not the only name that looks quite this disappointing, but frankly, I have been on a cereal kick, so I am especially heartbroken to see that it is just not really resonating, and frankly, it's because it's so expensive. A box of cereal now in the city of Chicago is like $7 or $8. It's insane to me, but I mean, you gotta do what you gotta do, so it's one of my vices right now. So walk us through this chart here and what we can watch out of earnings.
Sounds like, Jenny, you're becoming a serial killer, perhaps, but I'll tell you, with General Mills here, going, it is going sideways. Again, I mean, let's look at it in the context of what we were just looking at with Lennar. In the very short term, November into December, it's been going sideways, kind of along that 45 level of support down there around the bottom. Nevertheless, the longer-term trend has been to the downside, and as it's been continuing to move to the downside, maybe now seeing a little bit of range compression against that 45 support level, so a bit of a descending triangle, if you will. That would give some potential to a downside move, maybe a couple, $3, based on where you measure it from in that price pattern. On the other side of that coin, you've got this little bit of a bullish divergence that's setting itself up on the RSI, where the RSI is making higher lows and a slightly higher high in the context here as prices moving down still. So that is a fairly significant bullish indication, not a guarantee either way. So it could go up, it could go down. The earnings announcement could be the catalyst to push the price out of that descending triangle to the upside, because it's getting deep in the apex. It could be the catalyst to push the price below that 45 level of support. So there's a potential for this to go up fairly large or down fairly large. And a lot of strategies will base their premise on that type of movement. In this case, if the price just stays the same, then I guess investors are just up a creek without a battle. Jenny?
You know what, and unfortunately, I believe you were so correct in the sense of, yes, it looks pretty downbeat, weak at this point, but also, as anyone knows from trading these markets, Looking to go lower can always continue to go lower until I guess you reach the price of zero. But
That's right.
I appreciate Ben Watson, our OG chart master, for all the technical help today as we do approach some of these smaller but still important company earnings. And so now as we trade General Mills, I do think it's important to keep in mind exactly what Ben said, and that's, yeah, you can hope for a top year, but you could also see a continuation of downtrend.
Yeah, and so I think because of that, I looked at a very similar but exactly opposite strategy. It's neutral in the sense that we didn't pick a direction for this example, but looking for a move, either maybe to recent lows or new lows, or perhaps a really sharp reaction, which may seem kind of unique when looking at a consumer staple, but it's all relative, so everything's going to be priced with that in mind. And so,
kind of a bear flag.
50, 45 put.
We've got higher lows.
At the end of this week, 50-cent debit means you have $50 in risk, but there's unlimited profitability. So while the risk profile for the last strategy peaked out in the middle and worked down towards its loss as you went away from unchanged, this is the opposite. Unchanged or staying between 45 and 50 is where the loss takes place, and then unlimited profitability to the upside and quite a bit of profitability potential down to zero to the downside. So looking for the opposite of what we did in Lennar, looking for a very active, big reaction one way or the other in earnings. Your break even to the downside would be 44.5, and then to the upside 50.5 on this one. Max loss again $50. So risk defined, looking for some action and some news perhaps to come out of this report.
Looking for some revival of the staples too. I mean, I love the grocery store stocks, and they have just all been taking it on the chin a bit this year. As pricing is still a concern right now in a very difficult pricing environment for most of the country. So we'll leave it there. We'll be watching those companies as they do report. But coming up next, time to discuss our FOMO stock of the day, which is Southwest Airlines, now in an 11-session winning streak, which is a record-setting streak for the company, and actually our best-performing airline of this year after a more lackluster 2024. So Southwest is really making strides here.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at npedalides and connect with me, Nicole Pedalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. We really started with nothing. He worked hard, and after he passed away, the torch has been passed to me. And my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren planning for their college educations. Someday it'll be their turn.
Welcome back to Next Gen Investing. It's now time for FOMO. Today we are looking at Southwest Airlines with some analyst optimism as this analyst sees a lot of potential from the fact that they're shifting their business model and finally going to see these assigned seats charging for luggage. And I know the Southwest enthusiasts are perhaps not thrilled, but I do tend to think this will not shift the loyalty of the ecosystem, but I'm getting ahead of myself. Marley Caden is, of course, here with us in the studio, host of the Schwab Network. And Marley, break down all of the various thoughts on Southwest, which actually has been a really strong performer of the airline stocks this year.
It certainly has been. I think it's been the best of the performers of the airline stocks. And it has given up some of the gains that we saw earlier when this note first came out, but still up 1.5% on the day on this positive note, this one coming from Barclays. Barclays upgraded Southwest to overweight from equal weight. They have a price target of $56. That is up from $34. Right now they're trading at $42.36. So it is a potential upside of about 30+% from where they're currently trading right now. The firm's saying that they view this new commercial strategy that Jenny just mentioned as charging for bags, offering extra legroom seats, offering assigned seatings as a potential revenue driver. They think this is a positive move for them. They've also said what they call stagnant, if not contracting years in industrial economy for freight carriers and air travel. They've not been bullish on the space for several years. Barclays now said they see what they call idiosyncratic stock opportunities across transports and airlines, with Southwest being one of those opportunities that they believe are. They think the Southwest new strategy will drive material improvement in their relative revenue generation, especially in early 2026. They think we're going to see a lot of this hit right when these changes roll out in January, where you can pay for that extra legroom, you can pay for your assigned seating, which also comes with advanced boarding, which I think a lot of people are willing to pay for, and those options will go live then. Now, they did hit 3.5-year highs today following this note. Southwest year to date up 26%. In just the last week, they've gained about 11%. And these analysts not alone here. Barclays is not alone in their sentiment. TD Cowen up their price target on Southwest to $42 from $31, so not quite as high as the 56 that we're hearing from Barclays. They have a hold rating. BMO upped theirs to a market performing. They initiated coverage and a $43 price target. Citigroup also began coverage on December 4th. They set a neutral rating and a $38 price target. Hold is the average rating for Southwest right now. 11 analysts hold, 5 buys, 4 sells, and the current price target is just a little bit under $39. So below where we're trading right now.
You know, I'm going to make a very, very large leap here, but just hear me out. I do wonder if Southwest in some ways is rolling a bit of the dice here, similar to, I'm going to use a very different company, but what Cracker Barrel did recently, trying to change to get a new group of people to come to your place, and you alienate your existing customer base. Now, the key difference is there's not that many options, and there's none that really mimic Southwest, so maybe you do, but I look at it and say, you're just becoming what you were always trying to be different than in some of these changes. And clearly, if it's revenue generating, that kind of means that it costs more for the everyday person who wants to go fly on these airlines. And at that point, you basically invite a different level of competition because you're no longer different than your competitors. You have to be better or cheaper than your competitors. And I don't know that Southwest is going to be able to compete with the Deltas and the United straight up.
See, okay, that's I guess my personal gripe with Southwest has always been, in recent years, at least like the last decade or so, it's not cheaper. We call them like a low-cost carrier, but I mean, they're really not.
Yeah, I almost see it as it serves a different demo in the sense that it typically uses maybe the second airports in big cities, regional airports, so maybe it has a different client base simply from where it's located, but I don't know, I like the flexibility that Southwest offered. That was part of the reason. I'm not a planner. You can move things around. It sounds like they're getting to where you got to be a planner, and I'm not sure how I feel about Mark. I'm sure you
I don't think you have to be a planner, per se. I don't think they're changing the basis of their business here. I think that they're offering themselves another avenue to make money, right? You can charge for your seat assignment. Doesn't mean you can't have flexible travel plans. You're just going to have to hope that your same seat or something comparable is available on the next flight, or you're forfeiting whatever that upcharge was. I don't think they're getting rid of the flexibility that they're offering versus the other airlines. But yes, is it going to hurt and sting a little when you have to pay for your bags and you've traditionally never paid for them? Absolutely. But will it feel good when you've paid a little bit more to make sure your carry-on gets on the plane? I think that will probably feel okay. Interesting correlation you're drawing between the Cracker Barrel thing. And we know that ended disastrously. I mean, that was one of the worst PR disasters in a while in terms of an advertising choice that had to be rolled back and people got very upset about. I don't see this in the same vein. I don't think they've pivoted so far away. But, you know, Jenny brings up a good point. the prices are not that different. I mean, I'm looking at, I just pulled it up quickly just to look at a flight from Chicago to New York to see, and I could fly Delta for less than I could fly on Southwest right now. So it's interesting in this particular dates that I had stored in my computer. It does beg an interesting question if it's not ultra affordable. And I don't know that I call them a low cost carrier because I think of like Spirit Airlines in that conversation, or Frontier. But it begs the question, if I can get it for the same price on an airline that feels a bit tawnier, am I going to go in that direction?
Well, I'll offer two counterpoints to my own statement, which is one, this is like the least inviting, like consumer switching field, because you have your loyalties, you have your sort of, you're used to operating. And there's a reason Southwest nobody copied Southwest really. So clearly the other business model has more, I guess, endorsements based off how they manage it. But what I would say, and this is sort of to your point that you were just making, Marley, it's harder to hide that you're a little bit more expensive than maybe your perception when you're now offering the exact same service and you're compared side by side. Where maybe before it was like, yeah, you kind of, it's the wall-to-wall.
That's what you did.
You don't pay for bags. You don't charge for switching. You go to the different airports. Well, now it's like, well, now you do get charged for all those things like everybody else. So what are you getting value-wise?
And I think that the entire,
Very nice, James.
has done such a good job of somewhat like hiding some of their
Do
fees.
right.
You used to pay cancellation fees. You used to have to you could not cancel your flight or change your
Randy.
flight. Now they, for the most part, do offer this, but you pay other hidden fees. Like you pay for any seat selection you have on like United, or you pay for like any various carry-on on America. There's all these various
like locked-in travel funds you don't know how to get out of the site.
Yeah, even Southwest, the way they framed all this was like, we're revamping our loyalty program. So if you have a card, you can still have access to a lot of these perks, which I just see right through that. It's just getting really expensive to fly. But all that to be said is you do think they're not trading at Southwest.
6800s just went past the 200.
And having a really nice month of December.
Yeah, it opens some growth opportunities too. Maybe to get more corporate travel. Maybe they can expand international, which we know is a really important revenue driver for these other airlines. But strategy, I mean, the words from the analysts positive. The performance clearly positive over the last quarter, so if you think that's going to continue into the first month of next year, I looked at a bullish call vertical spread, buying the 42.5, selling the 45 call vertical for $1 debit, so it creates a little bit of positive asymmetry. You risk $100 on this example, but you have a chance to make $150. The break even is 43.5. So. This is a strategy that looks for upside into the new year in that first couple of weeks.
LUV.
Continuation of the recent trend. And it's endorsing the recent strength that you've seen from Southwest. As, of course, this is FOMO after all, and nothing induces more FOMO than a nice vacation.
Okay, and I did just check because I was just curious, like for comparison's sake, American Airlines, this is 3% of their revenue now, just these checked bag fees. I mean, they were clocking in $1.3 billion in just, I mean, like basically a 6-month period. So this is, aside from my own personal gripe, is going to be a huge, I think, success story, at least as far as a revenue upside catalyst for Southwest. So perhaps we're seeing a really nice session today and a really nice several sessions as we're now in an 11-session winning streak for Southwest. I appreciate it to Marley Caden, host for the Schwab Network, for that breakdown. Now coming up next, we will stick with our broader theme of transportation. We'll be discussing some of the recent auto market trends and what we can watch now into the new year.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But there's a... Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get out here.
Where are you going?
We're past the 200s.
Schwab, a modern approach to wealth management.
200 SMA.
Download the Schwab Network app and stream live coverage wherever you are. Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
welcome back to Next Gen Investing. It's now time to discuss some broader trends we are seeing in the auto market. This has definitely been a topic of discussion in markets over the last several days, and of course all year long. But I'd like to welcome in now Kevin Roberts, Director in Economic and Market Intelligence at
We broke it.
Kevin, thank you so much for joining us today. We do know that we've seen some evolution and some changes being made in the auto space. So as far as recapping this year, what you're watching into next, walk us through your thoughts.
Yeah, so it's been an interesting, adventurous year in the auto industry. I feel like most years are like that. Obviously, tariffs were one of the major stories at the beginning of the year. Did not have as much of an impact on pricing as much as we thought it might have, but definitely impacted when consumers were purchasing vehicles. And then in the second half, we had the expiration of the EV tax credits, which really pulled ahead a lot of EV sales volume into Q3. And then we've seen sales volumes drop quite sharply in Q4.
When you look at this space and you start thinking about the types of vehicles that are in demand, how much does where you're located play into that? We know there was a huge push into EVs. Just Ford has, pulled back on some of that just recently in the last 24 hours. Are there very different, trends in terms of what's in demand in New York City versus maybe rural Nebraska?
Yeah, there can be some, pocket trends. There's a higher rate of EV sales if you look at a market like, say, California. And then if you're looking at, say, the Dakotas, you might see more interest in, three-quarter pickup trucks on that side. So there can be some kind of regional trends in that. But generally, overall, we have some pretty consistent, smooth trends just in the U.S. overall for the new and used market.
Okay, now hybrid sales have been really interesting as we've seen these affordability concerns trickle into the market, but also hybrids are really resonating right now. Do you see this continuing into the new year, this momentum behind hybrids, as we did just recently actually get a development from Ford that they're somewhat straying away from that pure EV business more into the hybrid space?
Yeah, 2024 was a great year for hybrids. 2025 was even better, and I just see that trend continuing into 2026. Consumers really have kind of spoken. They are interested in more fuel-efficient vehicles. Those fuel-efficient vehicles are hybrids, though, so consumers are interested in them. And as we're going to start to see more automakers bring more hybrids to the marketplace, I really think that's where we're going to see a lot of future adoption. And then you're also seeing a lot of automakers also looking into the EREV space as well. I think kind of hybrids is where we're going to see the U.S. market kind of move over the next several years. But I would say Americans are starting to shake off our kind of gas guzzler reputation with the growth we've been seeing for hybrids.
Kevin, as we look ahead to next year, and I kind of look back as I do that, the last 5 or so years within anything to do with financing was shocked by rates and wild demand and supply swings due to the pandemic, due to some of the inflationary supply chain things that we saw after the fact. And then you mentioned tariffs as well, really changing some supply chains and pricing dynamics, or at least adding uncertainty to that. When we look ahead to 2026, rates have been relatively stable. Maybe the tariff situation isn't loved by the automakers, but maybe it's a little bit more understood and stable. Is 2026 tomorrow's headline today, more about a stable, understood market than any of the last 5?
So I would say general expectation is for a relatively flat new vehicle market in 2026 and a continued recovery. Used sales still haven't recovered from their kind of post-COVID environment, so still continued recovery in the used vehicle side of the market. New vehicle market a little flat with that uncertainty about vehicle pricing. But again, the total cost of ownership has gone up quite sharply. It's easy to look at the overall cost of vehicles and interest rates, but also keep in mind that auto insurance and just general parts and maintenance have also increased quite sharply over the past several years as well.
So are we seeing any degree of this deferral mindset? We talk about it so often with home buying, for example, where consumers are waiting for this more affordable housing market. Is the same being said about the auto space, where we're all just waiting for things to hopefully normalize, and perhaps we're waiting for a day that might never come?
So I think on the new side of the market, we are kind of in, I hate to say new normal, but I think we are in a relatively new normal with the new side of the market. The used market, I think, is still in that recovery mindset. Volumes still are not back to the levels we saw, say, in 2021 or in 2019. So still additional room for growth in that market and a potential additional upside with how high new vehicle prices have gone. I think there might be some additional room for additional growth in the used vehicle market over the next several years.
Where do you think, from a consumer standpoint, the kind of Tesla auto driving, that kind of stuff, the autonomous vehicle, the stuff that full self-driving, I think Tesla calls it, how much are those type of features, whether it's park assist, etc., that these different vehicles offer, how sought after is that from consumers right now, or do people just want something that gets them from point A to point B?
I think affordability is the number one feature people are looking for. The extra features are nice. Those tend to come at a pretty high premium. And so in the current market, I think if you can make a really nice new vehicle under $30,000, that would be a wild seller in this market. So those features are nice. I particularly like, anything that can help me have less kind of eyes on the road time on freeways or help with parking. They're all great features, but affordability is the number one feature that consumers are looking for.
Absolutely, and I feel like that could be said about so many different areas of the economy right now, but definitely being felt hugely in the auto space. So we so appreciate it, and really topical discussion is there's so much news right now, it feels like, in the auto space, as there usually is. But I appreciate it. Kevin Roberts, Director in Economic and Market Intelligence at Car Gurus. Now, coming up next, it's time to stick with our car theme. We're discussing Ford, which is seeing actually some modest improvement on the session here, as it did unveil this $19.5 billion hit from the biggest EV bust we've seen yet. So we'll discuss more what that means for the company going forward.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time to discuss under 30 today, and that is Ford, which is seeing some pretty substantial news as it is expected to take a $19 billion hit from a perhaps not EV buses, I think overstating it, but some reallocation with its EV funds. So joining us now is George Tillis, Senior Markets Correspondent for the network. And so George, this is a fascinating story to me. I will say that Alex, I know he's probably going to say this, but he's been very right for a very long time. So I'm really excited to hear your thoughts here on the story today.
Well, I think, first off, just address the price. I mean, they're taking essentially what they declare about a $19.5 billion impairment charge because they're essentially pivoting their EV strategy, effectively decommissioning or eliminating the F-150 Lightning. It was a higher price point product for Ford. It wasn't selling. The volume wasn't there. And they decided to basically scrap that project. They are also talking about at least this year saving about $1 billion or earning an additional $1 billion in EBITDA and improving their free cash flow position. So look at the price today, it's higher. This normally would be a bad sign for any company for that matter. And I think what's happening here with the price action in the stock, especially over the last year, about 36%.
480.
The automakers are higher.
Boom!
Rivian, we also talked about General Motors, I believe, as well. That they're focusing on core technologies, core products, expanding and using, I would call it the Toyota playbook, which is moving more aggressively towards, hybrids, the ICE, internal combustion engine vehicles, and of course electric hybrids. That's Toyota's recipe for success. And Ford looks to be moving in that direction with the anticipation of about 50% of their total consumer fleet now moving to hybrids by 2030 as declared by the company. The other thing I think is important here is that Wall Street seems to also appreciate that there's idle capacity now in some of their battery manufacturing plants that they could certainly utilize to produce technology components that they could actually sell into the data center markets as well. So again, that's a good strategy. Increasing the yield on existing capacity, repurposing it, if you will, and effectively again. When you consolidate operations and you capitulate and say, hey,
capitulate,
we're not going to throw any more money at, you do see some accretive potential in the stock price.
Capitulation.
George, clearly there's somebody different or some combination of different people that have the leadership of the boardroom.
There's a lot more room.
I don't know that this strategy will work. But trying to create a product because you want someone to like it isn't a good strategy. This is a company that's been around for 100+ years because they made things people wanted. And they got back to that here, going where the market is and using that market intelligence that I'm sure they spend billions of dollars on. But the part you said last, I think, is the most intriguing thing about this, which is they see opportunity in this power demand data center build out world that they can pounce on and take advantage while it's there. And to me, the decisiveness to pivot and the ingenuity to find that opportunity, again, I don't know if it's going to work, but I see why the market appreciates it.
Definitely, and that's why I brought up just to start. I mean, generally speaking, when you see an impairment charge like this, the stock would be down. So effectively, that's very meaningful. How the price action today is holding up and how institutions are not selling. I think again, making power generation equipment or distributed equipment for data centers, that's a pivot. Again, utilizing that idle capacity that may be there, repurposing it, that's a good strategy. And I think, at the end of the day, this is my view, I think of Ford, I think of, utilities and utility trucks. And essentially, maybe the EV truck space is more of a novelty space, not necessarily a utility space. And that might be why, effectively, the volume and prices were high, volume was low for their product. So they're just basically resetting themselves to their core business. And again, I think Wall Street is appreciating that, considering the price action. So, maybe the aspects of EV trucks are more novelty, Tesla, Rivian, for instance, and then going back to your core, but also, again, dealing with the MPG requirements across fleets by using hybrids, they can increase volume, increase production, lower cost of unit production, and that makes for better profits. Lastly, I'll just quickly say that next year, in 2026, they're expecting $1 billion less in sales than this year, but their profits next year are expected to increase by over 40% from $1.03 this year to $1.48. So lower revenue, higher earnings, gives you an idea that they're moving towards operating leverage, and that's what Wall Street likes.
Yeah, I think that's exactly why we haven't seen more of a, frankly, negative move today. I know I say that as we slip slightly negative, but I mean, hey, you see the $19 billion figure, I think that how we framed it is exactly what the street tends to care about. So we appreciate it. George tells us a great explanation of what the news story really today is facing forward. And that will do it for Alex and myself for Next Gen Investing. I will say, Alex, that we have seen a bit of an improvement throughout the last hour. So easing a bit off of these session lows, that'll do for us today. So watch this coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time
market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on ETF.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. And I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Good afternoon, everyone, and welcome to the Watch List. I'm Diane King Hall. Coming up on 2 p.m. Eastern here at the New York Stock Exchange. Let's start out with what's coming up on today's show. Just how reliable has the futures market been as it pertains to daily trading? We'll take a closer look. Also, with Technical Tuesdays, our very own Rachel Michelle joins us to explain the data she's uncovered. And our panel discussion will take a deep dive into those jobs numbers we got today. We got October, we got November. We are playing catch up on the economic data. All right, let's run now. Take a quick check on markets with just about 2 hours left in the trading day. We still got some pressure on the markets. You're looking at the S&P 500 off by 0.5%. In terms of the weakest sector, that's energy, followed by healthcare and real estate. But you've got broad-based weakness across sectors in the S&P 500, just about every sector in the red. NASDAQ 100 off by just shy of 0.1%. That's been fluctuating throughout today. We saw a little green on the board earlier in today's session, but we backpedaled some later this afternoon. The Dow right now lower by a little bit more than 0.5%, 0.6%. Russell 2000 also lower by 0.6%. Let's take a look at some of the other price action across asset classes. We've been closely watching the dollar. That's off below 98 against the basket of currencies. Bitcoin a little bit higher today, even amidst some risk off we're seeing, but again, nowhere near those highs that we saw earlier this year. Bitcoin better by more than 2% right now, approaching 88,000. Yield on the 10-year off by 2 basis points. Gold, a little bit higher. Gold has certainly seen a run rate, so we've seen some gains in gold, silver, gold right now better by more than 0.1% right now. Crude oil taking a step back today, off by nearly 2.5%. We've got some worries hitting oil markets, crude oil trading below $56 a barrel for West Texas Intermediate. For some of the biggest stories in the market, we want to welcome in Kevin Haynes, co-host of Fast Market. He's over there at the Seawell. I'm bookending the day with you, Kevin. So we started out this morning going through some of the economic data as it was coming in fast and furious. You've had some time to process some of the economic data. We talked earlier about jobs. Let's talk about the S&P Global Composite.
Not holding up well.
Released today as well. Give us some of your takeaways.
Get ready.
Composite flash, the composite dropped to a 6-month low of 53, down from 54.2 prior, Diane. Now, this is still above 50, so as these indexes go, this is still considered expansion, but it's the lowest number in 6 months. What drove it? Manufacturing fell to 51.8 from 52.2, with new orders shrinking for the first time in a year. Services PMI decreased to 52.9 from 54.1, also a 6-month low, showing modest new business inflows and sales growth. Inflation, firms reported sharp increases in input costs, highest in over 3 years, linked to tariffs. So there's a lot of issues. I think this is why, after navigating the non-farm payrolls and retail sales as relatively positive, this is why I think the market weakened slightly, Diane. I think this number was still in the expansionary area, but weaker than expected, Diane.
Okay, let's talk about weaker than expected as well as it relates to Pfizer. They've updated their 2026 guidance. It is not what the street wanted to see today. We've seen the stock get weaker throughout today's session. I mean, Pfizer just really can't catch a break this year. We're going
No, they
back
can't.
2 years. The COVID days aren't working anymore. The demand's not there. They haven't figured out something with regard to the weight loss drug. What's your take here?
Exactly right, and they mentioned exactly what you just said. The stock dropped today, forecasting weaker 2026 profits and revenues due to declining COVID product sales, patent expirations, and ongoing R&D costs, though they did say they are aiming for post-2029 growth with new drugs. 2029, Diane. So the company also announced new non-exclusive deals with Adaptive Biotechnologies, maintained its dividend, and saw positive early trial news for a cancer drug.
SPX is out of support.
Pronounce it. But the weak outlook, COVID sales, strategic shift.
Got this quad, even probably the 5th time. 1, 2, 3, 4, 5.
Buddy from Fast Market, close to Fast Market, over there at the SIBO. Now let's widen out, get a bigger picture take with Henry Schwartz, Vice President, Derivatives and Market Intelligence. We're sticking with the CBOE. So Henry, thank you so much for joining us today. So one of the things you're paying attention to is the record volumes that we've seen in options activity. You're expecting this year will be another record year for options volume. I'm curious to know, what are the trends that you have noticed?
Retail traders.
Sure, so it's really a continuation of what we've seen for the last 5 years. So this will be the 6th straight record year. We're averaging over 61 million contracts a day. Before COVID, it was about 19 million. So, and Kevin was standing in front of the SPX pit on the CBOE floor in Chicago. That's one of the biggest drivers, and in the SPX, it's the zero DTE trading technique, basically. Customers using these options on the very last day that they have to trade, and doing a lot of kind of rules-based systematic trading.
Oh, really?
Just using them for the fact that, if you want a tactical hedge, if you want to cover yourself for maybe a bounce this afternoon, a very short-dated option is incredibly capital efficient, right? Basically, the leverage that is inherent in an option in its last few hours is enormous. So we're actually seeing about 2 million contracts a day in the zero-day DTE SPX. It's about 62% of the entire product. So, and then the other big themes that really have been running for several years and are not slowing down are retail engagement, particularly in the single stock activity. So, I just refreshed data yesterday. We just recently launched this Mag 10 index option, which is the Mag 7 plus 3 additional stocks, Broadcom, Palantir, and AMD. Sorry, I have written on a board in my office. And those 10 stocks are responsible for a third of the single stock listed option volume, which really is coming from
right?
the retail segment. So it's really the themes this year are more of everything.
MAGS.
More single stock option trading, particularly retail in that segment, and ETF option volume is also on fire. Each segment is up about 20% this year.
Henry, let me ask you this. Let's go back to zero DTE. Why are so many traders gravitating to that? Because that is inherently very risky, and I've seen stories of people blowing up their accounts doing that, or operating in that space. Why are so many traders gravitating towards that?
Well, it's really interesting, right? The zero DTE strategy, which is simply using an option on its final day of trading, became possible 5 days a week starting in 2022. That's when we listed FTX zero DTE, or daily options, but basically about 80% of the activity actually happens on that final day. And you are correct. Options can be dangerous. I think of it like a chainsaw in terms of like a power tool. You got to know what you're doing. However, what we actually see when we look at the activity in FTX is that the majority of the trades are limited risk. Okay, meaning people are either buying options. Okay, when you buy an option, the maximum you can possibly lose is the amount of premium you pay. So if you buy an FTX option for $4 because you'd like to position for some sort of a scenario or a move, your maximum loss is that $4. There is also a kind of a consistent flow of options.
$400, buddy.
But it's a form of capped risk vertical spread. So people that have traded options, technically, if you are short a naked option, your risk can be infinite, right?
Oh,
because you are on the hook for a move beyond basically the premium you collected. But when you use a vertical spread, you basically sell one option, but you use a further out of the money option to cap that risk. And in index options in particular, it's very simple, right? At the end of the day, when these options expire, they expire into the cash number, and you're just cashed out. So there's no uncertainty. When you try to do that type of trading in ETF options, it can get a little dicey after hours, or if the ETF finishes right at the strike. So we see about 80% of the activity in the zero DTE is capped risk. So and it makes sense. I mean, FTX is almost a $6,500 index. So it's a large dollar notional, and the amount of margin that a customer has to have to trade an uncovered option is a couple $100,000 just on one contract. So we do not see, we're not hearing kind of horror stories about people getting hurt. What we're actually seeing is communities of traders that apply a strategy, and it's very repetitive. In some cases, people are actually trading these things 10, 15 times a day. So every 10, 15 minutes, they're basically adjusting a trade or putting on a new trade. And the technology that's out there now to do back testing.
You got a problem with that?
Basically engineer these trades makes it kind of easier than it ever has been, and that's why the short dated trading and zero DTE in particular has been kind of the biggest growth story that I've seen in 30 years in the business.
Okay, that leads me to, for 2026, are you expecting that same kind of activity, or what's your overall outlook into 2026 for options activity? Expecting another record year?
Yep.
Yeah, I don't see any slowdown. I mean, the single stock option space, which again is primarily driven by retail, it is influenced by kind of how the market's performing, right? So this year, market's having a great year. We're 15% in the S&P, or up even more than that in the NASDAQ index. Russell's up. It's basically been a great year for equity investors. That's been really, really helpful for the option volume because retail customers, there's a wealth effect. They feel like they have money to use to trade and put on their views. But there's also kind of some structural changes. The fact that customers have become very used to using options in conjunction with underlying holdings, so maybe they're overwriting to add a little bit of income to some stocks.
NVIDIA.
That they've been holding for years, and they've become proficient at knowing how to put on the trades and how to manage the trades and how to kind of anticipate what they're going to do if the stock goes up or if the stock goes sideways. That kind of approach to trading, helped by the technology that brokerage firms like Schwab is rolling out, making activity easier than ever. There's kind of I don't actually see anything that's working against continued growth in volume. So I'm pretty comfortable we will continue to see. I don't know if we'll see another year up 20% year over year, because this has been really a blowout. But we see new products getting rolled out. We see new use cases. There's just so much going on in kind of it's not just the derivatives and the options business, right? It's basically becoming more of a field of risk transfer and risk adjustment. So people are using different kinds of products, different strategies, and they're just continually coming back and having a good experience doing it.
That's right.
All right, thank you, Henry. I appreciate that. That's Henry Schwartz, Vice President of Derivative Market Intelligence.
SPX.
Cboe Global Markets. Have a great rest of your day. Coming up, we've got Options Corner. Tom White joins us to highlight unusual options activity from the day and how investors are looking to trade on recent news. You just heard about Broadcom, Pfizer, and Strategy. We'll be right back.
Yeah, not looking too good for you, Broadcom. 67.80s. Drama. Do.
Experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to the watch list. Time now for Options Corner, where we analyze unusual options trades seen throughout the day. For that, let's welcome in my teammate from Fast Market. You've got Tom White joining us with a look across three key names. So Broadcom, a little bit higher today. It has pulled back more than 15% from its all-time high. You found a neutral to bullish trade. Tell us about this.
Yeah, it's the steepest slide, three-day slide in Broadcom that we've seen. It's trying to right the ship here today, relatively flat, that we've seen since 2020. as far as the pullback. And this comes post-earnings too, Diane, where they saw 28% revenue growth led by growth in AI, the AI segment of their business by 74%. CEO Haktan pretty hyped up about it. He still says that their XPUs, that are those specialty chip designs that they make for some of the large language models, some of the hyperscalers, continue to grow exponentially, but he doesn't believe it's going to dig into much of the GPU market. Now, they did raise guidance moving forward, and also as they continue to see AI accelerating at this point. Stock's done pretty well this year, it's up nearly 50%, but as you mentioned, it's pulled back nearly 18% from those all-time highs that we saw earlier this month on the pullback. It had a bunch of price target rating changes on this post-earnings. One that stuck out to me was Truist. Even after the slide post-earnings, they raised their price target to 500 from 365. And they said margin drag was maybe the reason it pulled back. But remember, going into this earnings report that they had last week, the bar was really high on this one, and it just hit recent all-time highs, so maybe some profit taking in there too. But we did see some neutral to bullish activity in here, and this was out in the December 19th monthly options that expired in just 3 days. So this might be a trader just drawing the line in the sand that, hey, the stock's done going down it's starting to consolidate today. So it's done going down, and if it does continue to go down, they're willing to buy it. So trader came in and sold 4,000 of the December 19th monthly options. The 340 strike puts collected a credit of about $4 on average for these puts. So that takes the break even for this trader when they start to lose money down at 336 over the next 3 days. It's only about 1.5% below the current share price. So selling a cash secured put, taking that neutral to bullish stance where, hey, if the stock doesn't go down anymore, remains above 340, they just get to keep that credit that they collected on the 4,000 they sold. Or if it falls, they're willing to buy the shares at $366.
Let's talk about over in the healthcare space, Pfizer, that one moving lower today. No surprise after that guidance that it issued. The street doesn't like it. It just hasn't been able to find a solution in terms of its pipeline. What type of trade stood out for you?
Well, yeah, this is one of those things where they came out with a mid-quarter update, and initially the stock popped on it. The stock was positive, but now pulling back about 5%. And when you say things like, hey, we're going to on track to deliver majority of our $7.2 billion in cost savings that they've kind of anticipated by 2026, adjusted EPS for fiscal year 26, they lowered from $2.80 to $3. Consensus is about $3.06 on that, so they came in a little bit lighter than that was anticipated. But full fiscal year revenue is supposed to basically come in line. So it didn't seem like there was a lot of bad things in here, but market's kind of hitting the stock here a little bit. Pfizer said they plan to begin 15 studies in obesity next year. Remember, they already tried this once. It failed. And then they're not as dependent on COVID anymore, but they see declining COVID trends continuing into next year. So it was a mixed bag on this mid-quarter update, but hey, investors still hitting the stock here. And we did see some bearish activity in here. This was out in the February monthly cycle. So 66 days to expiration. Trader bought over 30,000 of the 24 strike puts in February. Paid an average debit of only 45 cents. There's not a lot of extrinsic option premium in these out-of-the-money puts. So the break-even where this trader starts to profit is below 23.55 over the next 2 months. That's about 6% below the current share price in Pfizer, with put volume about 7 times normal daily average volume. So this trader thinks that the sell-off that we're seeing today is not done over the next couple weeks, a couple months.
Okay. All right, let's talk about a move that you found, a bullish trade that you found in strategy, or it's formerly known as MicroStrategy. It is moving higher today. Tell us about the trade that you found.
Yeah, it's moving higher on the back of maybe Bitcoin up today, but still down about 44% this year, off 70% from those all-time highs that we saw in November of last year. Remember, this stock was $543 at that point, so you see the decline here. The divergence between Bitcoin, which they buy a lot of. They just a week ago they bought another $1 billion worth. Second week in a row that they bought another $1 billion worth. The divergence between Bitcoin and MicroStrategy, the stock has been at the widest level that we've seen in years. So that's a concern I think, for investors. And despite the buying, Strategy's Bitcoin yield, a core metric tracking Bitcoin per share of MicroStrategy, has turned negative for the first time in years, according to a report. And that's because they diverted about $1.44 billion into a U.S. dollar cash reserve instead of deploying the capital into more Bitcoin. So that those days of using Strategy as a proxy for buying Bitcoin going away quickly here. But we did see some bullish activity, probably on the back that, hey, maybe we're going to get a rally in Bitcoin that'll help Strategy. This was on the December 26th weekly options that expired in just 10 days. Trader bought 10,000 of the 175 strike calls, paid an average debit of about $4.75. So the break even up at $179.75 over the next week and a half. That's about 9% above the current share price. So you're going to need some more gains in Bitcoin to get Strategy above that break even. But this trader's bullish over the next week and a half going into Christmas.
Yeah, Bitcoin higher right now by more than 1.5%, but nowhere near those big moves that one would need to see, especially if you're bullish on this, and to reach the targets that the most bullish people saw for this year. You remember, Tom, I know you haven't forgotten those like 200,000 or 150,000 targets. We're nowhere near that right now. All right, Tom, thank you so much for bringing the latest trades that you found there on Pfizer, Broadcom, and Strategy. Coming up next, we'll check on the reliability of futures, or maybe unreliability, and how it impacts the market daily. That's next on the watch list.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on the Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Watch Us, Dining Online from the floor of the New York Stock Exchange. Let's take a look at a couple of movers in the market right now. Shares of Southwest Airlines still taking flights today. They hit a 3-year high after an upgrade at Barclays. The analyst says the company's new commercial strategy, including bag fees and assigned seating, will drive material improvement in revenue in 2026. Stock is now higher for the 11th session in a row. It's been an outperformer compared to the S&P 500 year to date. Halliburton is moving lower today along with other energy names as crude oil prices continue to slide. That's because of supply concerns tied to peace talks between Russia and Ukraine. And Halliburton shares are flat this year, but up more than 45% from April lows. We want to welcome our next guest, Tim Quast, founder and CEO of Market Structure Edge. to talk about futures as a predictor, as a roadmap first off. So futures used to be a roadmap, right? You look at futures at the start of the day, they'd be higher, you could say, oh, maybe, this is how things will work today. Earlier they were higher, but that's not what's happened today. Why do you see futures, or how do you see them as a signal for how the trading day will unfold? Is it still reliable?
Well, Diane, it's nice to see you again. Happy holidays, Merry Christmas. Futures are no crystal ball. I came up with that all by myself. And you know what the data show. I mean, if we do a statistical analysis, they're still, surprisingly to me, because I see the disconnect all the time, say 2/3 of the time will give you a general indication of the direction. But you're right, look at today. I was writing the Market Structure Edge daily note this morning early. By the way, you can get those for free just at marketstructureedge.com. And I watched the futures go from positive to negative to positive to negative. And you think, well, what good is that? Well, traders, number one, it's not very good. And if it's a signal only half the time, it's no better than a coin flip. The cause, Diane, is a market that is an autonomous system. The market doesn't work the way most of us think it does. We spend most of our time talking about fundamentals, business fundamentals, and why is a stock valued this way or that, technical signals, and yet the market is very mathematical, and it's global, and it's automated, and it trades all the time. And so much of the prices today, you can see this by, if you go look at the 13F filings that public companies have to make 45 days after the end of the quarter. It's a 1975 standard, by the way. But you can go look at the top holders of U.S. stocks, and you'll find that 3 of them are Susquehanna, Citadel, and Jane Street. And they're part of the reason, I'm not picking on them, but it's part of the reason why futures have become unreliable. They have investment horizons of, I'll call it 400 milliseconds, about the blink of an eye. Yet they, at any given time, own $2 trillion of notional value in derivatives. Futures are derivative contracts, right? So, when those things read right, that's wrong. Yeah.
Can I jump in? I just want to jump in for a second because you pointed out those names. I know you said that you're not picking on them, but does that mean that market plumbing doesn't matter anymore?
Boom!
Well, the plumbing does, but the plumbing isn't maybe what we think it is. Here in the U.S., the plumbing is Regulation National Market System.
The plumbing.
And its principal requirement that every trader and investor should know
Oh man, to the 200.
Have to trade between the best bid to buy and offer to sell, which can never be the same. If they were the same, that's a locked market. The bid can't be higher than the offer. That's a cross market. And so, yes, Citadel, Jane Street, and Susquehanna make billions of dollars setting the bid and the offer by buying from a seller and selling to a buyer and taking 1/10 of a penny from each share. And that investment horizon is so massive that it causes futures contracts to lose their reliability. Whatever the investment horizon is that is pursuing whatever the investment vehicle is, will affect its value. And if that investment horizon is a blink of an eye, futures become unreliable. So you can't count on them.
So Tim, one of the things we talked about earlier in our show was there's a lot more options activity now, right? And retail investors, they've started a trend of a lot more retail investors being involved in that during the pandemic, and it's at record levels this year, and so that's expected to continue. If retail investors listening to this right now, which there are some, they may feel like, why bother when you talk about these big names? What's changed in the way money moves through markets, and why should the retail investor, I guess, bother? Because they may say, well, forget it, I'm just going to throw in the towel now.
Well, you got to know how the market works. I will always say to investors, the number one principle is to understand how the market works. Number two is to understand what the money is doing. If we don't understand both of those things, we'll have a hard time succeeding. So how do you make it work in this kind of environment? The number one rule in answering that question is don't trade price. Trade demand and supply imbalances. We can never outcompete Citadel. They have vastly superior data and systems. And so change your time horizon. They set prices, and the prices are capricious because their investment horizons are very short. It's why technical signals are difficult. They don't work very well. And it's because of the very short investment horizons behind them. So lengthen your investment horizon from seconds to days and trade demand-supply imbalances that are not of a consequence to a firm like Citadel that wants to capture a brief spread between an ETF and the underlying basket of stocks. That's the best thing you can do. And also beware of weeks like this one. You know, options expire this week. Your previous guest was talking about one trade where it's tied to the December 19 expiration date. Well, it's not just December 19. On the 18th, our expirations tied to index options. Wednesday, tomorrow, is VIX expirations. Next Monday, new options trade. That whole period is fraught. And in the middle of that are the last quarterly S&P and other index rebalances. So in the middle of that, you have a very difficult time getting a good, predictable trade, and beware of that. You could just avoid it. If you're risk averse, avoid monthly options expirations because they're 20% of market cap. And one small change can affect direction.
So Tim, I want to get your take from, I guess, what you would see turning the page from 2025 to 2026. So not completely crystal ball, but a little borrowing a little bit from Ms. Cleo. So what would you say is the thing that should be in the toolbox from 2025 or that you see carrying forward into 2026?
Well, I always say trade demand, supply, and volatility. These are the ways that you make money. You have demand, supply, divergence, and that's what causes prices to rise. You know, if demand falls and supply rises, prices decline. When demand rises and supply falls, prices have a tendency to rise. That's very important. Volatility helps us produce returns. So you should know how volatile anything that you invest in is. How volatile is the S&P 500? Well, the average component of the S&P 500 moves 2.5% daily from highest to lowest price. That's why Citadel makes so much money. SPY, which is supposed to track the underlying basket of currently 504 stocks, moves 1%. Well, if there's that tremendous gap between the basket and the instrument that's supposed to track it, you're going to make money on that. So those are things you have to keep in mind. Volatility at month end is a key lesson. It has become very large because of month end index options expirations, and be very careful at that transition, investors, say from July 31 to August 1st. That was difficult. That can happen again, and beware of that in 2026.
Okay, thank you, Tim. By the way, I love your tree. That's Tim Quast, founder and CEO of Market Structure Edge. Thank you so much for joining us, Tim. So ahead, it is Technical Tuesday. Richard Michelle joins us as we look at the charts for the S&P 500 and a couple other names on our list, including Pan American Silver. Watch this. We'll be right back.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on XXM_Violet and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the Washington Banking Hall. It is Technical Tuesday, so for a look at the charts, we want to welcome in Rachel Deschelle, Senior Manager of Trading Services, Charles Schwab. Rachel, I usually talk to you in the morning. I get to talk to you in the afternoon today. Let's talk about the S&P 500. It's a little weaker today. What levels and trends are you watching?
Yeah, great to join you in the afternoon as well, Diane. So really the S&P 500 has really been trading in the sideways range for the last 13 trading sessions or so. It's had a little bit of breakdown today from that horizontal movement over the past few sessions, but this is following last week where the S&P 500 nearly reached those all-time highs and really came within a quarter of a percentage point away. So I don't think it's real surprising that we're seeing a little bit of a pullback after nearly a 6% move to the upside from that 65.50 support. Now, I'd also kind of like to discuss seasonality as well, because while it's not a strategy or necessarily a guideline, it's definitely something that investors tend to pay attention to. And honestly, this time of the year until Christmas, on average, we do see a little bit of a pullback before that possible Santa Claus rally afterwards, seasonally speaking. But in the short term, we are finding support at this 50-day moving average where bulls may step in and buy the seasonal weakness around this level, right around 67.60 or so. And if we see a break here in the coming days, or even today possibly, we may see a continued move to the 100-day moving average around 66.30, which is really not shown here in this chart, but it's a little bit lower, less than a 2% move away. But I will say we can't talk overall market trends without looking below the surface. So that advanced decline line below on that chart really showing that cumulative difference between advancing and declining stocks on the NYSE. It's coming off of record highs in the indicator, showing that breadth still remains strong. So if we can get past this seasonal weakness here, the trend in breadth setup could give traders more of a reason that the bulls still remain in control.
Okay, speaking of the bulls being in control, the next chart you brought is Chimera Therapeutics. This biotech has seen its share price more than double since the start of this year. What are you paying attention to here?
Yeah, it's definitely been a wild ride for this one, Diane. So, I'll just kind of start by saying this is a healthcare stock in the biotechnology industry, which as a whole, it's more of a risky industry because of the high failure rates of drug trials, the massive capital needs of these companies, dependence on unpredictable regulatory approvals. So when the biotech sector is trending up, it's been more of a risk on an indicator for the overall market. So with that being said, KYMR has had that phenomenal run this year. From the early lows to highs, it's gained nearly 430%, far outpacing its peers. And with each of those new highs that are made, we see momentum really confirming reaching those overbought levels. And really since September, momentum has remained in a bullish regime above 50. So I think that's notable as well. And even with this push to those all-time highs at 103, we saw RSI reaching some of the highest levels, close to 87. So as far as the trend and the setup here, we really saw that massive gap from December 8th that will act as an entire zone of near-term support. But really that move paired with this minor consolidation the last few days is really forming a possible bull flag continuation pattern. So that possible flagpole really measures up to $36. So if we do see this pattern set up complete and break to the upside, measured targets could give this stock quite a ways to run.
You got RBC Capital raising its price target on Chimera. They're raising it to 103. So you see the re-rating that's happening with sell-side analysts. Let's talk about the last chart that you brought us, you got Pan American Silver on your radar. I wonder if this has to do with obviously the price action that we've seen in silver. We've seen some momentum in the metals. Silver hitting a record. Pan American also more than doubled since the start of the year. What are you noticing in this chart?
You're exactly right on. You hit the head on the nail there, Diane. So the reason why I'm paying attention to this stock is because honestly, it's really hard to pay attention to, or I guess hard to not pay attention to silver miner stocks when silver has been on such an explosive run this year. And so this has been one I've been watching for a while here. So just to kind of put it into perspective, like you were saying, from really lows to highs, it's gained over 160%, and momentum has really followed that trend with the RSI reaching those overbought levels multiple times. The last time it reached those levels back in September to October, we did see that bearish divergence lead to a little bit of a pullback here, but this most recent thrust above 70 on the RSI is really confirmatory with the trend, which is what a lot of bullish traders would like to see, is that momentum confirming the trend. But as far as the trend here, most recently price formed a bullish continuation flag pattern, has really been trending higher along with that measured move towards 56. That may be a profit-taking area level for Pan American Silver, but something else notable here, I will say, is if we take that anchored VWAP there in purple and anchor it to those recent swing lows of that flag consolidation, we can see right now price is really hovering right over that level around 48.60 as that near-term support, where we may see some buyers even step in continually at this level of support. So the trend is your friend, and we're really not seeing signals of it bending here soon, Diane.
Rich, I want to circle back to your S&P 500 patterns that you're paying attention to. You mentioned seasonality. I know that's not so much a part of the chart, but I feel like I cut you off. There was a thought I feel like you had that you wanted to finish with. Can we circle back to that?
Yeah, so with the S&P 500, I think the most important thing here is trend and overall breadth, because with the S&P 500, we do have that's kind of at the index level. We're just seeing that on the surface, but with breadth, we're kind of taking that look under the surface, and while it may show as a kind of weak bit that we're seeing here, where we didn't reach those all-time highs, we didn't make a new high in the index yet on a open high low close basis, we did make a new all-time high in the S&P 500 on a closing basis. Which a lot of traders would say that the close is most important, and that was at the same time that the advanced decline line also reached those record levels here. So on the surface and under the surface, I think it still remains strong.
Okay, great stuff. Thank you, Rachel. That's Rachel Deschelle, Senior Manager of Trading Services, Charles Schwab. Appreciate that deep dive here for Technical Tuesday. So ahead, we'll bring our panel to dive into the latest jobs data. We got November, we got October, both released today. Stay with us here on the watch list.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends. So Magic Duty. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Hey, investors, you know the market moves. And Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, You can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Barnes, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Welcome back to the watch. Let's dive into a closer look at the labor market. We found out today the U.S. economy added 64,000 jobs in November. Unemployment ticked up to 4.6%. We also got October numbers showing there was some weakness. For more insight, we want to bring in our panel. Joining us now, Amy Glazer, Senior Vice President of the Debt, and Mark Bittner, Chief Economist of Piedmont Crescent Capital. Thank you both so much for joining us. Mark, I have your notes in front of me, as do with yours, Amy. But let's dive into your takeaways on payrolls, right? We got both November and October in the same day. November was stronger than expected, but October there was major weakness. Mark, what's your take?
Well, the weakness was where we thought it would be. Just we didn't know exactly how the government numbers would show up, and we're still probably only got a partial read on the DOGE-related layoffs and federal payrolls. I think estimates really have it at around 600,000, so we have about 270,000 that have shown up to date, and we had a bunch of them show up in October. We knew it would. In terms of private sector payrolls, we still eked out a slightly better than expected gain. The pace of private sector job growth has slowed to about 40,000 a month, and it seems that it's perked back up to somewhere around 60 to 70,000 jobs a month.
Amy, what's your take on this when you think about all of this? Are you worried at all about the job market?
In fact, we're seeing this cooling as we've all anticipated and seen over the last several months, but it's certainly not frozen. We have a bit of a supply and demand issue going on right now. There's still open jobs, there's availability, employers are still hiring. The question is, do the candidates match the skill set, do they have the appetite, potentially to go in office to take more traditional hours? So I see this more of a supply and demand issue right now, and let's be clear, cooling doesn't mean crisis.
Okay, cooling doesn't mean crisis. When you think about the concentration of where the job gains were, you saw growth in healthcare, no surprise there, some growth in social assistance. Mark, what's your thought on that? Does that worry you at all where the jobs are?
It worries me a little bit, and this is the type of hiring that takes place late in the cycle. Healthcare and social services are almost always looking for workers. There are two industries that were hit the hardest during the pandemic. That's where hiring fell the most. We're seeing a rebound in social services. Some of that is tied to nursing homes, which really devastated by the pandemic. So the fact that hiring is strong there and it's not so strong everywhere else, that does give me some concern. The breadth of job growth has been narrowing all year. What gives me a little more comfort is that the more leading indicators out there suggest that hiring is beginning to come back a little bit. So I think that the November numbers are also tainted a little bit by holiday shopping season distortions. I think that's one of the reasons that we saw that employment in transportation and warehousing was down so much. Couriers are not hired as much on a seasonal basis as they typically were, as they were in the past, since we didn't get a seasonally adjusted job loss. We also saw less hiring in retailing. So I think that sets us up for a little bit better number in the next couple of months.
Amy, speaking of seasonal hiring, you all have unique insight into hiring trends and needs. What does the holiday season look like from your point of view?
Was still strong. We are seeing where employers are really taking advantage of productivity and have this notion of just-in-time staffing. So although we may see the number of employees taking seasonal jobs on, the average hours worked appear to be a little bit less from the ground. But seasonal hiring still as strong as it is every year. We anticipate an ongoing surge going into January with returns and customer service roles as well.
Mark, I want to go back to the point you made about some leading indicators that you notice about hiring picking up. So are you saying that we may be moving out of a low hiring, low firing kind of environment?
I wouldn't go that far. I think we may see a little bit more hiring, but I still think it's going to be lower than what we've seen earlier in the business cycle. And I put it more that we're taking a few steps back from the edge. And Chairman Powell stated that he believed that the employment numbers, as they are currently reported, are probably over-reported by about 60,000 jobs a month. That puts job growth since April, when the Liberation Day tariffs were announced, at either zero or slightly negative. And I think we'll see it improve off of those extremely low levels. But we're not looking for a whole lot of strength in job growth. There is something to the AI story. If you go back, and I put this in the note, if you go back to when ChatGPT was released in November of 22, you see a pronounced slowing in job growth in the tech sector. Now, we saw that the tech sector was hoarding workers during the pandemic and the immediate aftermath. If you go back to the pre-existing trend, it's hard to say whether AI is eliminating jobs or whether we're just getting back to trend. But the anecdotal evidence, which you hear from a lot of young people, is that it's awfully hard to get a job. You look at the unemployment rate, and most of the increase in the unemployment rate that we've seen this year has come from workers aged 16 to 24. The unemployment rate for workers over the age of 25 has risen very little. It's up 0.2 percentage points year.
Okay, I'm so glad you brought that up because that was kind of the next line of thinking I had about the impact of AI. Amy, from your vantage point, what are you seeing with regard to that impact of the job market and, kind of the needs that or skills workers need to have?
So it's really interesting. We're seeing a workforce report we just put out that last year this time, most employees were seeing about an hour gain per week in productivity due to AI. This year it's jumped to 2 hours. However, employers aren't seeing the productivity as a result of it. So employers need to continue to not only upskill and reskill their team members to use AI, but what to do with that free time, whether it be to work on creative projects or strategies, so they get the full ROI of embracing AI within their organizations.
Okay, all right. We'll leave it there for today. Thank you both so much for your perspective on the jobs data that we're playing catch up on. We finally got both October and November in the same day. We're finally catching up. We'll get December on time next month. Thanks to Amy Glazer, Senior Vice President of DECO.
$12? Are you kidding me?
The market initially had moved higher on that jobs number. It's taken the day lower, though. Throughout the day, as investors process it, we're watching weakness in the S&P 500, in the Dow, in the NASDAQ, off the back of those latest jobs numbers. October was weak, November stronger, but they focus on weakness. That's going to do it for us on the watch list. I'm Diane King Hall, filling in for Nicole Petrolides. Download the free Schwab Network app. It's in the App Store. And tune in 24/7 on SchwabNetwork.com. Thank you so much for watching. You've got Market on Close with Sam Bottas and Marley Caden up next.
We have 4 minutes to power hour. We're on market close.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee.
See how pretty that flag is?
Worldwide. No overdraft fees, and enhanced security features to keep your money safe.
Beauty!
Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Oh, yeah?
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing of houses, opening up our business, having children, they've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Well, we stay bullish, we hold here. If we don't, we dip. Simple as that.
Hey, Bob. Hey, Andrew. Last year, my dad had a
What's the deal with all these commercials?
To see this person that I've always seen as a force in our family be vulnerable.
Wait, that is stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I programmed that 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Boom. What'd I say? What did I say? Said now or never. Boom.
Good afternoon. It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Hayden, coming to you live from our Chicago headquarters.
And I'm Sam Barnes, coming to you live from the floor of the New York Stock Exchange.
Marley, you're hot.
What is coming up on today's show? We'll look at the trends in online retailers as the holiday shopping season rolls on and how cost considerations are dominating consumer decision-making. Later in the show, we'll get some stock picks you should have on your radar for 2026. And in Options Corner, we'll check in on Tesla after another bullish analyst note, this time from Mizuho. Marley, take us through what you're watching for today.
Pardon the pun, Sam, but Southwest stock taking off to heights we haven't seen in 3.5 years after getting our plays. The firm says that the airline's new commercial strategy, which includes charging for bags and increased leg room and assigned seating, will be a positive revenue driver for the company.
And sleep with a stewardess.
Coming up. Ford also announcing it's taking a nearly $20 billion hit as the car maker shifts its focus away from electric vehicles. The company announced it will also be launching a new high-growth battery energy storage business. And Pfizer shares some of the worst performers on the S&P today, falling after issuing disappointing 2026 guidance. Their EPS forecast range coming in below expectations, while revenue would mark little change from 2025. We'll take you through the numbers shortly, but before we do that, let's take a look at how the markets are as we head into the end of the trading day. We did see the NASDAQ turn around, though we've added some green to the board. The S&P, though, is still trading down about 1/3% right now, 67.92.
Not drinking.
On the NASDAQ, like I said, a little bit higher, not even 1/10%, but we'll take the green, 25,082. On the Dow, we are trading 7/10 lower, 48,079. And the Russell 2000 is trading at 25.15. Ignore that 30%. That's a mistake there. The U.S. dollar is down 2/10, 97.78. Gold trading higher, though, 43.42.30. For crude oil, we're dipping to the lowest levels we've seen in more
We're
than
definitely
4
at
years.
resistance.
2.7% right now, 55.28 a barrel. And Bitcoin trying to stage a recovery here, but still below that 90,000 threshold, up 2% at 87,760 right now. I do want to check back in with Sam, though, and see what stories caught her eye on the floor of the NYSE today. Sam?
Well, Molly, we've got that Friday feeling. The only problem is it's Tuesday. But after weeks of delay, we finally got the October and November payrolls reports, which were a mixed bag. November payrolls were rising 64,000 in November. That was more than expected, but it had a decline of 105,000 in
Not quite.
October, in part because of a big contraction in government payrolls impacted by DOGE, marking 3 months of negative jobs growth. The unemployment rate also ticking up to 4.6%, which was the highest level since September 2021. October retail sales, meantime, also came in
Next.
8 of the 13 categories were up, but autos were a drag, in part because of the expiration of the EV tax breaks. So once again, that was another mixed report there. We also got business inventories, which came in slightly higher than expected, which could be pointing to some softening. Reaction. Stock futures had initially picked up, but then came off.
They're doing a big yawn. Met a new high. Uh-oh. Apple.
Economists have been pointing out that the delayed data would be useful to justify what the Fed has done.
They told you to stay away from them.
But there is still some confusion around just exactly what to take away from these prints. Some are worried about the weakness in the economy. Some say the government shutdown has made things a bit messy, and we should perhaps wait to see how things play out.
Made everything messy.
We are risk off in the markets today, so maybe the markets are focused on the weaker parts of those prints. But for now, I'll send things back over to Marley, who's with Jenny Horn in Chicago with some of today's top news.
SPX new high.
Jenny Horn joining us today, co-host of Next Gen Investing, to break down some of the top stories that we're looking at today. I'll spare us any more airline puns today, Jenny, but Southwest having a really strong performance today following a note from Barclays.
Yeah, and this note really highlighting a lot of the unrealized revenue that they think that they could capture here from, of course, the fact that they're now going to have a more traditional airline structure. And so, I mean, hugely optimistic, especially when you look at Southwest's performance this year. And I think that we often forget that it was not the leading AI trade of last year, but actually United Airlines was one of our best performers last year, and now has not seen the same favorability as you're seeing more and more encouragement from Southwest. And frankly, this Barclays notes highlights a lot of the bullish enthusiasm we have seen. So Apple now 11 straight days, which is its longest winning streak on record. We did see today pacing for its highest close since June of 2022, and it's also its largest percentage increase since just earlier this month. But again, up 23.4% over just the last, 11 sessions or so. Barclays, though, raising its price target to $56 a share, raising its rating to overweight, and this
Ain't that pretty?
have an average rating of, I'd say,
Phone wedge. And I thought this was a bear flag. Then it broke out, then it came back double bottom. Higher low.
On average, just solely based on luggage charges.
Boom.
Airlines brings in roughly $1
To
billion.
triple top.
And obviously, different business models. This will happen right away for Southwest, but it is unrealized revenue. But as we were discussing earlier, I mean, does this also then challenge some of that loyalty base? I mean, I always joke that, how do you know someone uses American Express? They tell you. How do you know someone is a Southwest loyalist? They will tell you because they are a very vocal, loyal consumer. And so you wonder if that remains challenged. But
That could be a problem.
From a company standpoint, they've done a really good job framing this narrative in a way where they make it seem like they've updated their loyalty program, that their credit cards now have additional perks. So they're trying to gain that loyalty in a different way, but we'll have to see what this actually looks like with a very different type of Southwest, frankly.
Yeah, we'll have to see if those drink tickets and the free cookie tickets are going to be enough to get people to pay for those bags. It'll be interesting to find out, but Barclays feels bullish about it. Let's talk about Roku, also a bullish note on Roku, a rare double upgrade.
Yeah, so Roku today, I mean, another day, it's up 45% this year. So, I mean, in the broader media landscape, Roku has been doing so so well given the, again, consolidation we've seen. We've seen a lot of, obviously merger news, but it seems like this analyst is at least still seeing that overall favorability for a name that, again, operates in a relatively challenging space. And specifically, Morgan Stanley calling out the U.S. advertising market, as they said that that's expected to have now a strong year in 2026, supported by various events like the Olympics, FIFA World Cup, as well as just various political advertising. So they actually are raising just their overall U.S. advertising growth outlook for the coming year by more than 10%, up more than 150 basis points from their prior guidance, noting that core ad growth has continued to outpace overall economic growth and that the digital transformation and new spending categories are expected to support the trend. So Roku specifically called out in this note as its price was raised to $135 from $85 a share. They now expect their platform revenue to grow by roughly 19% in 2026 compared to their previous outlook, which was around 15%. So they were not the only name called out. They did also mention Outfront Media as well as Omnicom Group, but also with very specific sort of upside for those two names. But Roku, they see really just broadly really benefiting from the overall shift we're seeing in more connected TV and advertising, and they see Roku being the standout of that space. And I will say I'm biased because I do have Roku TVs, but I always think that it is like the easiest, best way to get advertisements out there because the Roku TV land is just constantly playing at my house.
And I had a guest on Trading 360 earlier that was highlighting the importance of 2026 being a midterm election year. And that is something that also comes into play. And the thesis behind this double upgrade is that there are going to be so many political ads, and things like Roku TV are a great, as you said, way to get your ads out there and reach a lot of people. So, major potential upside, more than $20 higher than where we're trading right now for that new price target for Roku. We are seeing a pretty substantial downward move, though, for our next discussion topic about Pfizer here. Pfizer had we'll call it modest guidance for 2026, sort of demonstrating that some of their long-term investments are not going to play out perhaps as quickly as they had hoped.
Correct. And so this name is pulled back now about 4.5% this year. So we're not seeing, again, the volatility of the broader healthcare space has been all over the place. I think that if you close out this year right now, you would still consider this a pretty solid year, all things considered. But not helping with some updated revenue guidance now, they do say they expect roughly $62 billion in revenue for the year. They revised their revenue expectations and the details of their guidance now for 2026. Saying revenue should actually come in at the lower end of the spectrum, as they do expect less revenue just in the new year versus last, especially as their real efforts to remake their business continue to play out. So revising their guidance and outside again, $62 billion. We do see lower than expected sales of COVID-19 products and a $1.5 billion impact from various therapies losing patent protection. Back in November, the company did reaffirm its revenue to range between around 61 to 64 billion. So this is not a huge miss by any means, but it would be at the slight and low end of the forecast. But now, as we look to 2026, and this is where more of the concern is, you have now revenue ranging between roughly 59 to 62.5 billion. Now that was below the 61.6 billion expected, and also anticipates adjusted earnings per share to be slightly below expectations. This name did hit an all-time high back in 2021 during the pandemic, but we've since seen a very different, frankly, just enthusiasm for various drugs, and they've also had very public, unfortunately, cost-cutting initiations, and also we've seen the replacement of several of its senior executives. It does seem like there is a transitional period happening right now at Pfizer, and frankly, in the world of GLP-1, which is the brightest spot if you have any exposure to, they have not been a successful story. We've not seen some of their promised oral medications come to market, or some of their various drug therapies have the same effectiveness as, say, Novo Nordisk, Eli Lilly.
And I am interested to know if at any point they brought up any of their most favored nation promises with the Trump
administration. Well, they did.
The reason that they had lowered those forecasts, because obviously offering these significantly lower prices for Medicaid, Medicare, and through this potential Trump RX forum, could certainly weigh on both their top and their bottom lines.
Yeah, and I do think it is interesting because I will say their CEO was pretty transparent about right now really calling out specifically the CDC, FDA, and saying that right now there's also this perception broadly about vaccines. And so I'm bracing for what they do expect more and more of these patents to expire this year. But I do think it's really interesting. I'm losing roughly $17 billion in annual revenue to these patent expirations, plus also giving a pretty transparent really narrative around the fact that Americans are not as interested in vaccines, and that is not helping their overall business model either. So I think some of their commentary was interesting, as they did say they were hoping to return to growth by 2029, 2030, but I mean, this is like a long time away, Mark. It does not.
That feels very far away. Yes, I agree. Yes, it feels a long ways away. All right, this last one, we're going to move back into positive territory. We're going to talk about Okta. It's sort of tis the season for upgrades and downgrades. This time we've got an upgrade and a move to the upside for Okta coming from Jefferies.
Yeah, and I appreciate this note because as yesterday we discussed so many of these software names that were not seeing favorability from the sell side. A bit of a different tone today, as we did see Jefferies actually raised its price target to $125 a share from $90, also with a upgrade to buy from hold. And overall, just right now highlighting the fact that they continue to see more and more of these broader software sort of resetting trends into 2026. But specifically calling out the fact that this company does have a rare exposure into more of the authentication side of identity. And for that reason, they see them being more of an outperformer in their specific software world. And I mean, we do talk about a lot of the hardware versus software, you know, the AI winners, the AI losers, those that are the space is seeing massive consolidation. We have a considerable threat to some of their financial health into this next year. So I think, remember, not all software names created equal, and the cybersecurity space is one that is competitive, fairly fragmented, but if you're able to carve out a niche, like I do think that Okta has really been able to do and see this AI security momentum, I mean, this overall note was pretty positive on software in a different way than what we talked about yesterday, of course.
Yeah, certainly moving 3% to the upside here on this note when we know software has generally underperformed throughout 2025. But Jenny, thank you for breaking all of that down for us today, all those top movers. That's Jenny Horn, co-host of Next Gen Investing here on the network. I do want to send it back to Sam in New York, though, and find out what we have coming up in the rest of the show.
Well, Molly, we'll check in on the fixed income market and global central bank policy. Market on close, we'll be right back.
Hey, investors, you know the market moves. And Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to Market on Close. I'm Sam Bucks on the floor of the New York Stock Exchange alongside Marley Hayden in our Chicago headquarters. Let's just check in with these markets right now because, of course, we did get this all-important delayed jobs data. So We are, of course, working with that. It seems like a mixed picture as far as the labour market is concerned, is pointing to a little bit of confusion in these markets, just because, of course, we did get October and November's reading, which is telling us a few different things. We also got the unemployment rate ticking up as well, not to mention also a flat reading on retail sales beneath the surface. There were a couple of pushes and pulls there, particularly when you look at autos dragging. So the markets are trying to digest these numbers and think about what this might mean for the Fed coming up in 2026, given that, of course, they have penciled in one more rate cut next year. So we've got the technology, as you can see here with the NASDAQ, just putting on a marginal gain there, just to the upside. Technology, as I said, trying to make a bit of a comeback here. It does look like buyers have tried to step in, as we have seen that sector particularly under pressure in recent sessions, as we've seen that rotation out of high-flying AI names into other parts of the market. So that's a quick snapshot of what we're seeing at a headline level. The futures, as far as some of these products are concerned, the US dollar, we know the DEX has been coming off, that we're at 97 right now. Crude oil's obviously been a big story for us. We are at multi-year lows here. We're at $55 a barrel as we continue to track these developments around the peace talks with regards to Ukraine and Russia. Bitcoin, as we say, catching a bid, but still hasn't managed to recoup that key 90,000 level. We're at 87,000 and change right now. And then the 10-year yield, which initially came off following those reports coming out of course, the jobs market, coming off, ticking back up higher. We're now at 415, so we have ticked lower once again, so perhaps a little bit of bond buying going on there. As we say, across the sectors, we've got an attempt to try to make a bit of a recovery here in some of these big down sectors in recent sessions. Technology is just squeezing through there. Online to the upside. It's a similar story for communication services and consumer discretionary right now. They're eking out just these fractional gains. Will we get there at the end of the day? That is the big question. We've got 42 minutes to go here. Consumer staples are under pressure, financials as well, and the rest are doing like this. They're all red. We've got energy, which has been really feeling the brunt of it today off the back of those lower crude prices. We are down almost 3% when you take a look at some of the names in that sector. Materials is feeling it, so are industrials, real estate and utilities today. So we have seen mostly risk off across these sectors, as of course we continue to try to shake off these AI jitters and these concerns around valuations, as well as digesting all of this data and what it might mean next for the Fed. But I'll send things back over to Marley for now in Chicago.
So much, Sam. Joining us here in our Chicago studio is Ed Francis, the co-founder and CIO of Convexitas, to talk about some of the action we're seeing as we head into the end of the year and also some expectations that we can have for next year. Said thank you for being with us. We love having you here in studio. You always send over a note before we talk, and in this time, your headline, you posed a pretty big question for 2026. The question was, can the world still finance growth? What is making this moment different from past years?
Yeah, so I think we kind of have had a calm fixed income market. We're going on 3 years now, and I think it's like those constant setups where you had a buoyant fixed income market for a decade with zero policy, then surprise, we have inflation, we have an exciting fixed income market for, we'll call it 18 months, and because everybody gets addicted to, oh geez, like we're expecting chaos from that end of the spectrum, like now we've had a benign 3 years, and everybody's been able to focus on financing growth through the fixed income market. And stability tends to be important for that. If you're using fixed income markets to finance growth, that tends to be longer term projects. So when you're moving around like crazy, people don't like that type of investment in longer term projects, but we've had that acceleration of financing longer term projects because we've had such stability both in interest rates and in credit spreads. And the question is, are we going to still have that environment to finance growth next year?
And, we talk about a lot about the global central banks and how much they've been cutting, especially over the last 2 years. But you mentioned long-term. We haven't really seen those long-term rates come down. What does that signal to you?
Yeah, I mean, we might be at the capacity to manipulate policy, essentially, right? So, as you mentioned, like, globally, there's been a significant amount of rate cutting activity for the last 18 to 24 months. The U.S. is, I'd say, less than the rest of the world. We're maybe a little bit earlier on in our rate cutting cycle in comparison to others, but 2026 is going to see a shift from a global perspective, most likely into folks actually like raising rates, even though the narrative here is continue cutting.
And so you mentioned raising. Japan has been a sort of a big part of the conversation in the last couple of weeks, and it's been a major source of global liquidity. What happens if Japan is no longer exporting capital? They start hiking instead.
Yeah, I mean, and interesting, it was probably kind of part of their plan of their new government. They don't necessarily want to just be this financing engine to the globe. They want more growth internally from, operating perspective, jobs, things along those lines, and they're probably going to jack up fiscal spending to try to, force that to actually take place. And so all of the mechanics of financial services that utilize wherever the cheapest global financing is to potentially accelerate, growth maybe elsewhere for corporations, or even what we call financial engineering in terms of investment products, might need to find a new home or need to reassess what the cost of financing actually is to continue those projects.
And let's focus back here at home, because you said the U.S. not playing as big a part in this, but we got the delayed labor data this morning in the jobs data, and we did see an uptick in the potential for more rate cuts from 1 to 2 to 2% moving higher. The markets are still pricing in more cuts for us in 26, despite the fact that the Fed is not necessarily signaling that there are many more cuts coming. Are investors misreading
23
how much easing can actually help with growth from here?
Yeah, I mean, here's the balance, right? So what the Fed has signaled thus far, you don't throw it completely out the door, but you do a little bit, right? So we have a big change in the guard, and the change in the guard everybody's anticipating is going to be
I like how the orb played as a pivot point.
So the real guardrail
resistance, support.
We're going to focus on one thing. So if the market continues
resistance, support.
If growth expectations continue to trickle higher, we're going to see that potentially, have a problem is if longer dated interest rates start spiraling, a little bit out of control. But thus far, we've been very, very stable, and thus the market's digesting and accepting the concept of further easing, even in, we'll call it expectations of increasing growth. So there's no problems yet, but that's what I'd pay attention to if all of a sudden we continue to get okay job growth, okay overall headline growth, and potentially easing into that growth style environment. That's where you expect longer dated rates to maybe push back on that concept.
So let's say that happens. Let's say we start seeing fixed income sending some different signals in 2026 than we've seen. What should investors be watching first for the first flag? Is it yields, is it spreads, or is it issuance?
Yeah, I mean, oddly enough, it's like almost every other environment, you probably say spreads should be where you should focus first, but I actually think it's the risk-free rate. It's treasury yields are going to give you the first kind of input. And a bit of the reason for that is the amount of demand for, what we call annuity product, fixed delivery, return style product, it has skyrocketed and continues to grow pretty substantially. Ultimately, it's demographically, we have a bunch of folks entering that stage of their life where fixed delivery of returns is pretty important to support their fixed lifestyle. And once rates kind of got off the zero bound 3 years ago, unsurprisingly, demand for those types of products accelerated. And those types of products ultimately are investing in credit. Less so treasuries, much so, more so credit, which ultimately I think is saying that credit is a little bit of a false signal to some extent. Like the supply-demand mismatch there is pretty aggressive, helping credit remain pretty benign in terms of spreads. So I think the first signal is actually going to be coming from the treasury market, but you should pay attention to the little blips in the credit market, because it might be giving you a little inclination that, yeah, the supply and demand dynamics are a little bit weighted to excess demand, but when you have a little bit of issuance problem in a very specific name, then spreads move quite rapidly because ultimately the fundamentals show up later.
So do you think the credit markets are underpricing risk as we head into 2026, or just keep an eye for those blips?
I would say that they're pretty much pretty aggressively underpricing risk. I mean, listen, like being at a, call it 5-10% historical percentile where we're currently at in the credit cycle seems like pretty extreme underpricing of risk. Now, we're not saying that there's going to be lots of defaults or there shouldn't be somewhere else, but you're not exactly essentially getting compensated what we would say is appropriately for the risk that you're taking. And again, I think it's pretty obvious where it's coming from in terms of the supply-demand dynamics.
Zed, always wonderful to talk to you. Thanks for being with us to talk fixed income as we close out 2025 and head into 2026. That's Zed Francis from Convexitas. And I'll send it back to Sam in New York.
Thanks so much for that, Molly. Well, coming up next, the holidays are almost here, so we'll check in on e-commerce trends this holiday season and the state of the consumer when Mark Longpost returns.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall, on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Market on Close. I'm Marley King alongside Sam Bottis in New York. We saw a big pivot from Ford today. The automaker announcing it's taking a nearly $20 billion write-down of its EV division. The company will end production of its current generation F-150 Lightning pickup truck and will pivot towards increased production of hybrids, extended range vehicles, and smaller model EVs. The company also launching a new battery program as well. Taking a look at how the car companies are faring today in the automaker space, Ford just down marginally right now, GM down slightly more at 0.5%. Stellantis seeing the biggest loss today, but Tesla moving much higher on the day. We'll be talking about Tesla coming up here in Austin Corner, but they are up about 2.4%. I do want to bring Sam back into the conversation and welcome in our next guest. Joining us now, Scott Ashbaugh, the CEO of DHL of U.S. Commerce America. Scott, thank you so much for being with us today. We have a lot of macro uncertainty in our environment right now. As far as consumer behavior and what's shaping it the most right now, is it rates? Is it inflation? Is it jobs? What are you seeing as we head into this all-important holiday shipping season, especially for those of us who are late holiday shoppers?
Thanks, it's a pleasure to be here. So yeah, we have seen this year certainly a pivot towards value and cost is a major factor, at least when it comes to the cost of shipping. So we have seen our portfolio shift more air-related products to more ground-related products for the most economical path to consumer delivery.
Scott, you said it's such a fascinating juncture and intersection, and happy holidays, by the way. I think you and I really got the memo here without covering. But, consumers, supply chains, businesses, I mean, you throw tariffs in the mix, you've got the macro uncertainties in the environment as well, you've got geopolitics. What are you seeing out there right now? I mean, does everything look pretty resilient as we're hearing?
Yeah, it was interesting. When the tariffs first hit, we braced for a big decline in volumes. We fully expected to see that quite quickly update, and it didn't happen immediately. And the volumes stayed strong. We thought, okay, maybe it's that sellers had imported their products from abroad, and they were just eating through the stock that they had in place, where they had already paid the lower tariffs before. But time continued to go on, and the volume remained strong, and we were quite surprised and really kind of scratching our heads like, what's going on here? I would say then in October and the beginning of November, we saw a quite steady downturn in shipments per client quite across the board. And that continued right up until really the cusp of peak, and now that's been masked by a huge growth in peak volumes. And we're really interested to see what happens now in January post-peak. Are we kind of still maybe at some of this depressed demand level that we saw materializing there at the end of the year? Or does it snap back to volumes that we saw previously? So we don't know the answer to that yet, but the interesting thing that we noticed was this really delayed response to the effect of the tariffs, and that did surprise us.
And Scott, I'd love to get your thoughts on if you think that this is a temporary trade down some of these trends that we're seeing, or if you think that the consumer is structurally changing.
Structurally changing.
I think it's more about the cost of the goods and just straight up like cost and demand effect. And so it does appear that the cost of the goods has gone up. Now, is some of that inflation related? Is it directly tariff related? It's very difficult for us to say. But I can't really describe why it's happening. Only that we did see across the board an average shipment volume for our clients starting to take a turn downward.
I guess somewhat piggybacking off the back of Marley's question there to you, Scott, are we seeing this degree of resilience because of just how pessimistic we were at the start of the year with all the tariff talk, with just expectations so low that it gave room for some upside surprise? I mean, does it start to get a little bit more demanding next year, or do you think what we're seeing has legs?
I think I never underestimate the creativity of ourselves and our clients to find a way.
That's right.
And it's one thing we've seen over and over is when times get tough, folks get creative. And I think maybe we're seeing some of that of finding more cost-effective ways to source the products, more effective ways to sell and ultimately be successful. So will it stay? I think it'll change, but I do believe in the American businesses here to find a way forward.
And Scott, I'd love to get your perspective on how we're seeing businesses handle some of these tariffs, particularly from overseas. When we saw China drop their tariffs down, we saw those volumes rebound pretty quickly, so we did see some elasticity in global trade. But as far as how businesses are adapting to the tariffs and a lot of the uncertainty that we saw, did you see more rerouting in the supply chains, or are you seeing more businesses passing them on to the consumer?
Particularly for volume that was imported from China in the first place, where if you place an order and that piece is going to be shipped as a single item coming into the U.S., we saw a substantial amount of that volume be transitioned to now be fulfilled and kind of like held in stock in the U.S. So that means that the duties paid on that product coming in is paid on the cost of goods rather than on the retail value of it. So that was certainly a significant shift of volumes that originally were shipped kind of single piece post-transaction or for sale to the consumer, having that shift from basically fulfilled out of China to then instead be fulfilled from a warehouse here in the United States. That seems to have stuck, and I think that's going to continue on going forward.
Okay, and just to give us a snapshot also of the holiday shopping season, I mean, what have you seen out there? I mean, have you seen volumes sort of picking up, particularly around some of the heavily discounted periods where, people are really trying to take advantage of, the incentives that are out there because they are concerned about the hip pocket, or are things looking pretty stable?
Yeah, two things I noticed this time around. So one, the weekend of Black Friday through into
this PX 681291.
Much higher proportion of volume than we had seen in the past, which to me means where it used to be that Cyber Monday was the online buying, kind of point in time that really mattered. That's shifted now, and even in my own buying, I would see a lot of Black Friday sales online. So I do see more and more that maybe it's just a perpetual shift from brick and mortar into online. That continues to happen all around the holiday sales as well. So those Black Friday sales moving online more this year than I had seen before. But the second thing that I noticed was that, believe it or not, the average package weight jumped more significantly than in years past. And so to say exactly what that is, I would speculate that it's something to the effect of the merchants are getting more clever at how to add more items into your cart there at the last minute, and whether it be to qualify for free shipping or whatever the case may be. But it does seem that each package is getting heavier, and I attribute that probably to the savvy of the online merchants figuring out how to get you to buy more once they've got you involved in their online store.
Oh, they've definitely done it to me, Scott, so I can attest to their savviness. But we want to thank you for being with us today to highlight some of the trends that you're seeing today during the holiday shopping season. That's Scott Ashbaugh, the CEO of DHL E-Commerce America. And coming up next, we've got Options Corner. Alex Coffey will join us here in our Chicago studio to take a look at options activity in Tesla. That's next on Market on Close.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
It's now 3:39 Eastern Time, and we just...
I'm Kevin Green, and I track options flow daily. Identify who's buying,
how dare you.
who's selling, how it's going to impact the market.
I'm speaking.
Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos,
Hit the orb.
articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Market on Close. Another analyst is maintaining its bullish stance on Tesla today. Mizuho raised its price target on the EV giant to $530 from $475 and kept its outperform rating. Last week, it was reported that the company's U.S. sales fell more than 41% in November, but Mizuho is citing improving investor sentiment in robo-taxis for the price target boost. It's now time for Options Corner. Of course, we'll be talking about Tesla today. Helping us do that, Alex Coffey, co-host of Next Gen Investing, to take a closer look at Tesla and some of this action that we are seeing. Tesla hitting a new all-time high today, almost exactly a year from its last record high. I'm just noticing random factoid here. And very interesting, too, on the heels of this, these weak November numbers that everyone just seems to be looking past on the optimism of Tesla's future, not necessarily as an EV car maker.
Yeah, Tesla's always in the news headlines today, no exception. For good reason today, though, new all-time high literally just happening in the last, 10 or so minutes. So impressive roller coaster-like year for the company. You mentioned that note. Now, I don't know if the note was the catalyst or just well-timed, but nonetheless, here we sit with Tesla at all-time highs. So exciting stuff. It continues to be one of the most divided names on Wall Street. 45% of analysts in the buy camp, about 30% in a neutral or hold equivalent rating. And the sell rating carries about almost 25, a little bit more than 25%.
12-month average price target is sub 400. So perhaps new all-time highs hitting the tape may get some price target hikes, especially as this 2026 outlook season it continues to roll on. But you still have so many that are just not believers. Just in recent days, I mean, today, Morningstar with the sell rating and the $300 fair value estimate. Phillips Securities has a sell and a 220. Of course, Gordon Johnson still with the $19.05 price target. So with this, it's almost like you got to filter out what you disagree with, even if you have to acknowledge it, to get a more accurate representation of what a particular price range is. The bulls are in the 500s, the 600s, so it really just depends.
Yeah, right now trading at 489.22. Again, that almost a record high at that point. 490.25 is that record high. But very interesting, you mentioned the performance that we've seen from Tesla through the year. The first quarter plunged 36%, was worst performance in 2022. But then when we take a look at the chart, we just look at the last 6 months, we're looking up almost 50%. So, as you look at the chart, Alex, and you take a look at some of the technicals and what they're indicating, and also indicating a lot of this mixed sentiment that we're seeing, because it is a highly volatile chart when you take a look at it. What's it showing to you?
Well, one, a lot of the price action of the last year is no longer relevant. It is relevant potentially if you have a sell-off again, but when you're at all-time highs and we've made such a swift rally and turnaround, you can honestly just zoom in to what's more recent. And so that's what we've done for the first chart we're going to look at here, which is just a 1 month look at Tesla. But levels that we've looked at before, whether it was in the S&P 500 or other names that we talked about when I filled in here on Options Corner, 2 moving average. One represents a week, one represents a month. And I've talked about the relationship those two have with themselves and with price being an indication of short-term trend. Well, you can see back at the very beginning of the month, the 1 week crossed above the one month, and that was a potential buy signal, as the stock has only rallied a good, 15-20% since that moment. But also what you've seen is both of them are upward sloping, and that the price level is above both of them. So in the short term, that 1 week moving average, which trades right now, let's call it 475-ish, would act as a potential support level, and then below that, near around 450, would be that 1 month moving average as a potential next support level. That would be just if you were looking at just those indicators. Of course, we're at all-time highs again. There could be resistance at that, but I also put the boxes on here, Marley, that we've looked at a couple times before, and I know Rick talks about these as well. This is to visualize the next several weeks of what the market is basically pricing in its potential movement. So through the end of the week, there is still about a 4% range up or down, so 8% from top to bottom range being priced in of what might be possible just in a 1 standard deviation of outcomes. So that's between about 465 and about 500, 505. Through the end of the year, so I've been using January 2nd expiration, which is 16 days away, is that 9.3% up or down, so almost a 20% range, and then it increases to, basically 26% if you go out to that January leap cycle, which is 550 to 420. So it just goes to show that things are always relative, and ironically for Tesla, current IV percentile is 10. It's got low volatility relative to its own history right now, and you still have basically a 25+% range of potential outcomes that isn't even unreasonable over the next 30 days.
Yeah, potentially massive swing with low vol is very interesting as we look at that. And I know Tesla is generally one of the most heaviest names traded when it comes to options.
15 more minutes left
today as well.
Yeah, always. I mean, it's
specifically individual equities, it is rivaled really only by NVIDIA when it comes to activity, and today's no exception. Over 2.5 million contracts traded today. Calls consistently out traded puts about 2 to 1. Marlon, if we take a look at my second chart, guys, and we pull that up, looking at this, I didn't put a ton in terms of sophistication into this, but I put the lines here to represent some of these levels that I'm talking about. I like to use a stoplight system visually to kind of show, hey, maybe resistance to the upside, yellow is sort of the neutral kind of battleground areas, and then green potential support. That red 500 line is far and away the most relevant level by the end of this week. Over 60% of the options contract volume today, which I said was 2.5 million, actually took place in Friday's expiration. By far, from an open interest and volume standpoint, the biggest
strike that came up was the 500 call expiring on Friday. That's that red line. So perhaps an area you could see drawn like a magnet throughout the week, but it could act as resistance. And then there was kind of a range between about 480 and 470 where combined volume, calls and puts were trading relatively heavily, and that's that yellow section. And then below that, when you get outside of today's trading range, which this chart only represents today's market since the opening bell's trading range, that 460 level is that green level, also a pretty noticeable combined volume level. So. Yeah, always active, always making news headlines, and one of the most widely traded and watched stocks on the Wall Street.
And certainly that options activity kind of reflecting what we're seeing from the sell side as well, with a mixed sentiment in terms of its action. But Alex, we appreciate you filling in on Options Corner today and highlighting Tesla for us. That's Alex Coffey, co-host of Next Gen Investing and our senior equities contributor here on the network. I do want to send it back to Sam, though, and find out who she'll be talking to George about for overlooked stocks today.
Well, today the candidate is Lemonade, Molly, after an analyst upgrade there. So George Tillers will get us across that one. He'll break down the news about that company, what you need to know about the stock coming up next on Market on Close.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I'm Jenny Ward. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
How's it going?
First day, so. Sometimes,
Next.
Try again.
You could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl?
Schwab, a modern approach to wealth management.
Stay connected to the markets with the Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Welcome back to Market on Close. I'm Sam Butters, live from the floor of the New York Stock Exchange. It's time now for overlooked stock shares of Lemonade on the rise after Morgan Stanley upgraded shares this morning. So I'm joined by George Tillers to get us across this one, senior markets correspondent. So what is exactly the analyst saying, which is behind this note today as to why the shares are rallying up at 9% right now, George?
Yeah, I mean, you look at Lemonade, in fact, in the last year, the stock is up significantly, and it's actually trading quite well, considering the business is evolving, and also the financials are improving for Lemonade. And this is an interesting company in the context of artificial intelligence. It's essentially a digital insurance company, or if you will, an AI-powered diversified property casualty insurance company. So everything from auto insurance, property theft, liability, rent home, as I mentioned, car, pet. They also are moving into life insurance and annuity products. So one of the things to keep in mind is this is still an evolving business itself. They are competing with, major legacy companies like Geico and Allstate, which themselves have actually integrated artificial intelligence into their underwriting and, of course, claims processing, technologies. But one of the things about Lemonade is that they're essentially a business that is promoting themselves as, AI-centric. In other words, onboarding using AI, claims processing, faster and efficient, and as well as dynamic rating for insurance, which again helps set the risk premiums and premium prices at levels to actually mitigate loss ratios. So this is essentially one of the features or elements to Lemonade's prospects that Morgan Stanley alludes to in their call. So what Morgan Stanley did, they upgraded the stock to an outperform or equal from underperform, forgive me. They moved their price target to $85 from $53, and some of the metrics they talked about include, outsized growth in the auto space, which is improving for Lemonade. Like I said earlier, the loss ratios, which is essentially a payout for the dollars that are brought in for claims or having to pay out, is lower. In fact, it's 67% as reported last quarter versus 81% last year. Industry standards, which are moderate ranges between 50 and 80%. So again, they're within the context of that moderate industry group scope. The other thing is it's a unique story, as well as the fact that they do have a clear path to profitability on an EBITDA basis by the end of Q4 2026. This last point is actually quite important. If you look at the price action in Lemonade, just going all the way back to its inception as a reverse merger via SPAC in 2021,
Where in the heck?
$180, it dropped significantly in the trading range for multiple years, and it recently broke out of a trading range base going back to the second quarter of this last year, which goes back to effectively May, to which point the actual company declared that they're getting closer towards that EBITDA profit trajectory. And typically speaking, this has been my anecdotal experience and qualitative view of things, that stocks like Lemonade, which have pretty significant growth, in this case, 35 to 38% top line sales, price moves first relative to the extension of EBITDA profitability within about 4 to 6 quarters. So if you look at 2 quarters ago, that's when the move started for the year. And right now the stock is still trending higher. Nice day to day. I think it's in the context of a better market too, of about 8% on the back of the call from Morgan Stanley. And the stock is also trading above the 20-week moving average as a nice level of extension support.
So it's an AI-powered insurer, and I don't know what the rule here is at the Schwab Network, how many times you make the cut on overlooked stocks until you're no longer overlooked, because you and I just spoke about this one about a month ago, George, and it had rallied about 30% off the back of a strong earnings report. At that time, you had some analysts turning a little bit more bullish. I know that there was some concern at one point in the year around direct-to-consumer trends here in the US, just at least the rate of that in the market. But I mean, since you and I spoke about this last time, it's up about 16% or so in 1 month, year to date up 124%. So it's doing something right. What is it about this business that it's got going for it, as far as what else you're seeing out there in the market, from some of the competition, for instance?
Well, maybe some of the legacy names like Geico or Allstate still have a very large base of workers and sales agents that, process claims and help customers directly. You mentioned just a moment ago, maybe a lot of the customers like that. And some of the direct-to-consumer trends had, slowed down, for lack of a better word, for these up-and-coming, if you will, digital insurance companies. This includes companies like SelectQuote, Root, symbol ROOT, and Lemonade. But nonetheless, again, it really comes down to the powerful trends in sales, which in the case of Lemonade are estimated between 35 and 38%. The company's still not structurally profitable, but essentially the net loss condition of the business relative to sales, looking last year, they lost $174 million on $658 million in sales. They're getting closer towards an inflection point. If you just look at essentially the numbers for sales coming up this year, they're expecting $730 million for the full year, and they've got 1 more quarter to go. And next year, this is expected to jump to $1.2 billion. So effectively, the sales growth for this underlying business is improving closer towards that EBITDA extension, in other words, that inflection point, and price moves first. And that's what we're seeing here with Lemonade. But it doesn't mean you can't see, a couple of great quarters, which we've seen, plus another quarter pullback because maybe some missed expectations or potentially a bad quarter contingent upon, some property losses for things like, storms, events, and things out of the ordinary. So those are certainly things you have to keep in mind. But like I said too, the gross loss ratios are improving for lemonade, and that effectively speaks to more operating leverage for airline business going forward, as well as pricing premiums correctly based on top line sales.
Okay, look at lemonade. Certainly a bright spot in what is otherwise a down market today. We've got about 5 minutes left under the bell. Thanks, Georgia, for that, getting us across that company. I'll send things back over to Molly in Chicago for now.
Thanks so much to Sam and George. We're nearing the end of our market section. That, of course, means we'll be bringing in Kevin Green to break down the levels that he's watching on the S&P 500, as well as today's action. That's next on Market Up Close.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumers, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make-or-break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on the Schwab Network.
We're back here at Market of the Close. I'm Sam Barnes here on the floor of the New York Stock Exchange alongside Molly Hayden in our Chicago headquarters. So we've just got a few minutes left to go now. So let's welcome in KG, senior markets and correspondent, to help close out the session. So obviously we've got downers across the board, but there are some bright spots. Technology is managing to hold on there. We did see some buyers throughout the course of the session. It seems like KG, what have been your takeaways so far?
Yeah, I mean, actually, this is a pretty decent recovery day, and the Nasdaq 100 actually is in the green right now if you're just looking at that particular index. I mean, at the end of the day, we did see some selling pressure happening early on in the session where we were able to recover the 6,800 level. We're not able to get to the 6,880 where we kind of highlighted as a key area of resistance for today, but at least some buyers stepped in. Now, what's kind of interesting about today, which has been different from last week and a half, 2 weeks, is the Mag 7. They actually did outperform. If you actually look at it, 6 of the 7 components of the Mag 7 are actually in the green for today, and a lot of the risk-on trades or the traditional AI trades actually did perform pretty well, and that's a little bit different. So we have a concentrated market, only 3 sectors in the green: consumer discretionary, technology, as well as communication services. But they carry a lot of weight in the S&P 500, so that's exactly what we needed to see, as well as defending that 6,800-ish area. Now, going into the close, I'm looking at that as an area of potential pen risk here for the market. We're about 6 points away from it right now, but I still think that that would be a win for the bulls, in which we're obviously seeing losses of over 0.75% at the lows of today's session here. So you did get a little bit of a rally back. You also have to kind of look at some of the technical structure of not only the Mag 7 but also the semiconductors. The semiconductors tested the 50-day moving average. Was able to recover that on an intraday basis. That's really good to see. The Mag 7, as well as if you look at the Mag ETF, a little bit of a bullish engulfing candle, which is obviously bullish for that particular ETF. Also holding the 50-day moving average, which is definitely key here. The volatility has not been able to stay elevated for too long, still sitting around a 16 and a quarter VIX. So this is actually...
Well, I have to say that's a wonderful close. Tesla's really on fire. Tesla, and the hint that some of these other EV car makers are giving up, I think that's just a catalyst to help it along. But definitely the robo-taxi and the robots, and I think I have a lot of faith in this here run. We're going to 5. So it's been more or less a cool day today, relaxed. Everything was kind of just in its guidelines. And we'll catch you later. Have a great day. Hopefully I'll get over this cold tonight. Take a couple more aspirin. Whoa.